A very good afternoon, everyone. Welcome to Yashas Academy. We are on a mission to clear our examination in June 2024 CA Foundation Accounting. And there we go. We're going to do entire revision of entire syllabus of CA Foundation Accounting in today, tomorrow, and day after tomorrow's class. People who are writing your examination in the later date also can surely watch this. There's going to be no amendments in accounting. This is not tax and law. Come on. So here's our brief plan about how we are going to handle the topics. Today, day 1, 20th of May, we are going to do chapter 1, 2, 3, 4 and 5. This is usually 50% of the syllabus as per previous syllabus. But now it's not going to come to 50%. This will be hardly 30% or even in fact lesser than 30% in examination. And tomorrow's class, 21st of May, we'll be doing 6, 7, 8 and 9. That is bills of exchange, final accounts, NPO and income debt records. And 22nd of May, when RCB will be taking over RR, we'll be doing 10 and 11 partnership and company accounts. So the plan will be to finish ASAP that day, but I can't promise you anything, just like the result. So can we get started with chapter 1 theoretical framework? No beating around the bush, and I won't tell you any tips at the beginning. So we'll discuss the tips at the end as to topic wise. I'll go on telling you how to follow the tips. My only message or request to all of you people, when you start studying the subject of accounts, please put the weightage to dustbin and then start studying. There is no weightage. There is no prior percentage given. Yes, I agree that you all have access to one PDF in the ICA website which tells that 10 to 15% marks from this chapter, 5 to 6% marks from this chapter, 20 to 30 from this chapter together. Please don't follow. It won't work. You do this strategy analysis, you would be watching marathon revision once again, which I don't really want you people to be doing it. Yeah. Humble request, if you want to give it a try, please take one of the past examination, take one of the past weightage analysis, compare how many marks has come, how has come. Even if by mistake some topic matches with the percentage of weightage, because of the choice question that you have, it will go outnumbered. You do 4 or 5 topics together, which comes to 70% of your weightage as per the PDF given by ICI. Then you start writing the examination question paper. You see whether will you be able to get 70 marks. You can't. And one more very important thing that I want you to notice, the chapter that you skip might have the easiest question in the exam. The chapter that you do as like this is my strength, what if the most difficult question comes from that very topic in the exam? So I always believe in skipping topics. You should skip chapters in the examination hall after you see the question paper. Not when you're studying, not when you're revising, especially not when you're preparing. You get it? So we will do all the topics in these 3 days. Can we start with introduction to accounting? Let's start with a brief history of the word accounts. So whenever we see the word accounts, the primary question that should shoot in our mind is what exactly do we mean by the word accounts? So what is accounts? The name itself signifies it is counting. If you observe the name, it has C-O-U-N-T-S, counts in it. So the man started counting long ago. We're talking about the times when there was early men in the cave. He started keeping count of number of kids he had, number of cattle he had, number of wheels he made. From that day to the modern day where we open to see how many followers have I got overnight. Yeah, how many views have I got on the reel that I posted, and how many messages have I got. So you check all of that. That is also keeping count of things. Or if you are a professional looking into Instagram for professionals like LinkedIn, so there you see something that is also keeping a count of things. Or you check your mailbox to see how many mails you have received, how many mails you sent. That is also a count of things. Or you might get that one message on your mobile phone every day, no? Morning, your bank balance is so and so. That is also a count. So, or if you keep money in your demat account or investment account, what you see there numbers, that is also a count. So accounts is a count of things. So it is keeping a count of things. But talking about the definition that one has to read for the examination goes like this. Accounts is a systematic record or track with the definition is given by AICPA in 1941, American Institute of Certified Public Accountants. It says that accounts is an art of recording, classifying, summarizing in a significant manner and in terms of money, transactions and events which are in part or at least of financial character, which is usually analyzed, interpreted and communicated thereof. Sir, why are you going at this speed? This is a topic which will not come in the examination. Don't expect a question on what is accounts in the examination. That is over in second PUC accounting for 2 marks. So, but I cannot go forward without telling the definition. Every aspect in this definition, whatever you have, recording, classifying, summarizing, analyzing, interpreting, communicating, we have a detailed discussion on each of it in our first and second chapter. So you should know the overview of the definition, that is accounts. going a slide forward discussion, we'll ask ourselves, what do we mean by transactions and events? So what do we mean by transactions and events? All the human activities that we basically do will be transactions and events, and then we'll record it in books of accounts. If they're not transactions and events, we are going to ignore them. The question is, when do we call an item as transaction? When do we call an item as event? Human activities, what we do, coming to class, going home, sleeping, eating, all of these are human activities. Certain human activities affect in money or money's worth. They are called as economic activities. Certain human activities don't affect in money or money's worth. They are called as non-economic activities. We ignore non-economic activities. We focus on economic activities among human activities. The human activities which are economic activities will be further checked. Are they relating to the business or are they not relating to business? If they don't relate to business, again you will ignore. If it is an economic activity and if it relates to business, that's when we call it a transaction. So for a human activity to become a transaction, it has to go through two conditions. Number one, it should be an economic activity. Number two, it should be relating to business. Do you get that? Very good. So further, the transactions can be classified into internal transaction, external transaction, cash transaction, credit transaction. It is important to spot this. If you don't spot a cash transaction, credit transaction, internal transaction, external transaction correctly, you might end up writing wrong journal entry. Then you would have to do rectification of errors, which if you do, you will get marks, which if someone else do, they'll cut marks. Talking about transaction. So in short, what did I tell you? It's an economic activity that relates to business. Now, what do we mean by economic activity? Which affects in money or money's worth. Which affects in money or, very good. If it affects in money or money's worth, we call it a transaction. Then let's identify certain transactions within this. Are you ready? I'll show up a transaction, or it might be not a transaction. I want you to tell me whether it is a transaction or not a transaction. To start with, we will start with started business with cash of 1 lakh rupees as capital. Is it a transaction or not a transaction? Capital relates to business, 1 lakh rupees. It's an economic activity. It's a transaction. How about filling a bank application and receiving passbook and debit card from the bank? Why not a transaction? It is relating to business, but it is not affecting you in money or money's worth. In the same bank, if you deposit money, in the same bank when you withdraw money, the same bank gives you interest. If the same bank charges you bank charges, transaction. You get it? Then next step, deposited 70,000 rupees into this bank. Transaction or a transaction? Very good. How about purchasing a plant by paying 20,000 rupees by check? What is it? Very good. It's a transaction. And then we have appointed workers for operating the plant. The plant and machinery, whatever you just installed, in order to operate it, you appointed some workers. Transaction or not a transaction? Not a transaction. If you pay them salary, very good. Then paid wages to these workers who are operating the plant. Transaction. How about receiving free sample from the supplier, the person who supposed to supply to goods to us, no? From that person, we received some free sample before we place the order. Pre-order sample received. Transaction or a transaction? If we give sample, it's an advertisement expense. There will write the entry, advertisement expense account debit to purchase account. However, if we receive sample, it is not a transaction. Then issued price list to customers. Customer came, you gave them the price list, details of the product and the price at which these products will be sold by us. Transaction, not a transaction? Not a transaction, a red flag. How about issued free samples to customers? We are giving free sample to our customer. Transaction or not? Yes, it is a transaction. You get that? Then last one. What if you sell goods to customers? Transaction or not a transaction? If you sell goods to customer, yes, it is a transaction. So we now understood how to classify a transaction, how to classify a human activity into transaction and not a transaction. If it is a transaction, we are going to pass an accounting entry for the same. However, if it is not a transaction, there would be no accounting entry for the same. Now, further classification of transactions into internal, external and cash and credit. This depends upon the categorization basis. If you look at it from the basis of people involved, you call it internal, external. If you look at it on the basis of money involvement, it will become cash and credit. Let's see the first one, settlement in cash. If the transaction gets settled in cash instantly, it is called as cash transaction. If the transaction doesn't result in immediate settlement, the settlement is deferred or postponed to a later date, then it will become credit transaction. Let me repeat, when do we call it a cash transaction? When the transaction is immediately cash settled. The transaction is complete. You purchase goods, you immediately pay cash, transaction is over. You sell goods, you receive cash, immediately the transaction is settled, over. That is cash transaction. Credit is where it is not cash settled. There is still some due in receivable, or there is still some due in payable. So whether receivable or payable is not yet settled in cash, it is deferred to be settled on a later date, then it will become a credit transaction. Then see this, what is cash transaction? Settled by immediate receipt or payment. Credit transaction, settlement is not immediate. Then we will see some transactions wherein you need to identify whether it is cash or credit. Will you? Before that, what are the rules to decide? See, if the transaction says cash, then what is it? Cash transaction. If the transaction tells credit, then it is. If the transaction doesn't tell whether it is cash or credit, then what do? Then you check for name. If the name is given, credit transaction. If the name is not given, that's it. Because if someone asks you for loan, basic thing that you will do is you will at least ask their name, no? Some customer walks into your shop, he purchases goods, he gives cash. Then you will say get lost. However, he purchases goods, he will say I will give money tomorrow. But have to at least write his name down, no, as to who is he. You will ask, what's your name? You will ask. So when the name is given, it is credit transaction. You get it? So please see this. So when do we call a transaction as cash transaction? When it is mentioned as cash. And the transaction itself, it's mentioned as cash, then it is cash transaction. If it is mentioned as credit, then it is credit transaction. If they don't mention whether it is cash or credit, then you will check whether the name is mentioned. If the name is mentioned, then it is credit transaction. If the name is not mentioned, then it is cash transaction. Clear? I hope you don't have any doubt. Now, sometimes they don't straight away give the word cash. They'll say it is received. Goods have been sold and amount is received. Goods have been sold and amount is settled. Payment is received. Payment is made. So they will use some synonyms, indirect words to say that it is settled. So be little wise enough to understand what are they trying to tell, though they don't use the word cash upfront. They might use the word paid, received, settled, or several other synonyms in the place of word cash. Now there we go. We'll take some examples. Once again, the internal external. It's small misorganization. Yeah. Classify the following into cash and credit. Are we ready? See the first one. Started business with cash of rupees 1 lakh as capital. Very good. Then deposited 70,000 into bank. Why not credit? What can you deposit in bank? Kidney? No, you would have to deposit cash only. So obviously what you deposited is cash. Then purchase plant by paying rupees 20,000 by check. Whether you pay by check, phone pay, Paytm, paid. It is cash transaction. It is settled. The other person has not cleared it. To you, you will affect your bank account. To you, will affect your bank account. Sir, what if the other party has not deposited the check, it is not cleared? That there we do reconciliation. We will write the entry when we issue the check, not when the other party deposits the check in the bank. Okay. After this, what if you pay the wagers some money? Cash. Then wages outstanding amounts to 2,000. 2,000 rupees there is wages, but it is outstanding. Credit transaction. Why? It's not paid. How about purchased goods on credit? The name itself, the transaction itself says credit. Then it is credit transaction. How about purchased goods from Kiba for rupees 3,000? Credit? Why? They have not mentioned cash. But they have not mentioned credit also. They mentioned the name. How about sold goods to Sakura? Rupees 7,000. They haven't mentioned name. Further they mentioned, they haven't mentioned cash. Further they mentioned name. So what is it? Credit. Very good. How about sold goods to Sasuke for rupees 7,000? Cash. Cash is mentioned. So it is very good. Then let's see internal, external. Are you ready to see what is internal and what is external transaction? See, if it is settled in cash, cash transaction. If it is not settled in cash, credit transaction. Now we'll check people involved. If the transaction involves another person, then it is external transaction. If the transaction doesn't involve another person, it is happening within the business, then it is internal transaction. When do we call it internal? Doesn't involve another person. When do we call it external? Involves another person. Yeah, shall we take some examples? Did you see all the answers? No. People who are watching it on YouTube, you can take some pain in typing the answer or sending the color. Green color is yes, red color is no. Sorry, green is internal, red is external. I've got good afternoon, and after that, I didn't get response. Cool. First one, started business with cash of rupees 1 lakh as capital. There is no other person involved. It is you and your business. Sir, Gandhiji is involved in the note is there. No, that doesn't count. People who are alive, people who are actively taking part in the business, or who's getting some benefit, or they're giving some benefit or taking some benefit from business. So this is internal transaction. How about depositing 70,000 into bank? External. Bank is an external person. There is another person involved. What you keep? I'm not talking about the piggy bank wherein you put the money. I'm talking about the bank. So this is an external transaction. Why? There is another person involved. Bank is an artificial person. How about purchasing plant by paying 20,000 rupees by check? You pay 20,000 rupees. What is it? External transaction. How about paying wages to workers 10,000? Internal, external? External. Why? He's an external person. No, one more person is involved there. He is working within the entity, but he and you both are same. No, he's a separate individual. You will in fact open an account by his name. So what is it? It is external transaction. How about purchasing goods for rupees 2,500? They have not given any person's name. Whom did you buy from? You bought it from a person, no? Am I right? Whether artificial person or a real person, you bought it from another person. So this is an external transaction. How about goods which are not insured or are getting destroyed by fire? Internal transaction. There is no other person involved in it. You get this? Then sir, what if God of fire? God of fire is not counted as a person for accounting. You get it? What if the same goods were insured? Why? Insurance company is involved. Our loss will become their loss. So they will have to compensate money for us. So this will become an external transaction. How about depreciation that is supposed to be charged on plant? Sir, plant is a person. Plant is not a person. We're talking about plant and machinery. It's not Groot who's a person. So plant pay, if you compute depreciation, this will become internal transaction. So now I hope you understood the transaction part as well. Yes, very good. So idella aitu. Now what is accounts is over. Father of accounts is Luca di Pacioli. However, there is an earlier prescription given by Chanakya in his book Arthashastra. Not relevant, so we rushed it forward. Now we'll discuss the approach for accounts. Approach for accounts which is globally accepted is two. UK approach, US approach. UK approach is called as English approach or traditional approach. US approach is called as modern approach or American approach. So both the approaches tell the same thing. We have another approach also which also tells the same thing. Which one to follow? You can follow whichever you want. Ultimately the answer will be same. I will not correct you and then tell you have to follow only this. I have learned only this. You have freedom. You are in a country which has given you freedom to even abuse the Prime Minister of the country. So there is nothing wrong in choosing the method one among three. You get it? So you can follow whichever method you want. Okay. To begin with, the first one, like I told you, UK approach, traditional approach or English approach. There is another one called as US approach, American approach or what you call as modern approach. And there is one ultra modern approach which is going to become famous in the future. You guys are the first generation of people to learn it. So this is called as Bangalore approach. So this is another approach which is very similar, says the same thing what other approaches tell, but in a more simplified manner and a fun way. And I made this up. Okay, this is actually not there. Don't write in the exam Bangalore approach. I cooked this up in my kitchen. So Bangalore approach, yellow color kanasta illala. Yeah, sure, they've gone home. It's okay. Red is bright. Yeah. So Bangalore approach. Under the Bangalore approach, what it is, you need to remember the word Bangalore. What is it? B-A-N-G, bang. If you hit really hard. And after that, when you open the rest of the fingers, that will take the remaining letters in the spelling of Bangalore. B-A-N-G, A-L-O-R-E. So that is assets, liabilities, owner's equity, revenue and expense. The easier and shortcut to remember the entire accounting approach will be very simple. If in case you take assets and expenses, if they are increasing, we have to debit it. If it is decreasing, we have to credit it. So asset and expense, increase debit, asset and expense, decrease credit. The remaining three fingers, liability, owner's equity and revenue. liability, owner's equity, and revenue. If these three are increasing, we call it credit. If it is decreasing, we call it debit. Let me repeat. Asset, liability, bank, asset, liability, owner's equity, revenue, expense. ALORE. Asset and expense. A and E. Debit increase, credit decrease. Liability, owner's equity, and revenue. Credit increase, debit decrease. And that's the basics. And the same thing is told in different way. UK approach categorizes the accounts into how many categories? Two categories, personal accounts and impersonal accounts. And they give three golden rules. Golden rules are three, types of accounts are two. How many golden rules do we have? Three. Golden rule for accounting for real account. It says debit what comes in, credit what goes out. Then the rule for nominal account says debit all expenses and losses, credit all incomes and gains. And the rule for personal account says that debit the receiver of benefit, credit the giver of benefit. So this is a very simple golden rules given by UK approach. And like I mentioned, types of accounts are how many? Two. Personal and impersonal. Personal accounts are further classified into real personal, artificial personal, and representative personal account. Sir, what about real account and nominal account? They both are impersonal accounts. Let me make you quickly understand what are all of this. Real personal account. Real personal account is account of real persons. Me, I am a real person. You are a real person. I am not alien. You are not alien. AB de Villiers is alien. AB de Villiers is not a real person account. So, real person. If there are real person with skin, blood, bone inside, they are real personal accounts. Am I right? Then what is artificial personal account? Artificial personal accounts are persons who are created by law, not persons created by God. Persons created by law. We have created it based on our law and statute. Partnership firm. Partnership firm. Does partnership firm have birth and death as per the God script? Then Yamaraj will come and take the partnership when it is dissolved. No, it's a person that we have created by ourselves, by the act that we have passed called Partnership Act. Company, artificial person, association of person, body of individuals, or any other cooperative society, bank. All of these are artificial persons what we have created. What is representative personal account? These are actually accounts which represent a real person or an artificial person. When you say something called prepaid expense, or when you say outstanding salary, salary advance, outstanding interest. So these all representing. When you say outstanding rent, it represents landlord who's a real person. If you say outstanding salary, it is representing an employee who's a real person to whom you owe money. If you say outstanding interest, it represents the loan that you took from a company or loan that you took from a financier, real or artificial person. That is representative personal account. Representative personal account represents a real or an artificial person. Then we have real account and nominal account. Real account is account of assets. Nominal account is account of all expenses and incomes. Clear? I hope this space is okay with you all. If you have to finish 1, 2, 3, 4, 5 today without skipping topics, this is the speed at which I should go. Everyone's fine with it? Very good. It is called marathon for a reason. And asset definition, nominal account definition, and I've given you real, personal, and artificial accounts definition. I just explained these things to you. It's however there here. You can all go back and then watch it again on YouTube if you want. If you want detailed learning, go to this particular video, pause it, take a screenshot, and then read. If not, I think I am fine to go forward without spending more time on this basic. Can I? Very good. Then we will discuss the US or American approach. Under the US or American corn approach, under American sweet corn approach, there are 5 accounts. How many things? 5 things. Sweet and salt peka, tangy lemon, mint masala, butter and salt. Classic. So in US, there is nothing called mint masala, mix masala, peri peri. Indians, we made it. Butter and salt is the classic. We're having butter and salt in break today. So 5 categories: asset, expense, capital, liability, and income. Asset and expense. If it increases, we should debit it. If it is decreasing, we should credit it. Capital, liability, and income. If it is increasing, we should credit it. If it is decreasing, we should debit it. That's it. Sir, isn't this same as our Bangalore approach? I think they've copied. No, we are copy. We are a copy. We have copied it. Theirs is true and original. It's okay. Copy also has its own value. Let's understand the definition of the word asset, liability, expense, income, revenue, capital. Shall we? To begin with asset. What do you mean by an asset? Asset is a resource controlled by the entity. It's a resource. We won't call item. We won't call asset is something, asset is anything, asset is this thing, asset is that thing. No. Asset is a resource. Resource can be used again and again. Source means once. Resource means replay. You can use it multiple times. It's a resource. And to call it ours, we should have a control over it. Is ownership mandatory? Ownership, if you have it, good. But ownership is not mandatory. What is more important? You should have control. So resource controlled by the entity. This is arising because of a past event, and this is giving future economic benefit. This is arising because of a past event, and this is giving future economic benefit. That's when we call it an asset. You get it? So this is the meaning of asset. Asset is a resource controlled by the entity, arising from past event, giving future economic benefit. So then types of assets. Assets based on the period of holding can be classified into period of holding. We can call it into current and non-current. Based on the tangibility, touch, feel and sense, we can call it tangible and intangible. So to begin with, based on the period of holding, we'll classify them into non-current assets and current assets. Now when we say fixed assets or non-current assets, how do we decide a specific asset is non-current asset or current asset? It is based on the period of holding. What period of holding is a decisive factor? We're usually under the conception that 12 months. If it is less than 12 months, current. If it is more than 12 months, non-current. That is not necessarily the point. We'd have to check operating cycle in mind. We have to keep operating cycle in mind. So what do you mean by operating cycle? From the time you buy the raw material to the time you sell the finished goods and collect money from your customer, how much ever time is there, that is called operating cycle. From the time you buy the raw material, convert it into finished goods, sell it to the customer and collect the money from the customer. The time gap is there, no? That is operating cycle. Any asset whose benefit will get exhausted within the operating cycle is current. If the benefit from an item will last for a period longer than one operating cycle, becomes non-current. I repeat, any asset or any liability which will get expired within the operating cycle is current. If its benefit is prolonged for a period longer than one accounting period, it becomes non-current. However, if the operating cycle is lesser than 12 months, then we'll take 12 months as the basis. If operating cycle is more than 12 months, then we can take 12 months as the basis. So it is comparison between operating cycle and 12 months. It's not 12 months in isolation. It is not operating cycle in isolation. Do you get this? Very good. It's a classic point where usually people get it wrong. So I wanted to break that chain of misconception and then make it clear to you people. Further, our fixed or non-current assets, whatever are there, are classified into two classifications: tangible and intangible. Tangible, which has touch, sense, you can see it and you can feel it, that is tangible. What is intangible? Which cannot be touched, which cannot be seen, but can only be felt. Yeah, example, El Clasico example. Always you will say only one thing, goodwill. But there are a lot of other intangible assets: know-how, patent, trademark, copyright, license, and goodwill also, of course, whatever you tell. Then current assets, we won't classify them into tangible, intangible. You just imagine going to your debtor and then saying, can I touch you? Why? I don't know if I should call you tangible debtors or intangible debtors. If you try to touch, they'll touch. They'll touch really hard. So please don't try to check whether a current asset is tangible or intangible. Tangible, intangible classification is only for non-current assets, that is fixed assets. Further discussion is on liability. Liability is exactly opposite to asset. What do you mean by asset? Asset is a resource, liability is an obligation. Asset is a resource, liability is an obligation. I told you again with regard to asset that it is a resource arising because of a past event, because of which will get benefit in the future. What is the definition of asset? Resource controlled by the entity arising from past, because of which there will be future economic benefit. Liability is an obligation, which has arisen in the past, because of which in the future we are going to have a outflow of resources. So it's a present obligation of an entity arising because of a past event, and this will lead to outflow of resources. This will result in what? Outflow of resources. So what is the meaning of the word liability? Liability is present obligation of an entity. In the present you have obligation to pay money, and this is arising because of a past event, and in the future it will result in outflow of resources. arising because of a past event. Present, you have an obligation. In the future, there will be cash flow. That is liability. Got it? Past, present, and future of liability. Then we'll discuss the next topic of types of liability, current and non-current. Again, same to same what we discussed for asset. If it fits within the operating cycle, current. If it doesn't fit within the operating cycle, then it is non-current. Operating cycle is subject to minimum period of 12 months. If the operating cycle is 9 months, then what do you take as accounting period? 12. What if the operating cycle is 18 months? 12. Subject to minimum of 12. You can, however, consider if it is 13 months, 14 months, if you think some item is current item. But just because of small comparison with 12 months, it is not. You get that? Sorry, 18 months is what you will take. If the operating cycle is 18 months and period is 12, whichever is higher is what you consider. I hope that's understood. Sorry if I told whichever is less at some point. Then after liability, next topic is owner's equity. Owner's equity talks about what belongs to owner. What belongs to owner is the capital that he had invested in the beginning, capital that is invested later as additional capital, profits that the business has earned for his sake, minus the drawings that he has made. Basically, the money that the firm owes to businessman, money that he has given, minus money that he has taken away, plus the money that business has to give additionally to the businessman. Initial capital, plus additional capital, plus interest on capital, plus profit, minus drawings, whatever he has made, is basically the capital or owner's equity. Have a look at this. Amount invested by the owner, initially or additionally. To this, from this, we deduct the amount that he has withdrawn already. To this, additionally, we add the profit that belongs to him. Then we'll ultimately get the amount that belongs to the owner's equity. I hope everyone got this. Then last two, one is revenue, other one is expense. Revenue is the sum value of all the benefits that the businessman has given by way of service or goods that he has sold. Against that, he has to collect money. That becomes our revenue. What is revenue? Revenue, also known as income. Revenue is also known as income. It is value of all the goods sold or services rendered by the entity. It is value of all the goods sold or services rendered by the entity. Exactly opposite to this is expense. What is expense? It is value of all the goods purchased or bought or services taken by the entity. Value of all the goods bought or services taken by the entity. This is expense. Everyone got it? Fantastic. By this, we're done with the basic part. One more thing that we need to know here is, why do we do accounts? In this part, there are three parts. One is characteristic features, next one is objectives, and the last one is disadvantages or limitations. Objectives is to keep a systematic record of all the transactions that has happened in the business, to evaluate financial performance, to evaluate financial position, to know the profitability, and also to know the net worth of the business. And then comes three things. One, decision making. Based on this profitability and performance, you have to take decision. That is also helped with accounts. Next thing is, in order to know the solvency position, meaning at any point of time, if in case you close the business, will you have enough money to pay all the liabilities? That is understood by checking solvency position. And ultimately, what do? Astella. Everything's over. Systematic record, evaluating financial performance, position, decision making, and to know solvency position. Yeah, all five. So this is the objectives of accounting. What are they? Systematic record, financial position, financial performance, decision making, and finally to know solvency position. These are objectives. What are characteristic features of accounts? Accounts functions are to help us measure. If not for accounts, how do you measure your profits? How much profit? This much. This much means how much? Yeah. You tell in numbers, no? That is measurement. Forecasting. You will tell, no, next year our profits are expected to be this much. Q3 results are expected to be this much. They tell in terms of numbers. That forecasting, predicting the future is based on the past data, which is maintained by way of accounts. Accounts will help us take decisions. Accounts will help us compare our results with some other business results. It can be within the industry, or it can be competitor, or it can be some other industry altogether, or it can be the overall country's performance. So you basically can compare your profitability or your financial position with some other business because of accounts. Evaluation. After you compare, you take one decision. No? My business is done better than their business. My growth rate is 2% more than the industry. My profit percentage is 1% higher than my competitor. You arrive at these conclusions. That is evaluation. And finally, all this will help you control your business. If your GP percentage is positive, your net profit percentage is negative, that means your indirect expenses are more. Your sales margin is high, but your asset expenses are more. That means you have invested too much money in assets. So basically, you can control your business by analyzing the information that is there in financial statements. A lot of them take decisions now whether to invest in the business or not by looking at the financial statements. Whenever you seek for investment also, someone will definitely ask your financial statements. So accounts will help you control your business. Finally, government regulation and taxation. It is not like our hobby to maintain accounts. Government wants us to maintain accounts. Companies Act wants you to file annual returns. Income Tax Act wants you to file income tax returns. And all these legislations put together have put a responsibility on us to maintain proper books of accounts so that they get enough information to understand how the company is functioning when it comes to financial resources. Got that? That is functions. Lastly, we have limitations of accounting. What are the drawbacks or limitations of accounting? All the qualitative factors are ignored. We record only those items which are quantitative in number, and we also record only historical information. We don't give any consideration for the price change that happened after. Whatever was the price at which when we affected the transaction, that will be recorded. All the price level changes because of inflation are ignored. Accounts is biased because we can choose such a policy which will give the kind of profit that we want, and ultimately you can fabricate accounts to make it look like how you want. So that is window dressing. You can inflate the profits, you can deflate the profits, show higher worth of assets when the actual worth is less. So when you can play around with accounts, trying to beautify it either to attract investor or to evade tax, that's what we mean by window dressing. And this is limitation of accounting. After this, then one last point that's there, this was asked in your recent RTP also, is what can you do after you qualify as a chartered accountant? Role of an accountant in the society. So there are several parts. Service part was what was asked in MTP or RTP, I don't know. MTP litra. MTP had a question. What is the service, what is the role of a chartered accountant in service industry, or what services can a chartered accountant offer? So as a chartered accountant, you can help people maintain their books of accounts when they don't know how to maintain accounts. You can help them audit their books. Auditing can be internal audit, auditing can be statutory audit. And you can help them in consultancy, tax consultancy, management consultancy, meaning how much tax to pay. You can help them identify. If they don't know how to manage their business, you can help them. You can help them in arbitration. Arbitration is settling the transactions outside the court if there is a conflict. Or if they want to start a business, they don't know how to incorporate a business, how to get the certificate of incorporation. If you want to create a partnership firm, where to apply. So they don't know all of that. So all of that is a service what a chartered accountant can definitely offer. And you can help them plan their money, financial planning and advisory, treasury management, taxation. All of this is the work what a chartered accountant can offer as a service. This was the question in MTP. However, if you don't want to get into service sector, you can get into something called industry. You can go seek employment. In what fields can you seek employment? Can you seek employment in engineering department? No. You can seek employment in finance department, accounting department, costing department, treasury, budget. These are our core areas. We can seek employment here. If you don't want to seek employment in industry, you can work in PSU. By PSU, I mean public sector undertaking, like BHEL, HAL, BEL are there, no? So there again you can work in such public sector undertakings. So all of these public sector undertakings, when you work, there also will work in same department: finance department, budget department, accounts department, audit department, reporting department. This is where we can work. Or we can become entrepreneur. Entrepreneur agbeku anta you can decide. Then if you become entrepreneur, you can help in country economical growth of the country. Or you can decide to help the government frame their fiscal policies. Usually in the financial year beginning or before the financial year, they come out with budget. The finance minister of the country and the state comes out with the budget. So when they come out with the budget, there is a huge team which sits behind and then makes the policy, financial policy for the country. So you can be part of a team that frames the fiscal policy of the country. That is helping trade, commerce, industry or public goods and service. Or like I told you, you can become entrepreneur and then you can contribute to the economic growth in your own way, whichever way you want. You can open sandwich gully if you want, or you can put chai business, whatever business you want, and you can still contribute to the economy of the country. So this is our introduction to accounting unit in theoretical framework. Got that? Next, we'll do concepts and conventions. We have 2 more units in this, concepts and conventions. After that, we will be discussing capital revenue and valuation principles, including introduction to accounting standards. First chapter is going to go a little flat, and you guys would have to deal with it. If you try to do it by yourself, it's more difficult. You wouldn't be able to do it at this speed. So trust me, it's good that you people force yourself to do chapter 1 to 3. Please don't skip easy topics, so please don't skip. Let's start with concepts and conventions. Shall we start with accounting concepts and accounting conventions? First, we'll discuss accounting concepts. What do you mean by an accounting concept? Concept is an idea. Concept is an idea, means it should glow. It's an idea, or we can call it notion also. This should have universal acceptance. It is an idea which has universal acceptance, and this is followed in preparation of financial statements. 3 things to remember. 1, idea. 2nd, universal acceptance. 3, used in preparation of financial statements. So if you remember that it's an idea which has universal application and it is utilized in preparation of financial statements, then it is accounting concept. 3 images: idea, bulb; 1, globe; 3, paper. Idea having universal application, which is a primary assumption based on which financial statements are prepared. How many of them do we have? We have 10 of them. How many of them? To begin with, entity concept, then we have money measurement, periodicity, accrual, then matching, going concern, cost, realization, dual aspect, and objective evidence. Let's start with going concern concept. It says that an organization neither has an intention nor a necessity to close down its operations in the near future. It says an organization neither has an intention nor a necessity to close down its operations in the near future. We prepare balance sheet because of going concern concept. We close our shop today with an intention of opening the shop tomorrow. So when we close our shop today, whatever is there inside the shop will be written in our balance sheet, because we'll use them next year. If you don't have an intention to open the shop tomorrow, what do? You sell everything that's there in your shop today. The difference between current and non-current is also there because of going concern concept. There was a question on this in your recent RTP. They had given an item, they told an organization is not a going concern. If it is not a going concern, then how should they value their assets? If the organization is going concern, they'll record the assets at historical cost. If the organization is not a going concern, then we'll record the asset at its realizable or fair market value. There was a question on this in our recent RTP, if I'm not wrong, and a question on this concept had come in your recent CA Intermediate May 2024 examination also. They had asked to prepare balance sheet of a company when there is no going concern. So then what do? Fixed assets also will be recorded at fair market value or realizable value, not at historical cost. And all the liability should be recorded at realizable value, the money that you should pay, settlement price. We have to record them at that price. So that's going concern concept. The balance sheet of a company is prepared because of going concern. If not for going concern, there would be no balance sheet. Then we have periodicity concept. Periodicity concept says that the entire life of the business, which is really long, will be broken into smaller pieces, and each small portion or each small piece is called as accounting period, and we prepare financial statements for each of that accounting period. So periodicity concept says that entire life of a business is divided into smaller portions called as accounting period, and books of accounts or financial statements are prepared for each of the accounting period. Got it? This is also called as accounting period concept. What is the other name for this? Very good. So then we will discuss entity concept. Entity concept says that an organization is distinct from its owner. An organization is distinct from its owner. They both are two different persons. They are not the same. An organization is distinct from its owner, and that's what we mean when we say entity concept. The personal affairs of the owner and the business affairs are very distinct. They are definitely not the same. And capital invested by the owner is a liability to whom? To business, because they have to pay it back to the owner at the end of the day. However, From the owner's perspective, that capital is asset because the owner can receive that money back from the business at the end of the business. So the same capital which is liability to business is actually asset to owner because they are distinct persons, they are not same. Business, owner are distinct and very. Okay, what do we have after this? Then the next discussion comes to money measurement concept. Money measurement concept is that if you want to record a transaction in books of accounts, it has to be written in terms of monetary value. It has to be written in terms of monetary value. If you cannot measure it in terms of money, it cannot enter into your balance sheet. So monetary measurement is very important. Money measurement concept is that transactions to be recorded in books of accounts should be measured in terms of money. Transactions to be recorded in books of accounts should be measured in terms of, what is it? Money. Why money? Why not any other numbers? Because it is of standard economic value and there is universal acceptance, and we basically use it as a medium of exchange, so we write it in monetary terms. You cannot write in kgs, quintals, liters. You get it? Money is standard unit of measurement, universally accepted. What is after money measurement concept? Accrual concept. What does accrual concept say? It says that we should record transactions and the transaction happens. We don't wait for actual affecting of the transaction in cash. Certain times transactions happen now, cash is affected later. So we should record it now and we should not wait for the cash to get affected. So record the transactions as and when it happens and not merely when it is affected in cash. Record the transactions as and when it happens and not merely when it is affected in cash. Today you purchase the goods, you pay the money after 1 month. Today you should record purchase entry though you didn't pay cash. Today you should record the purchase entry though you did not pay the cash against the same. After accrual concept, yeah, like I told you, accounting can be two bases. One is cash and the other one is accrual. Business entity should follow accrual basis. Business entity should follow accrual basis. Then after accrual concept, next we have matching concept. Matching concept says that we need to match. What should we match? Our current year expense with our current year income. We need to match our current year expense with our current year income. When we match our current year expenses with current year income, if income is more, expense is less, it will become profit. If expense is more, income is less, it will become loss. Imagine P&L account here. I'm writing all the expenses here. I'm writing all the incomes here. I'll match my current year expenses with my current year income. Income is more, expense is less, profit. Expense is more, income is less, loss. And when we match, we should use current year. We cannot take last year profit, current year expense, or current year profit, next year expense. If you take current year expense, current year income, when we match, we get current year profit. Correct? That's matching concept. Matching concept is possible because of accrual, and it's also possible because of periodicity. If not for accrual, let's say the expense is incurred this year, paid next year. Accrual concept forces us to write the transaction in this year, because of which matching is possible. If we don't write the transaction this year, let's say we write the transaction next year, then current year expense is not recorded in current year. How can you compare current year expense with current year income to find current year profit? And breaking that entire life into periods is because of periodicity. So it is based on two things. One is periodicity, second one is accrual. Got that? That's with regard to matching concept. And after we finish matching, then we'll go to cost concept. What do we mean when we say cost concept? Cost concept says that whenever we purchase an asset, we should pay money for the same. The price that we pay is cost, and cost is the price at which we should record. What is it? Cost concept says that whenever we acquire an asset, the money that we pay is cost, and the cost is the value at which we should record the asset. What is the price prevailing in the market? Doesn't matter. We record it at the price that we pay. See this, value of an asset is determined based on historical cost. Historical cost is the amount that we paid when we purchase. This is what is usually followed when there is going concern. However, when an organization is not a going concern, when it is going to be liquidated very soon, we don't have an objective of holding the asset for long. We will sell it. Because we are about to sell the asset, we will record it not at historical cost, but we will record it at realizable value. When there is a going concern, how do we record the assets? Historical cost. When there is no going concern, we will record the assets at realizable value. And there are a lot of other valuation principles, replacement price, and then let's say fair value or realizable value. All of this we'll discuss that later. Current cost, we'll discuss that later in the same chapter towards the end. So like I mentioned, if there is a going concern, historical cost. If there is no going concern, then realizable value. Talking about realizable value, we'll move into realization concept. It says that assets should be usually recorded historical cost. That is when the organization is a going concern. If it is not a going concern, there is something which is completely opposite to historical cost method. What is it called as? Realization price method. This says that record the asset not at the price that you paid, but record the asset at the price that you will get if you sell. Record the asset not at the price that you bought, but record the asset at the price that you get if you sell. That is realization concept. When do we follow realization concept? When there is no going concern. When there is a very good, then it is now accepted because revaluation of PPE is allowed. Then we have something called as revenue recognition concept, which is actually not part of your syllabus, but let me just reiterate that part to you. Should recognize revenue on sale of goods when there is transfer of three things. 1. Risk. 2. Reward. 3. Effective control. You will recognize revenue on sale of goods on transfer of three things: risk, reward, and effective control. This is with regard to revenue recognition concept. Previously, under the old scheme, CA CPT, when the ICA had issued the material, no, this was there in that. However, in the new scheme of education, when the new syllabus material has been issued by ICI, in that new syllabus, there is no concept of revenue recognition in the material. We'll still read that. Realization jote revenue recognition. I'll just tell it. Then dual aspect. This is the basis for accounting equation. We write no assets is equal to liabilities plus capital, or the entire debit credit logic is based upon this. This dual aspect concept says that every transaction what we deal with will have two aspects. Every transaction what we deal with will have how many aspects? Two aspects. And as a businessman or as an accountant, when we identify the transaction, we need to recognize both the aspects of the transaction. We need to measure both the aspects in terms of money, and we should record both aspects. So dual aspect concept says that every transaction will have two aspects. We need to recognize, measure, and record both the aspects of a transaction. Have a look. Every transaction or event will have two aspects. We need to recognize, measure, and record both the aspects. Accounting equation assets is equal to liabilities plus capital is possible because of dual aspect concept. This says that whenever an asset is increasing, it will lead to decrease in another asset or increase in liability. If there is decrease in any asset, examples I think I can skip. If in case there is decrease in an asset, it will lead to increase in another asset or decrease in liability. Example can be cash paid against a loan. Then if there is increase in a liability, it will result in decrease in another liability or increase in an asset. Finally, if there is decrease in a liability, it will lead to increase in another liability or decrease in asset. Let me repeat. Increase in one asset will lead to decrease in another asset or increase in liability. Decrease in one asset will result in decrease in another asset or increase in liability. If there is increase in liability, it will lead to decrease in another liability or increase in another. No. If there is increase in liability, it will lead to decrease in another liability or increase in asset. If there is decrease in liability, it will lead to decrease in an asset or increase in another liability. Did I tell wrong at some point? But I corrected it. Now it's all fine. No doubts on this. Then zooming into the next topic, objective evidence, which is the last concept. This is also given in blue because again this concept is not there in your material. Objective evidence. What does it say? Every transaction, whenever we are going to record it in books of accounts, we should check whether that is an authentic transaction. How do we check? Or why do we check? We check to know whether it is business transaction or not. So to check it, we need some evidence. That evidence should prove the objective of the transaction. So every transaction that we deal should have an evidence supporting the transaction. That is what we mean when we say objective evidence. Every transaction should be backed by an evidence proving its objective. Bill, invoice, voucher, anything can be there. Got this? This is the last concept. Concepts and conventions are not same. Concepts are different, conventions are different. Concepts are fundamental assumptions based on which we start making financial statements. Conventions come in the process of accounting. Concepts are fundamental assumptions based on which accounting is done. Financial statements are drafted. In the process of drafting the financial statements, what will arise or what will come by usage and practice is conventions. So these are the practices that has come over a period of time. Got it? How many conventions do we have? We have 4 of them. Number 1, conservatism. Number 2, consistency. Number 3, materiality. And number 4 is full disclosure. When we say conservatism, it says that we need to record a transaction. We need to record a transaction relating to expense or a liability, even if it is not affected in cash, even if it is going to be in the future. If we expect it, we should record it. However, if you expect a profit, if you expect an asset as a result, don't record it. Wait for it to actually happen. So we need to record for all expected expenses and losses, but not for expected incomes and gains. What does conservatism say? Account for all expected expenses and losses, but not for expected incomes and gains. This will actually result in overstatement of assets. This will actually result in understatement of assets and overstatement of liability and understatement of wealth, but can't help it. So it will result in understatement of income and wealth, and it will result in overstatement of liabilities and expenses, but that is okay. Only thing that you should keep in mind is prudence. You should do practically. You cannot be biased, or you cannot be with an intention of window dressing to do this or to show higher profits. This concept or convention of conservatism needs to be followed based on prudence, neutral mindset, and faithful representation of your financial statements, with the intention to show your financial statements in a very fair way. Got it? Then after conservatism, we have another thing called consistency. What does consistency say? It says that the accounting conventions or accounting policies that we follow should be same from one accounting period to another accounting period. We can't keep changing. This year I'll follow some accounting policies. Next year I'll follow some other accounting policies. You can't keep changing them. You have to follow the same accounting policies and practices from one accounting period to another accounting period. That is consistency. Can we break consistency? We are allowed to change our accounting policies. We are allowed to change our accounting policies, but the exceptions are given in accounting standard 1. We'll discuss that there, and for now let's slightly go forward. Consistency will enable comparability. If there is no consistency, what will happen? You yourself are following different things every year. How can you compare your previous year profits to current year? You cannot. In order to compare your previous year profits to current year and current year accounting policies and practices should be same. If policies and practice are different, and if there is difference in profit, that profit difference is arising because of change in accounting policies. No, that cannot tell you about your results. We'll discuss policies later, and the periodicity will enable consistency. If not periodicity, you cannot break entity into years. No, then how can you check consistency between years? Then we have materiality. As per your materiality is the last convention. What does materiality say? Materiality says that all the facts and figures which affect the decision making of the user has to be disclosed separately, and that's what we mean when we say materiality. All the facts and figures that have significant economic value and will affect the decision making. If that information is told to a person, the kind of decision that will take will be different. If that information is not told to him, then the decision that he will take will be different. So if that data or information can decide the decision making, it can help person take a decision, then it is called as material. If it doesn't let him take decision, then it is called as immaterial. All the material information which will affect the user has to be disclosed separately, and immaterial items need not be disclosed. That is as per materiality. However, there is one more convention called full disclosure, which was previously part of your book, now not there. What do they say in full disclosure? They say it doesn't matter whether it is material or immaterial, you still have to disclose it. It doesn't matter whether it is material or immaterial, you still have to disclose it. Isn't there a conflict between materiality and full disclosure? Answer is yes. Materiality says disclose only material items. Full disclosure says disclose material items as well as immaterial items. What do we do? Which one to follow? We should follow both. We should follow materiality. for disclosing all the material items. Immaterial items will also be disclosed, but not with the same element of detail. Immaterial items can be just disclosed at one place. Material items will be disclosed on the face of the financial statements, in bold, in italics, catching all the attention, giving necessary disclosures. Immaterial items all together at one place, saying that these are also the disclosures that we're making, but these are not material. Are you getting it? By this, we finish accounting conventions and accounting concepts. There are two concepts and one convention which is regarded as fundamental accounting assumptions. What are they called as? We need this for later, so I want you to remember. How many accounting concepts? 2. How many accounting conventions? 1. What are they? Going concern, accrual, and consistency. Going concern, accrual, and consistency are 3 of them which are called as fundamental accounting assumptions. Fundamental accounting assumptions. So what do you mean when you say fundamental accounting assumptions? I will get back to that part when we do the next unit. So we're done with 2 units, and another 15 minutes max we will finish this unit. Next unit, remaining part of our chapter 1. The third unit is on accounting cycle, which I am not doing right now. The reason being, whatever is there in accounting cycle is again repetition in accounting process. So we'll cover it up there. In a regular class, we do it in separately only. But because these units are overlapping one with the other, rather than repeating, I would choose to do it in accounting process topic. Considering that this is marathon revision and hoping that you people have done your reading before attending the marathon revision session. Usually people watch it at 1.5x speed. Do you really have the guts to watch this video at 1.5x? Usually that's what you do, no? Whenever you see a video of 1 hour, 1 hour video means I can finish in 40 minutes. Why? Some part I will scroll, drag it forward. Some part I will watch it, double tap and forward. Some parts what will I do? I will watch it at 1.5x, 2x. Huh? Really? Surprising. 1.75. Yeah. Possible 1.5 this? I am only going at 1.5. Capital or revenue. So this is helping us decide whether a transaction is a capital transaction or a revenue transaction. In this context, when we say capital, we are not meaning capital which is like reserves and capital, opening capital, additional capital drawings. No. It is capital receipt, capital payment. It is capital receipt, capital payment. It is not that capital. And when we say revenue here, it is not income. Like sum of all expenses, benefits given or goods sold against which money is supposed to be received. Not that revenue. Here when we say revenue, we mean revenue receipt, revenue payment. When we say capital, we mean capital receipt, capital payment. When we say revenue, we mean revenue receipt, revenue payment. Got it? Now, what do you mean by capital receipt? Or how do you pick a transaction and tell whether it is capital or revenue? There are certain bases. The basis is number 1, nature of business. What is the number 1? Nature of business. Let's say you bought a building. It can be a capital payment if that building is used for office purpose. However, you are a realtor, you are a real estate dealer, you buy and sell properties. Then you bought a property. Then the same payment what you paid for the building will become a revenue payment. So nature of business will decide whether a specific payment is capital or revenue. You paid money to buy a car. That car is used for your business purpose, for you to commute between your office or commute with, say, from one office to another office. That is a capital payment. However, you are a car dealer. You buy car, you sell car, you buy car, you sell car. Hyundai beka sir, Hyundai i20, 20,000 ಇದೆ sir. Yeah, Icon beka sir, 40,000 ಯಾರು ಕೊಡೋದಿಲ್ಲ sir. Registration also free. Swift Desire beka sir, ಇದೆ sir. XUV Renault Duster beka sir, ಇದೆ. So someone is selling cars like that. For him, that payment what he makes for sale of the car, purchase of the car, that payment what he makes when he purchases the car, that receipt that he gets by sale of the car is all revenue. However, you buy car for your office purpose or you sell your office car. You are not a dealer in cars. Then you purchase and sell car. That payment or receipt is capital. If you are a dealer in car, it is revenue. Do you get it? Say something. Very good. So first one is nature of business. Next one is purpose. What is it? Purpose. When you buy it with an intention to sell. When you buy it with an intention to keep. That will help us decide. Maybe you are a real estate dealer, but you bought a building for your office. Just because you are a real estate dealer, the moment you buy a building, it will not become revenue payment. If you bought that building with an intention to make it into your office, that will become capital. Got it? You are a car dealer. You bought a car. The moment you buy a car, it doesn't become revenue payment. What if you bought that car for your office purpose, for you to use? Then it will become capital. Got it? So first thing is nature of business. Second one is purpose. Third thing that we should note is recurability. If a specific payment or receipt is recurring in nature, it is revenue. If it is not recurring in nature, it is capital. Recurring is repetitiveness. And what is the frequency of the transaction happening? If it happens very frequently, very repetitively, very often, with less gap between time, revenue. If it doesn't happen usually, if it happens once in a blue moon and it's a long form transaction, capital. This is not the only three consideration. We have one more, materiality. If the amount paid or amount received, if it is material, if it is significant, it can affect decision making, then it is capital. If it is negligible, if it is not going to be big, if it is not going to let you take decisions, then it is revenue. So materiality is also a factor to decide whether it is capital or revenue. And the last point is revenue generation capability. If you make payment, against that payment you get a specific asset. That asset has a capability to generate revenue income to you, then that payment is not revenue. If a payment that you make will give you benefit in long run, if it's going to create revenue income to you in the future, that payment will not be revenue. That payment will be capital in nature. Got it? So if it is going to give revenue in the future, that will not be revenue, that will be capital. So this is the basis to decide whether a transaction is capital or revenue. Why are we classifying the transactions into capital and revenue? Why should we classify? Because the accounting treatment is different. If a specific transaction is revenue in nature, it will go to P&L account. If it is capital in nature, it will go to balance sheet. And you need to be cautious with regard to one item called deferred revenue item. What is deferred revenue item? Looks like capital, but it is actually revenue. Looks like capital, behaves like, it's actually revenue, but behaves like capital. If you pay some 10 years, 3 years, 4 years expense together, prepaid insurance, prepaid rent, you might feel like it's capital item. It is actually not capital. It is revenue for several periods written together. What should we do? To the extent it relates to current year, we'll treat it like revenue. To the extent it relates to next period, we will treat it like capital. It's not capital. We'll treat it like a capital item by writing in balance sheet. Let us say we paid rent for 18 months. We should pay rent for how many months? We paid rent 18 months. In the 12 months is current year. 6 months is next year. To the extent it relates to 12 months, it is revenue expense. It will go to P&L account debit side. To the extent it relates to 6 months, benefit will be taken in the next year. So you defer that 6 months of rent to next period. We'll write that 6 months rent in balance sheet of current year, and in the next year you shift from balance sheet to P&L. So you are deferring of postponement to P&L. Though you paid 18 months rent in current year, you are not writing 18 months rents to current year P&L. You are writing 12 months rent to current year P&L, 6 months rent in current year balance sheet, and in the next year from the balance sheet you shift that 6 months rent to P&L account. That is deferring the revenue. Got it? Ultimately after this, then we'll go to accounting policies. Like I told you some time ago, accounting policies and practices should be consistent from one period to another period. There when we told accounting policies, what do we mean by accounting policies? It is principles which are the basis of preparation of financial statements. What are accounting policies? It is principles and methods of applying those principles in preparation of financial statements. Whenever you have to value your inventory, you have FIFO, LIFO, SAM, WAM. Whenever you want to value your fixed assets, you have cost model, revaluation model. Whenever you have to find goodwill, you have simple average method, weighted average method, annuity method, super profit method, capitalization method. So you have multiple options, multiple principles, what you can pick. And these are picked and applied in preparation of financial statements. They are called as accounting policies. I have given examples also. Got it? There is a big problem because of these accounting policies. What is it? Too many to pick, no? Too many options. What if you pick wrong option? What if you pick wrong option? What if you pick the option which is not appropriate to you? Then what happens? There is no comparability, there is no reliability, there is no standardization. You follow one policy, I'll follow one policy. Both of us didn't follow same policy, profits are different. We cannot say the statements are prepared based on different policies. Can we compare our profits? No. Is there some standard rule that everyone is following? No. And you are looking at some company's balance sheet or PL. You can't even trust that. Why? You can trust that balance sheet only based on the accounting policies that they follow. You buying food on the street side, you can trust and eat that food only if you know the ingredients. If the ingredients that they're using is not standardized, if they're using engine oil to do bhaji, you're like bhaji onthara different ide, chennagide, but you won't know that what is happening. So you should be able to figure out the ingredients. There should be standardization. That is where accounting standards will come. But before that, what is the cons of accounting policies? No comparison, no standardability, no standardization, no reliability, no uniformity, and there is only one thing, which is difficulty in selection. You don't know which one to select. These are the problems of accounting policies. To overcome all of these problems is a solution called accounting standards. These accounting standards are issued by ICAI, Institute of Chartered Accountants of India. ICAI, using all its powers, has issued 32 accounting standards, among which 30, 31, 32 is removed. Accounting standard 6 is been withdrawn. Accounting standard 8 is been withdrawn. So 6, 8, 30, 31, 32, 5 are not there. So 32 minus 5, 27 is the accounting standards that we have in force right now. But what is accounting standards? Accounting standards are written policy documents. What are they? These are issued by 3 authorities: government, expert accounting body, or other regulatory body. Whenever they issue these accounting standards, they cover the aspects of recognition, measurement, presentation, and disclosure. So remember to start with Akshay Kumar, accounting standards. Then Shah Rukh Khan are written policy documents. Cover it up with Disco Diwani, covering the aspects of recognition, measurement, presentation, disclosure. So accounting standards are written policy documents issued by government, expert accounting body, other regulatory body, covering the aspects of recognition, measurement, presentation, disclosure. Sums of the definition of the word accounting standards. In this, when I say government, I mean MCA, Ministry of Corporate Affairs. They issue accounting standards for companies. We'll learn it in inter when you come there. Expert accounting body means ICAI, Institute of Chartered Accountants of India. Institute of Chartered Accountants of India, when it issued accounting standards, the objective is to overcome the disadvantages of accounting policies. Accounting policies, we said no comparison, no standardization, no uniformity, difficulty in selection. Objectives: bringing in standardization, bringing in uniformity, bringing in comparison, bringing in reliability, and making it easy to select. See, exactly ulta of what you had there. Uniformity, comparability, standardization, reliability, ease of selection. But one thing that you need to remember is, no matter what accounting standard says, it cannot override law. And in spite of accounting standards are there, still we'll have choices. Choices will become less. If you have 4 options, AS will tell you have to pick one among 2, but still 2 options are there. So it will still be a difficulty to make choice, but number of options is definitely reduced. So this is objectives of accounting standards. We have 2 simple parts of accounting standard that needs to be discussed. Standard setting process, you can do it yourself. This is a process. Then we have the list of standards. There I go, I'll take you to accounting standard 1, disclosure of accounting policies. About 10 minutes ago, I told you something, no? Exceptions for consistency, that is covered here only. Now, with regard to accounting standard 1, disclosure of accounting policies, there are 3 things that you should remember. 1, fundamental accounting assumptions. I told you, no? In concepts and conventions, 3 things I made you mark. I told you fundamental accounting assumptions. They are the 3 things: going concern, accrual, consistency. What about it? Why is it called fundamental accounting assumptions? Very simple. Read the name very clearly once again. What does the name say? Disclosure of accounting policies. Disclosure of, what do we mean when we say disclosure of accounting policies? Whatever accounting policies the organization follows, they would have to disclose it. Whatever accounting policies an organization will follow, they would have to disclose the same. That is disclosure of accounting policies. However, if your entity is going concern, if your entity is following accrual system of accounting, if your entity has consistency in accounting policies, you don't have to make any disclosure. Disclosure is required only if it is not a going concern, there is no accrual, and there is no consistency. Against going concern, accrual and consistency, no disclosure is required. Got it? That is the reason it's called as fundamental accounting assumptions. After this, we have changes in accounting policy. This is exceptions to consistency. Consistency says no, accounting policies and practices should be consistent from one accounting period to another. Can we change them? We can change our accounting policies. We can change our accounting. That is called changes in accounting policy because of exceptions to consistency. There are three situations in which you can change: when the accounting standard is changing, when the law is asking you to change, or if the change in accounting policy is going to result in better presentation of your results. Let me repeat, when can you change your accounting policy? You can change your accounting policy in three cases: when requirement is there by law, second one, when there is change in accounting standard, or if you think such a change in accounting policy will result in better presentation of your results. Got it? Then we have considerations for selection of accounting policy. What is the consideration? How do we pick accounting policy? When we have more than one option to pick, how do we pick one among these 3-4 options that we have? That is what we mean when we say consideration. AS1 doesn't tell which accounting policy to pick. AS1 will tell what to consider if you want to pick. It says you need to be considering prudence, substance over form, and materiality. What should you be considering? Prudence, substance over form, and prudence is you need to be practical when it comes to accounting. You cannot be blindfolded, or you cannot be neutral. You cannot be inclined to one part. You should be neutral. You should not be inclined to show higher profits. You should not be inclined to show lower profits. Prudently, practically, vigilantly, professionally, you will think and then take the decision. That is prudence. Substance over form means accounting reality should be given more importance than mere legality. What should you give more importance? Reality in accounts should be given more importance than legality. You purchased one asset, agreement is signed, money is given, asset is taken, but registration is pending. Doesn't matter. Legally, the old person, the other person, seller is still the owner. You are not the owner. Why? It is not registered with the registrar, but you paid the consideration, sale deed is signed, asset is received, you have taken control, possession of the asset, you record it as your own asset and charge depreciation. Even if it is still registered legally in the other person's name. Why? We go by reality. Substance is more important than the legal form for us. Or lastly, materiality. So these are the three important considerations based on which you will recognize, you will record, or you will pick a accounting policy. This is accounting standard 1. Accounting standard 2 you will read in chapter 4. Accounting standard 10 you will read in chapter 5. Accounting standard 26, the reference is there in chapter 8. Then the last standard that you should learn is provisions. Once you do provisions, this is actually a separate unit in your material. We have only valuation principles to discuss. Once we are done with that, we'll be done with chapter 1. I'll give you a short break the moment we finish our chapter 1. It's another 5 minutes. Can I? We didn't take long, 1 hour 20 minutes for entire chapter 1. What do you mean by provision? What do you mean by contingent asset? And what do you mean by contingent liability? So here you have definitions, 3 of them: provision, contingent liability, and contingent asset. I'll break this definition down to you and then make it more simple to understand. Whenever we start understanding provision, contingent asset, contingent liability, first you need to know the meaning of the word contingency. Contingency is an event which is dependent upon happening or non-happening of one or more future events. So it is an event which is dependent upon happening or non-happening of one or more future events. So future uncertainty and uncontrollability is the consideration. For example, RCB getting qualified to playoffs was a contingent event. It can happen, but it cannot happen also. I'm not talking now. I'm talking about 1 week ago, 10 days ago. It can happen, or there was a possibility that it cannot happen also. It was in future that the decision will be coming out. And it is not in our control. Why? It is not like we will win all the games and we'll go to playoffs. We have to win, they have to lose, that match rain has to come, this match this guy has to be out. So a lot of things had to happen and everything went our way. So things were not controlled and no one was sure. No one was sure, but still one thing was very, very sure. Isala namde. Okay. So contingency is an event dependent upon happening or non-happening of one or more future uncertain and uncontrollable things. And that's how we decide contingency. You get this? This contingency, when it results, it can result in outflow. or it can result in inflow. If this contingency is resulting inflow of economic benefit, that is going to result in asset. If it is going to result in outflow of resources, we call it contingent liability. Let me repeat. If the contingent event results in inflow, it is asset. If it is going to result in outflow, it is liability. Not a normal asset or liability. It is a contingent asset or a contingent liability. Meaning it can become an asset in the future. It's not an asset right now. It can become a liability in the future. Not a liability right now. So this contingent asset and contingent liability, it should not come to balance sheet. Why? Balance sheet is for assets and liabilities. You should disclose them outside. Contingent asset and contingent liabilities should not come to balance sheet. It should be disclosed outside balance sheet. However, contingent asset should not be disclosed also. There is no need of disclosure also. Why? Prudence. What is it? Prudence. If it becomes asset, we will record. If it is not an asset, no need of disclosure also. Further, for a contingent liability, we create provision. For a contingent liability, we create contingent liability means in the future there might be outflow. Conservatism, prudence. We have to make provision. But to make provision, it should fulfill two conditions. How many conditions? Number one, there should be probable outflow. Number two, there should be reliable estimate. Meaning probably this will not go in our favor. This will go against us. We would have to lose it. Probably there's going to be outflow of resources because of this. And second one, reliably you are able to measure how much is the amount of money that's going to go. So this particular event, which is now a conspiracy, will result in contingent liability to liability. I am expecting it. And when it becomes liability, I have to pay money. And I am able to measure how much money. So when there is reliably estimate of outflow and there is a probability that it will result in outflow, then for a contingent liability, we create provision. If it is contingent liability, only disclosure. If it is a provision, then we would have to make expense in P&L account and also liability in balance sheet. Do you get it? Says something very good. See, balance sheet ali, you will not write contingent assets and liabilities. Contingent liabilities will be disclosed in footnote. Contingent asset, no disclosure required because of prudence. If you make provision for a contingent liability, that is when it fulfills two conditions. What are they? Probable outflow and reliable estimate. You will shift that contingent liabilities from footnote to P&L expense and write in balance sheet liability side. Got it? This is with regard to provisions. Then last part, Ind AS is removed from your syllabus. We can skip this part. Last part of your chapter 1 is valuation principles. What is it? At the time when you purchased the asset long ago, what you paid is historical cost. At the time you purchased the asset in the past, whatever you had paid is historical cost. Then if in case you are buying the asset today, right now, what money do you have to pay? That is called as current cost. If you sell the asset now, what money will you get? Is realizable value. If in case you will use the asset and then take the economic benefits of it to the nearest future, to the longest future possible, the total economic benefits that you get is called as present value. So there are 4 valuation principles. How many? 4. Historical cost. What is historical cost? Long ago in the past, when you bought the asset, what you paid is historical cost. Today, if in case you buy a new asset of the same type, how much should you pay? That is current cost. If in case you sell this asset, how much money do you get? Realizable value. And in the future using this asset, how much money or value are you going to generate? That is present value. Present value is the future may benefit what you get discounted to present value. So this is our valuation principles. And after discussing this valuation principles, last topic connected to valuation principles is accounting estimate. See, we did valuation principle. We can measure an asset based on historical cost, realizable value, current cost or present value. But what if all the valuation principles fail? I am not able to identify the value of an asset. Historical cost is not there, replacement price is not there, future benefit I am not able to assess, current cost I don't know. Then what do? We will record the asset at an estimated value. At what value? When do we do estimation? When we don't know the actual useful life of an asset. 10 years, 3 years, 4 years. How do you tell it? Estimate. At the end of the useful life, After 10 years, at what price can I sell this laptop? Realizable value. You can't tell anything actual. It is estimate. What is it? Very good. So that estimate is called accounting estimate. So accounting estimate, when do we do it? When we cannot measure an asset, when we cannot measure a liability based on valuation principles. When you cannot measure an asset or we cannot measure a liability based on valuation principles, then we do accounting estimate. Do you get this? Accounting estimate is being done based on two important bases. Number one, past experience. Number two, present situation. In the past, something similar had happened. From that, you gain some experience. In the present, whatever the situation you are in, you will analyze both and then arrive at accounting estimate. When you say useful life of a laptop, how many years is the useful life? 7 years, 8 years, 10 years. How do you conclude? In the past, you had a laptop. How many years was that laptop useful for? That laptop had lasted for 7 years. Okay. In the present, this laptop is better than the last laptop. Harder case. So it lasts for 1 year more than the old laptop. You analyze it to present situation and then you arrive at the answer. Last laptop, after 7 years of useful life, you sold it for 10,000 rupees. So now you bought one new laptop. What is the realizable value of this? You will check that laptop I had bought it for 50,000. I sold it for 7,000 after 10 years. This laptop I bought it for 2 lakh rupees. So when I sell it, I might get at least 30-40,000. So based on the past experience and the present situation, you will arrive at accounting estimate. What are the two important factors in accounting estimate? Past experience and present situation. Example is our depreciation, amortization, impairment loss, useful life, residual value, provision. When you say 2% provision for bad debt, 3% provision for bad debt, where did that number 2 or number 3 fall from? Estimation. It is just an estimate. Okay, that's it. By this we are successfully done with the topic of theoretical framework, which is chapter 1 of your syllabus. Ta-da! So it is about 4:52. Let's take a short break. It's not half an hour break. We'll take about 10 to 15 minutes break. We'll finish chapter 2 and then I'll give you one more. Chapter 2 and 3 and then again I'll give you one short break of 15 minutes rather than taking 1 30 minutes break. I hope that's fine with you all. So it is 4:53. Let's say 4:55. I'll give a short break of 15 minutes. See you all at 5:10. Yeah, around 6 o'clock, 6:15. We'll take another break once we finish accounting process and DRS. Hello guys, welcome back. We were discussing chapter 1. We have just finished chapter 1. Now let's continue with chapter 2, that is accounting process. Cool. When we talk about accounting process, it's the entire journey from being a transaction to be part of financial statement. So journey of a transaction from being a mere transaction to ledger to trial balance to final accounts. How is the entire journey going to be? So the journal is where we record the transaction the moment we spot it. The process of recording in journals is called as journalizing, and the order in which we record the items in journal is chronological order. This is the primary book of accounting where all the transactions are first recorded. It's also called as original book of accounts. From here, the transactions are then transferred to respective ledgers. How to pass journal entry? I don't think I would have to spend time. Should I tell how to pass journal entry? Identify the accounts involved, check whether they are increasing or decreasing. Then we should debit it, credit. I don't think I have to waste time around it. Should I? No. So then after this journalizing the transactions, then we'll go to ledger. Ledgers are called as secondary books of accounts, are also called as principal books of accounts. Once the transactions are entered in journal, from journal we post them to ledger. The process of writing the transactions in ledger are called as posting. Called ledgerizing is not the word, we call it posting. And when we write in ledger, we write them in the analytical order, not in the chronological order. Analytical is we analyze the transaction and write them in the respective ledger where they belong. Within the ledger, however, still the chronological order will be followed. At the end of the accounting period, we have two options. Should we balance the ledger or should we close the ledger by transferring it to P&L? This depends upon the type of the ledger. If the ledger that we're talking about is a real ledger, real account, or it is a personal account, these ledgers are balanced. Real accounts and personal accounts are balanced at the end of the year. That is, we write balance carried down and balance brought down in the next year. However, if the ledger that we're talking about is a nominal ledger, nominal account, then it is closed by transfer to P&L account. So, real and personal ledgers are balanced, nominal ledgers are closed by transfer to P&L account. That's what you should note when it comes to ledgers. Then let's talk about subsidiary books. Trial balance, and then I'll talk to you about trial subsidiary books later. After you prepare ledgers, each ledger will have balance. Whenever you start preparing financial statements, you need all the ledger balances. You can't keep going back to each ledger to pick the right amount of balance that you have in each ledger to prepare final accounts. So you take one place, and in this place you store all the ledger balances. Each ledger balancing figure, balance carried down or amount transferred to P&L. You write them all at one place. This summary of all the ledger accounts is called as trial balance. It is a place where you try to see if the debit credit balances are matching. So it is a trial to check whether it is balanced. And this is the primary source of information, or this is the basis what we will use to prepare financial statements. So when you start preparing balance sheet, P&L, trading and everything, you don't have to look into journal and ledger. Just keep trial balance at place and that will help. So trial balance is a statement which comprises of all the ledger balances. Why is trial balance prepared? The objective of preparation of trial balance is to check the possibility of arithmetical errors. Is there any arithmetical error? We want to check the possibility. And we want to simplify the entire preparation of financial statements. One place to go to. And it will work as summary of ledger accounts like I mentioned. Trial balance is prepared at the end of the year, or at the end of each month, or at the end of each week. When do we prepare trial balance? It doesn't matter whether it is end of the week, end of the month or end of the year. Whenever you want to prepare final accounts, you'll prepare trial balance, because to prepare final accounts you need very good trial balance. So if you are preparing financial statements quarterly, you prepare trial balance also quarterly. If you're preparing financial statements annually, then you prepare trial balance also annually. So whenever you need to prepare financial statements, then you prepare trial balance. Trial balance can be prepared under three methods. How many methods? Total method, balance method, total and balance method. Let me tell you how does total method work. Each ledger, there are some items on the debit, there are some items on the credit. You won't find balancing figure. You will not find balancing figure. Ledger will not be balanced or closed. Let's say the total on the debit side is 10, total on the credit side is 12. You don't write 2000 balancing figure. Write 10 and 12 in trial balance. That is total method. What is balance method? Debit side it is 12, credit side it is 10. You identify balancing figure of 2000 on the credit side, that you will write in trial balance. That is balance method. What is total and balance method? There will be total debit, total credit column, debit balance and credit balance column also. I'll repeat. In a ledger, on the debit side the total is 12,000, credit side the total is 10. The ledger is not balanced. Now we need to write balancing figure of 2000 and close the ledger. We will not do that. I'll write 12 debit, 10 credit in the trial balance. That is total method. If I find balancing figure of 2000 on the credit side and then write that becomes which method? Balance method. However, if I open the ledger, summary of ledger accounts, that is our trial balance, write total debit, total credit, debit balance, credit balance as column. That is called total and balance method. In a regular class, I would have shown you with example how each of the method works. But I think now we can't afford to do that in detail. Can I go to the next one? Next we have subsidiary books. What do we mean by subsidiary books? These are alternative to journals. We do this instead of journals. Why? Journals are too lengthy. For a small business where the transactions are less, we can do journals. For a very big organization where the transactions are too many, we don't want to do journals. We cannot do journals. So then we have something special, which is something which does the work like journal, but it is not journal. These are called as subsidiary books. Subsidiary books are day books. They are alternative to journals. After you enter in journals, you need to classify in ledgers, no? They're saying instead of entering it all in one book and then classifying, at the time of entry only I'll classify into various categories. That is subsidiary books. We have several subsidiary books. Subsidiary books are primary books and are alternative to journals. Why do we prepare subsidiary books? The size of the organization is big. It is difficult to write it all in one book. Now I have one book called journal. purchase entry in the same book, sale entry same book, cash entry same book, bank entry same book. In one book only one person can write. However, I will open 8 books. One book for writing only sales, one book for writing only purchase, one book for only cash, one book for all purchase return, one book for sales return, one book for bills receivable, one for sales payable, bills payable. Then what can I do? Then I can appoint 8 people. Each of them will handle one book. Then what will happen? Simultaneously 8 transactions can be recorded at once. If everything is in one book, I can record only one transaction at once. Do you get it? And when I appoint 8 people, I can divide the work among 8 people. They will become expert in the domain that they are working. And when there is some problem, I can check only that book. If there is some problem in cash transaction, I can only check cash book. If I don't do subsidiary books, I would have to check entire journals, which is actually difficult. So the advantages is it will help us divide work, it will help us get specialization and efficiency, and it will also save our time. And it will also give information like how we want and everything. Why do we prepare subsidiary books? Small business journal is suitable. For a bigger business, journal is not suitable. We need something special called as subsidiary books. How many subsidiary books do we have? Sales book, purchase book, sales return book, purchase return book, bills receivable, bills payable, cash book, petty cash book, and journal proper. What do we record in sales book? We record sale of goods on credit. If it is cash sale, we won't write. If it is credit sale but of asset, we won't write. It has to fulfill 2 conditions. Number 1, it should be credit. Number 2, it should be goods. What about purchase? Again, it has to fulfill 2 conditions. It has to be credit purchase of goods. If it is credit purchase of asset, we won't write. If it is purchase of goods but for cash, we won't write. So to write an entry in purchase book, it has to be credit and it has to be goods. To write an entry in sales book, it has to be credit and it has to be sales. If you have previously entered a transaction in sales book, that is as sale of goods. If that customer returns the goods to you, then you will write in sales return book. If previously the sale transaction is not recorded in sales book, why? Because it is cash sales. Then such sales return will not be written in sales return book. So entry is made in sales return book for credit sale of goods return. And entry is made in purchase return book for credit purchase of goods return. If it is cash purchase of goods return, will we write in purchase return book? No. What about bills receivable and bills payable? If in case you have done credit sales, you have sold goods to somebody who hasn't paid you money, they have to pay you money now. They'll give it in writing that they'll pay later. That in writing, whatever they give is bills receivable. All of that credits receivable, will write it in bills receivable. Similarly, when you have purchased goods, you owe money to somebody and you have given in writing that you have to pay the money, that is bills payable. After that comes cash book. In cash book, we write all cash transactions. In cash book, we write all cash. No mercy. Purchase, sale, sales return, purchase return, asset purchased, goods purchased, asset sold, goods sold, expense paid, income received. Doesn't matter whether it is expense or income. Doesn't matter whether it is current year expense or previous year expense. Doesn't matter whether it is purchase or sale. Doesn't matter whether it is income or expense, whether capital or revenue. The moment it is affecting cash, we write it in cash book. Then petty cash book. It is like younger brother of cash book. All the petty small transactions will be written in petty cash book. The reason is the cash book where we will write all the big and important transactions cannot be the place where we write petty transactions. So under impressed system, we open petty cash book, wherein some money is assigned by the main cashier to petty cash. He will make all the small payments from that petty cash. If there is excess remaining in petty cash, it will be transferred to main cash. If the money in petty cash is over, from main cash money will be transferred, which will be utilized for the purpose of petty cash. Got it? Finally, we have journal proper. Journal proper is a place where we record all transactions which are non-cash, which are non-goods, which basically doesn't affect any of these above items, which doesn't go in any of this 1, 2, 3, 4, 5, 6, 7, 8, will go in 9. It's a residuary book. What is it? Final place where things will appear which cannot go anywhere else. That's our subsidiary books topic. And in subsidiary books preparation, whenever the question is given, they might give some transactions which are cash. They'll ask you to prepare purchase book, they'll give 4 transactions. One of it might be cash. So be cautious. If it is cash, don't write it. Or they might say it's an electrical business. They'll say furniture purchased. It is asset purchased. We should not write. And if in case they give normal credit purchase transaction, there will be adjustments based on trade discount. So remember, trade discount should be deducted. Trade discount should be deducted from the price and then written. GST is not there, freight is usually not there. If freight is there, first to deduct trade discount, then add freight. First to deduct the trade discount, then add freight. Sir, what if there is GST? First to deduct trade discount, then add GST, then add freight. Remember the order: trade discount, GST, freight. Trade discount, GST, freight. Trade discount we should deduct, GST we will add, freight we will add. Don't add GST on freight. Got it? That's with regard to all of these things. And once we are done with this, we need to have special notice towards our cash book. Can I spend a little time on cash book? Okay. Cash book can be prepared under multiple methods. How many methods? One is simple cash book, where only one column is there. Other one is double column cash book, wherein there will be two columns. What are those two columns? Those two columns can be cash and discount, can be bank and discount, can be cash and bank. There is nothing like two column cash book means cash and discount. Two column cash book means two columns. Which two columns? Can be any two. It can be cash and discount, it can be bank and discount, or it can be cash and bank. Three column cash book means cash, bank, discount. All the three will be there. In the preparation of cash book, remember, if there is a contra entry which affects bank and cash, amount deposited with bank, amount withdrawn from bank, it will appear in both the sides of same cash book. Then in the ledger folio column, you have to write alphabet C. If it is receipt in bank column, it will be payment in cash column. If it is receipt in cash column, payment will be in bank column. So be little cautious on this. And whenever you do cash book, another point to remember, checks received will be first treated as cash received. Later when the check is deposited into bank, then you will write it in the bank column. I'll repeat, whenever checks are received, it will be first treated as cash received. You will write it in the cash column on the receipt side. Then when the check is deposited into bank, you will reverse it by writing that amount in the cash column on the payment side and bank column on the debit side. I'll repeat, when the cash is received, you write in cash column. When the money is received through bank, you should write in bank column on the debit side. If the money received is in the form of check, you will not write in cash, you will not write in bank column, you will first write it in cash column. When the check is deposited, you will reverse this cash column debit by writing cash column credit. And again you will write in the bank column debit side. So you will straight away won't increase your bank balance. First you will increase your cash balance, and later when it is deposited into bank, then you will reduce your cash and increase your bank balance. Are you getting it? Always do this. Even if the check is deposited on the same day, for the sake of they being telling us to do this, you do it. Okay, it will take one line extra, 1 minute extra, not 3 months, 4 months extra time. So finish it in 1 minute. Clear? Yes or no? That's with regard to our accounting process. Now, I would want you to understand the concept of rectification of errors. But before I go to rectification, a quick time on little bit on our GST part. Shall I? Very good. Come on. Let me do little bit on GST part. Because this has been little bothering to students, I thought I'll touch on GST. Till now, there was no questions on GST. But this time they've added little on GST. That too not in your normal accounting. They've added it in final accounts. Because they've added in final accounts, people try to learn straight away in final accounts, which is difficult. You have to first learn journal entry, then you will go there. Shall I teach you the journal entry when the GST is involved? Yes or no? There is a question on this in our recent RTP also. In our recent RTP also, journal entries, there is one question and they've asked you to pass entry involving GST. Now, let us say sale. I'll tell the transaction and later we'll pass the journal entry. Sold goods for rupees 10,000 and GST on which SGST and CGST is charged at 5%. This is the question. Now, what is the journal entry? Let's say the cash is received. Usually, what is the journal entry we'll write? We'll write cash account debit. Am I right? We'll write cash account debit. to sales account. How much is cash? 10,000. How much is sales? This is what we write as an entry. Now, whenever there is a sale, someone would have made profit. The person who makes profit needs to pay income tax on that profit. That is direct tax. Government has another way of collecting tax called as indirect tax. Indirect tax means the incidence and impact is not on the same person. Direct tax, incidence and impact is on the same person. You earn income, you earn profit, you pay tax, direct tax. You earn income, you pay tax. What is it? Direct tax. Indirect tax means what? You purchase goods from me. I will collect tax from you and I will pay to government. Incidence is on me, impact is on you. I would have sold the goods to you at 10,000. I will charge GST to you 10% on 10,000. 1,000 rupees I'll collect from you. Impact is on you. Am I right? You will pay that 11,000 rupees to me, including 1,000 rupees tax. But I will pay that 1,000 to government. So incidence and impact is on two different people. That is called as indirect tax. A form of indirect tax what we have is called as GST, goods and service tax. Now you and me, we are sellers, we are our traders. So we write the journal entry, cash account debit to sales 10,000, 10,000 when we collect 10,000 for sale of goods. Government is telling whenever you sell goods worth 10,000, you collect 1,000 on my behalf. That person has money to buy goods worth 10,000, he also has money to pay me. So you should collect how much? You should not collect 10,000, you should collect 11,000. Sir, how did we get 11,000? 5% SGST, 5% CGST. Together 10%. 10% of 10,000. 10,000 plus 10,000 into 10%. This is what you collect. 10,000 into 10% is how much? 1,000. You collect it along with 10, it becomes 11. Cash account debit 11. To sales account 10,000. Did you sell the goods for 10 or 11? 10. But you collected 11. What is this 1,000 extra that you collected? GST. Can you keep it with you? You should pay to government. You should pay to government. So this is called output. What is it called? You need to pay to government. It's called as output SGST. And similarly, we'll have something called as output CGST. How much is output SGST? How much is output CGST? 5,000. Sorry. Oh, sorry. How did you get this? 10,000 into 5%. And this SGST, CGST, whatever you collected, you should pay to government. You should pay to, what is the entry to pay to government? Same thing, output SGST account debit output CGST account debit to cash account. So this is for payment of the tax that you collected from the customer to government. Did you all get this? You should write this entry when you pay, but not for each entry. Now you sold 500 worth, you collected 500 worth of SGST, CGST. It's not like immediately you pay. You make the sales for the entire month. At the end of the month, you total GST what you collected, you pay. You don't have to pay transaction wise. You will pay in lump sum. Are you getting it? This is without the concept of input tax credit. Here comes the concept of input tax credit. What is input tax credit? See, whenever you sold goods, it means that you had purchased the goods. When you sell the goods, it means that you had purchased the goods. Let's say when you purchased these goods, what is the entry you had passed? Purchased goods. Let's say you didn't buy it for 10,000 rupees. You bought goods for 8,000 rupees. How much did you buy the goods for? And you also would have paid GST. Tell me what is the entry when you purchase the goods? Purchase account debit. How much did you purchase for? 8,000. I'll write here to cash account. How much did you pay cash? Did you understand this entry? Like you collected 500 extra here towards GST. The person who sold the goods to you, he also would have collected 5% on 8,000 extra from you. You end up paying him. So cash account will not be 8,000. Cash will be how much? 8,000 plus 8,000 into, you pay 5% two times. So you paid 10%. How much had you paid? You pay 8,800. So purchase is 8,000. What is the difference of 800? Here I called it output SGST, output CGST, no? Here this is called as input SGST and input CGST. How much is each of them? 8,000 into 5% and 8,000 into 5%. Can I say it is 400, 400? Do you guys get this? Tell me if you have any trouble in understanding this transaction so far. So when you sold the goods, you collected GST. When you purchased the goods, you paid GST. Now, whenever you are going to pay this 500,000 to government will tell you have an option of input tax credit. What do they say? Input tax credit. What do we mean when we say input tax credit? Government says, when you purchase the goods, already you have paid me 800. Like, I didn't pay the government, I paid to the person who sold the goods to me. He has paid to the government 800 rupees on my behalf. Am I right? So now when I collect 1,000 rupees from government, I don't have to pay 1,000 rupees to government. When I collect 1,000 rupees on sale, I don't have to pay 1,000 rupees to government. I will adjust it and pay only. Here I have collected 1,000. I have already paid 800. I will pay how much to government? Only 200. That 800 what I adjusted is called as input tax credit. Did you all get it? Let me explain how it works. Now here, output SGST. Okay, output SGST is how much? 500. Output CGST is how much? 500. Correct. Then we have input SGST, input CGST. Input is how much? 400. After you adjust, SGST payable is how much? 500 minus 400. You need to pay 100. How much is CGST payable? 500 minus 400. How much should you pay? 100. So this is the concept that I want you to know. This is the concept which is new, which was not there in your syllabus all these years, which has been newly added. And I'll show you how the impact of this will be there in the financial statements also. Done. So when you pay that 100, what is the entry? Think and tell me what is the entry? SGST payable. No. We have input and output. These ledgers have to be adjusted. Your output SGST, output CGST is credited. I will debit it. I'll write output SGST account debit, output CGST account debit to input SGST account to input CGST account. In the first entry, we have credited output SGST and CGST. Why have we credited? It is a liability. We have collected it on behalf of the government and we have to pay. I am paying it now, so I will debit it. Here, we have paid, so we have the right to recover that money from the government. So it is our asset. So I have debited it. I will credit this now. I am taking the benefit of this. 400, 400. There is difference. Here debit 1,000. Here credit 800. Difference is 200. What will this be? Yeah, bank account or cash. That's it. Did you all get this? This concept of adjusting this input with output is there, no? That is called as input tax credit. What is it called as? What we did now, no, set off that 500, 400. That you learn in GST in inter. Not even in the first 2-3 days. You learn it towards the end. That adjustment. But sad and unfortunate, they have given it at foundation level only. No problem. We will do. They have given it to us to do. So what will we do? We will do. We can't complain. GST, not even in the initial days you learn. You learn it later in GST. But did you understand this? What you need to remember is, in the trial balance, they'll give this output SGST as credit item. And in the same trial balance, they'll give you this input CGST as debit item. So we'll adjust them and then pay. Adjust them and then pay. There's one more thing that will be there. That is called as, I'll tell, IGST. That is for interstate transactions. How to deal with that? I'll teach that to you tomorrow. Where is it there? It's there in final accounts. When you do final accounts topic tomorrow, I will teach. I'll also show you that RTP question on this. See, in your RTP, there is one question. Based on this output GST, there is one journal entry. So, I'll tell you the question. Question 3A in your RTP has GST adjustment. So, please do that question today and come. Okay. On 8th April, there is some sale regarding which there is one GST transaction. And again on 10th April, there is one transaction. Again on that, there is GST adjustment. And on 19th April, there is one GST adjustment. So GST adjustment is there in that question. Please do that question before you come to tomorrow's class. Will you do that? RTP. And I've taught this to you. This concept, what I just taught, is more than sufficient for you to understand this portion. So this, if you want, I can share one small screenshot or small PDF of this topic to you people. Whatever I just discussed on GST. This. Yeah, or you can watch the video. It is around 1 hour 58 minutes in the video length. Or note the time, 6 o'clock. If you have doubt, around 6 o'clock, 6:10, we have discussed this concept. So please brush this concept. And in RTP, you do 2 topics. One on journal and other one is on final accounts. Final accounts part, I will do in the class tomorrow when I do final accounts question. If I forget, you remind me. Understood this? Yes or no? Very good. Can we now go to the topic of rectification of errors? Shall we? Very good. You want me to send this at the end of the class today? I'll put it in one separate sheet. I'll share it. I'll share this file with you all later at the end of the day. Soft copy. Don't worry. I put everything that I should share it to you people in one page. I'll share it once for all in PDF format. Wherever you want it. Sir, I want hard copy. Hard to give. Can't give. Can we do rectification of errors now? Shall we? We'll do a quick revision of entire rectification and then we'll understand what complications can be there. I'll tell you a couple of things where people usually get wrong with regard to rectification. Okay. All good? People watching it on YouTube, is everything fine? Audio, video, give me a small confirmation if you can hear everything clearly. Speed. Space. Speed ಜಾಸ್ತಿ ಆಯ್ತಾ? Base ಜಾಸ್ತಿ ಇದೆಯಾ? ಎಲ್ಲಿ mic ಅಲ್ಲ. Mic I can't change. It's a big controller. I can only do this. Okay na? ಕೇಳಿಸ್ತಾನೆ ಇಲ್ವಾ? Now, CSK, not in my control. There are too many things for me to adjust. I'll get it checked. Don't worry. Errors. Errors are common. Errors do happen. Errors are not intentional. Only thing that we can do is not crib about those errors, but try to correct those errors. When we correct the errors, we'll get the correct financial results. If we don't correct the errors, Because of errors, our financial results will be incorrect. Based on that, the decision that we take will also be incorrect. Got it? So the errors which are unintentional mistakes can be classified into two: non-clerical and clerical. Non-clerical means what? It doesn't matter whether it is computerized or what to say, manual accounting. These errors will still happen. These are called as principal errors. What are these called as? Not principal, it is principal errors. What do you mean by principal errors? You have not followed accounting principle correctly. You have not followed accounting principle correctly. You recorded a what do you say, capital transaction as revenue, or you recorded a revenue transaction as capital. You purchased asset, you wrote it in purchase book, or you purchased goods, you wrote it to asset. You got repairs done for furniture, you should debit repair account, you debited furniture account. So these are what errors? Principal errors. And when you do these principal errors, no, your balance sheet will still tally, your trial balance will still tally, but these are continuing to be errors. These are two-sided errors. This is where you treated a capital item as revenue item or a revenue item as capital item. Example, read the example. Asset purchased, wrongly recorded in, or repair expense debited to asset account. Do you get it? Then we'll go to clerical errors. Clerical errors can be error of omission, error of commission, or compensating error. To start with error of omission. Omission means what? Not doing what is supposed to be done. Not writing the entry what you're supposed to write. Further classification of these errors of omission can be made into complete omission and partial omission. What do you mean by complete omission? We have not written debit, we have not written credit, full transaction, palak paneer, whack. You have not written the complete transaction. What is it? Error of complete omission. Transaction is not recorded in journal, not posted to ledger, not written in trial balance, nowhere. There is no trace of that ledger only. You get it? That is complete omission. Doesn't matter what transaction is it. You have not recorded any part of the transaction. Because of this, trial balance will not tally ಅನ್ನೋ situation ಬರೋದಿಲ್ಲ. Trial balance will tally in spite of this complete omission. Why? You have not written debit, not written credit. Not written debit, not written credit. Trial balance will still tally. However, what do you mean by error of partial omission? Partial omission is where transaction is recorded but not completely. We recorded debit aspect of transaction but didn't record the credit aspect. Or we recorded the credit aspect but we didn't write the debit aspect. We recorded the entry in purchase book, we didn't write it in creditor's book. We wrote it in creditor's book but we didn't write it in purchase account. We wrote the entry in sales book, forgot to post it to debtor's account. One side correct, one more side wrong. You get it? That is error of partial omission. Because of this, trial balance will disagree. Trial balance it will not tally if there is errors of partial omission. Then we have error of commission. What is error of commission? You have recorded the transaction. Have you recorded the transaction? Yes. Have you recorded at correct amount? No. You have recorded the transaction at wrong amount. At wrong amount. Or amount is correct, account is wrong. Amount is correct, account is wrong. So when you record a transaction either in the wrong account or at the wrong amount or it is wrongly balanced, that is what we call as error of commission. What is it? Transaction entered at wrong amount or in wrong account or wrongly balanced. Clear? Goods purchased from Dolu. We wrote it wrongly in Bolu account. Purchase is 4,500. You recorded it 5,400. This is error of commission. Lastly, we have compensating error. What is compensating error? It is not one error. It is two errors. How many errors? When you do two errors, no. First error will eat away the impact of the second error or it has nullified the impact of second error. Because of which now there are two errors. But we won't even identify. Why? The amounts are also wrong. When cash is received, we should debit cash. We wrongly credited cash. When cash is paid, we should credit cash. You thought when I received cash, I credited it. So when I pay cash, I should debit it. Now you will debit. Now we did two errors. Let us say first error is 100 rupees. Second error is 90 rupees. Difference will be 10. We won't be able to find. We will be searching 190, but the error is 10. You get what? We will be searching 10, but the error is in 190. So it is actually very difficult to find compensating errors. because one error has nullified the impact of another error to an extent. So what is compensating error? Like I mentioned, one error has cancelled out or reduced the impact of another error. And again, this is not a self-revealing error. Trial balance will tally in spite of this error. Even after doing compensating, our trial balance will still tally. We won't be able to find any mistakes. So that's compensating error. Did you all understand compensating error? Very good. Now, like I just mentioned, impact of errors on trial balance, one-sided and two-sided. If it is one-sided error, because of this, our trial balance will not tally. Our trial balance will not tally. If there is a two-sided error on the other hand, in spite of this, our trial balance will tally. I'll tell the error. You tell me whether it is one-sided or two-sided. I already told it to you. Shall we start? Principal error. One-sided, two-sided? Two-sided. In spite of principal error, trial balance will still tally. Come on, you have one more chance. Error of complete omission. Two-sided. Error of partial omission. One-sided. Error of commission. Can be one-sided, can be two-sided. We don't know. See, when they do that mistake, no, error of commission, they can do on one side or they can do on both sides. So that can be either ways. What about compensating error? Usually two-sided error. So what are one-sided errors? Error of partial omission, and it can be commission error. However, what are two-sided errors? Principal errors, complete omission, commission, and compensating error. Did you all get it? Akka. Fantastic. So what I want you to know after this is, in order to rectify the error, we need to identify the error. Let me repeat. In order to rectify the error, we need to identify the error. At what stage have we identified the error is the decisive factor for rectification. If we identify the error at initial stage, we'll scratch and rewrite. This is time pass. We don't have stage 0. If we identify the error before preparation of trial balance, if we identify the error before preparation of trial balance, then we should check whether that error is one-sided error or two-sided error. If it is one-sided error, we only do adjustment. We cannot pass journal entry. However, if that error identified before trial balance is two-sided error, then we can surely pass journal entry. Then we'll check whether if the error is identified after trial balance. Then what happens? When I prepare trial balance will not tally. Am I right? When I prepare trial balance and there is an error, trial balance will not tally. Whenever trial balance doesn't tally, I would have written that money in suspense. When I kept the money in suspense, then for one-sided error also, I will pass journal entry with suspense account. I'll pass journal entry with suspense account. However, if it is two-sided, anyways we pass journal entry. We won't even need suspense account. Let's take an example. For example, you left your water bottle in the class and then you left. Before I close the classroom, I saw it. I will give it to you. Adjustment. We both only will deal with it. However, you didn't come back to take the water bottle. Classroom is about to be closed. Office boy will take the water bottle and then keep it in the office. You have to go collect your water bottle from the office. This is what we say trial balance. Before the trial balance is closed, if you identify your error, I will rectify, we will adjust it. There is no need of journal entry. You get it? You don't have to show your ID card. You don't have to say that this bottle belongs to you. You don't have to show the picture of water bottle. I'll take the water bottle and go. Adjustment. Am I right? However, if the trial balance is already closed, water bottle would have gone to office. Then they'll say, what is the proof that that bottle belongs to you? You have to show them your ID card saying that you are the student here. You should prove that the bottle is yours, then take it. So basically their journal entry is required. Just a random example which spotted just now. Don't look at me like that and judge. So if the error is before trial balance, one-sided adjustment, two-sided journal entry. If the error is after trial balance, one-sided journal entry with suspense, two-sided journal entry. If it is after final accounts, again we do the same thing. One-sided means journal entry with suspense, two-sided is journal entry without suspense. Sir, stage 2, stage 3 look same. Are they same? They are same but different. What is the difference there? If in case we are doing rectification at stage 2, no, after trial balance, no problem. Seek the account, whichever account you want, you can debit credit. However, if you are doing rectification at stage 3, that is after final accounts, you know what should you keep in mind? If the error rectification involves a nominal account, If the error rectification involves a nominal account, such a nominal account cannot be debited or credited. You cannot debit or credit such nominal account. Why? Very simple. If you debit or credit that nominal account, that will not affect previous year. That will affect current year. It is like yesterday you forgot to put sugar to your coffee. Today will you put 2 spoons extra? No. A sakare coffee pudi agate. You get it? It won't be nice. Today's coffee, yesterday's coffee anyway got spoiled. Today's coffee also will get spoiled. So last year purchases was recorded incorrectly. Are you getting it? This year you realized it. If you rectify by using purchase account, current year purchase will become wrong, current year GP will become wrong, current year NP will become wrong. So at stage 3 rectification, after final accounts, when you are rectifying, if you find an item which is nominal in nature, what in nature? Then what do? You cannot use such nominal account. You will replace that nominal account with what? Profit and loss adjustment account. What will you replace it with? Profit and loss adjustment account. Did you all get this? Pakka? Very good. So by this we are done with how to do rectification and how to pass all of these rectification entries. Steps to pass a rectification entry. First, identify the wrong entry, then reverse the wrong entry, then think of the correct entry. Rectification entry will be reversal of the wrong entry plus the correct entry. Reversal of the wrong entry plus the correct entry. That will be the rectification entry that we should pass. You got it? Overview of rectification of errors is done. If you are interested, I'll take our RTP question and then show that to you with the help of the RTP question. Is that fine? Shall we see our recent attempt RTP? Come on. ICI.org. We are going to students. I am opening BOS knowledge portal. In our BOS knowledge portal, let us go to previous year question papers. Allah, yours is the first attempt under new scheme, revision test paper, and then I'll go to foundation accounting. Rectification of errors question. Shall we see this rectification of errors question? Beta Chemical Labs are unable to agree the trial balance as on 31st March. So what has happened? It is not stage 1. It is not before trial balance. Trial balance is done. Sir, is it stage 2? It can be stage 3 also. How will we get to know if it is stage 3? If they tell that these errors are identified in the next year, it will become stage 3. If they don't tell that the errors are identified in next year, if they say errors are identified before preparation of final accounts, it is stage 2. What is the difference between stage 2 and stage 3? Stage 2, I will continue to use nominal accounts. Stage 3, I'll replace nominal accounts with P&L adjustment account. Am I right? Come on, let us see this. And I've raised the suspense account for the difference. Very good. They've done this correctly. If they would have not done this correctly, if they would have not raised the difference and written it to suspense, some questions they will tell in the question, it's there in our study material also. The trial balance did not tally, the difference was posted to P&L account. When the trial balance doesn't tally, where should you write the difference? Suspense. If they wrongly write it to P&L, you know what will happen? Whenever we write rectification entry, usually wherever you use suspense, no, their suspense will get cleared. I'll tell you once again, listen. Trial balance doesn't tally. There is difference. You write it to suspense. When you pass rectification entry, every time you debit suspense or credit suspense, suspense balance is getting cleared. Suspense balance is getting cleared. If you have created suspense in trial balance, when you pass rectification, suspense will get cleared. If you don't create suspense, you transfer the difference to P&L. Every time you pass rectification entry, you are creating suspense. Are you getting it? Cash account debit to sales is the entry that we should write. We didn't write cash account debit. We wrote only to sales account. Trial balance won't tally. Am I right? Cash debit is not written. So we'll write suspense debit 10,000 in trial balance. Am I right? Say something. When you pass rectification entry, you will write cash account debit to suspense. Cash account was supposed to be debited, not debited. We will debit cash account now and credit suspense. Am I right? Yes or no? When you write cash account debit to suspense, suspense 10,000 credit, will clear the suspense debit in trial balance. This is because you created suspense. What if by mistake they had written the difference to P&L? Our profit is wrong. Our profit is wrong because of that error. That profit has gone to capital. Now this year when we identify the error, wherever we use suspense, no? That suspense should be closed by transfer to capital. That suspense should be closed by transfer to, I'll repeat the entire thing what I just told to you now. Whenever trial balance doesn't tally, where should we write it? If they have written suspense, very good, no problem, all fantastic. What if they have not written the balance to suspense and instead they have written the balance to P&L? Then we'll close our suspense account and transfer the balance to capital. Usually, do we close our suspense ledgers? Suspense, we'll write journal entry, leave it like that. If in the question they've told that difference in trial balance is closed by transfer to P&L, suspense account also will be closed by transfer to P&L at the end. There is a question on this in your study material. Please go through that question once. If you don't recall this, you remind me tomorrow. I'll show you that question as to what it is. Okay. Come on. Beta Chemical Labs were unable to agree the trial balance and they have transferred it to suspense. Very good. They have done a good job. Next year, the following errors were discovered. When is the errors discovered? So this is stage 3 rectification. This is stage 3 rectifications. Errors are identified after final accounts. Can we see the errors? First one. Repairs made during the year were wrongly debited to building. Principal error. They should have debited which account? Repairs. Because the expenditure is incurred for repairs, they should have debited repairs. Have they debited repairs? What have they debited? Building. They should have debited repairs. What have they debited? Building. So building is wrongly debited. We should have not debited buildings, but we have debited buildings. So building account which was wrongly debited will be now credited. Building account which was wrongly debited will be now credited. Error. Commission error. Using the wrong account. Okay. So we have wrongly debited building. So I will credit building. I should have debited repairs. Have I debited repairs? So what will be the rectification entry? Repairs which was supposed to be debited was not debited. So I will debit repairs. Building what was supposed to be not debited was debited. So I will credit building. Journal entry will be repairs account debit to. Very good. Repairs account debit to. This should have been the entry at stage 2. Because this is stage 3, I cannot use repairs account. Repairs will be replaced with P&L. Entry will be P&L adjustment account debit to. I will show the answer to you. See here. Repairs account debit to building will be entry. Because this is after final accounts, I will replace repairs with P&L adjustment account 12,500. Everyone got it? What is after this? Read the next one. Addition of freight column in purchase journal was short by 15,000. When you total the freight column, you total less by 15,000. You totaled 1 lakh. The total should have been 1 lakh. You wrote 85. You have decreased the total by how much? 15. If you have decreased the total by 15, freight when you write journal entry, you written less by 15. So what should you do? Write the entry for that 15. Freight is expense or income? Freight is expense. Expense. We should debit it. Freight account debit to suspense. Don't write cash. It is paid correctly. Cash account correct agide. Freight total is shortage. So freight of 10,000, freight of 15,000 which was supposed to be debited is not debited. So now I'll debit freight account debit 15,000 to suspense account 15,000. Entry is freight account debit to suspense. But this is rectification at stage 3. I cannot debit freight. I'll replace freight with P&L adjustment. Entry will be freight to suspense, which will be now replaced to P&L adjustment to suspense. Got it, everyone? Say something. Very nice. Goods to the value 4,500 returned by a customer. Shiv1 company. So this is actually sales return. I have sold the goods for 4,500 and my customer is returning the goods back to me. What is this? Sales return. Don't read the rest of the question. Read the question in pieces. Tell me what is the journal entry for sales return. Sales return account debit to Shiv1 company. I should have written the entry sales return account debit to Shiv1 company. But what have I written? Had been posted to the debit of Shiv1 company. You should write sales return account debit to Shiv. Shiv should be credited. I have debited. Now I should credit Shiv by double the amount. Why? I should have not debited. I have debited. To reverse the debit, I'll credit once. I should credit it. I have not credited. No, I'll credit it once again. I should credit it with double the amount. For example, Mr. Shiv is there. No, I am supposed to give him 4,500. I am supposed to give him. Why? He gave the goods back to me. He purchased the goods from me. He gave the goods back to me. I should give him 4,500 back. No, I say I don't have cash. He returned the goods to me. I told give me 4,500. He's like, why should I get it? Give, I'll tell you. And I took 4,500 from him. No, I should give him how much? Why? I should return this 4,500 what I've collected, and I should also give 4,500 what I'm supposed to give. I cannot say no. 4,500 I'll give. Take. He'll be like, okay. Where is 4,500? I gave no. Hey, but I returned the goods. That only I'm giving money. No, I gave 4,500. See, what 4,500 you gave, I returned, and I gave you 4,500 for goods returned also. Hey, ಒಂದೇ 4,500 ಇದೆ ಅಂತ ಹೇಳಿದ್ರೆ ಒಂದೇ ಇದೆ ಅಲ್ವಾ, ಇನ್ನೊಂದು 4,500 ಕೊಡ್ಬೇಕಲ್ವಾ? Are you understanding the frustration of Shiv here? Journal entry is sales return account debit to Shiv and company. We should have credited Shiv and company. We have not credited. We will credit now. We had wrongly debited. That debit reversal also will credit. So to Shiv and company 9,000. How much? 4,500 plus 4,500 9,000. Everyone understood? Next, and also sales return. Also sales return andre sales return is also debited. Shiv and company is also debited. What is the correct entry? Sales return account debit to Shiv and company. What have we written? Sales return account debit, Shiv and company account debit. So meaning sales return was supposed to be debited. Sales return is correctly debited. There is no error in sales return. Shiv and company should not have been debited. It is wrongly debited. So I will now credit it. Pakka? Say something. That's it. Journal entry is suspense account debit to Shiv and company, but 9,000. How much is the amount? Everyone got it? Say something. Fantastic. Third one is over. Then come, let's go to fourth one. Sundry items of furniture sold for rupees 30,000. What price did we sell it for? 30,000. Had been entered in sales book. Oh, it is furniture sold. What did we sell? Furniture. Furniture asset. Where have we written? Sales book. When we sell furniture, it should be written in furniture account. Entry should be cash account debit to furniture. They have written cash account debit to sales account. It has been posted in sales account. So what is the correct entry? Cash to furniture. What is the entry written? Cash to sales. Furniture should have been credited. Sales is credited in that place. Sales which should not be credited is credited. So sales will be debited. Furniture which should be credited is not credited. Credit now. Journal entry. Sales account debit to. Very good. Sales account debit to. Sales account debit to furniture. But this is rectification after final accounts. So I cannot debit sales. In the place of sales, I'll replace it with profit and loss adjustment. In the place of sales, I'll replace it with profit and loss adjustment account. Did everyone get it? Very nice. After fourth one, come to fifth one. A bill of exchange received from Messer Swapna. No, not Swapna. Sapna. For rupees 75,000 has been returned by bank as dishonored. Oh my God. I have received one bill of exchange from Sapna. For that journal entry, bills receivable account debit to Sapna. I discounted it with banker. Journal entry, bank account debit, discount account debit to bills receivable. Bank will give me money, bank account debit. Bank will cut discount. My expense, discount account debit. Bill is going out, to bills receivable credit. Journal entry, bank account debit, discount account debit to bills receivable. Done. This bill is dishonored. Means what? Bank went to Sapna. Sapna told, oh, well, hey, I won't give money. So now bank came back to me, asking me for money. Why? Bank doesn't know Sapna. I gave the bill to bank and asked bank to collect money from Sapna. Oh, Sapna doesn't pay, bank will come to me. When the bank comes to me, bank will throw the bill on my face. Then I should pay full money. Correct or not? When the bank gives the bill back to me, what is the entry that I should write? Bills receivable account debit, because the bank is giving me bill. Full money to bank. Bills receivable account debit to bank. How much? Full 75,000. Will I keep this bill with me? Then what do you say? I will give it to Sapna and collect money from Sapna. Am I right? So first, when the bill is received, what is the entry? Small revision of bills of exchange is also happening here only. What is the entry when I receive the bill? Bills receivable account debit to Sapna. Bill is received from Sapna. What is the entry? Bills receivable account debit to Sapna. I give it to bank and discount it. Bank account debit, discount received account, discounting charges account debit to bills receivable. Done. I have received the money. Now what will I do with this? What will banker do? Go to Sapna. If Sapna doesn't pay money, banker will give the bill back to me and I will give the money to bank. When I give money to bank, what is the entry? Bills receivable account debit to bank. After banker gives the bill back to me, I should give the bill back to Sapna. When I give the bill back to Sapna, what is the entry that I should pass? Sapna account debit to bills receivable. Got it? They have done everything. They didn't write this entry to Sapna. See this? Bill of exchange received from Sapna for rupees 75,000 had been entered by the bank as dishonored and had been credited to bank and debited to bills receivable. So meaning bank atra bill is kondu, giving money to bank, entry they have written. Giving it to Sapna, entry they have not written. What is the entry that you should write? Sapna account debit to, that's it. Sapna account debit to bills receivable. That's it. Should we replace bills receivable or Sapna with P&L adjustment? No. They are not nominal accounts. It will remain like that only. Understood this? Everyone. One last point that I want you to remember is whenever you do this rectification after final accounts, we write no new account here. P&L adjustment, P&L adjustment, P&L adjustment. We should total the P&L adjustment and post it to capital. How do we do it? Take all the debits at one place, credits at one place. Debit 12,500. Debit 15,000. So debit 27,500. Debits ಎಲ್ಲ add ಮಾಡಿ, credits ಎಲ್ಲ minus ಮಾಡಿ. Debit 12,500 plus debit 15,000. Will become debit 27,500. Here there is no debit credit. Here there is debit of 30,000. Add further 30,000. 57,500. Here we don't have anything. So how much is the total? 57,000 debit no in your calculator. You should close that balance. How do we close it? You should do minus 57. Debit plus credit minus. So I will credit P&L adjustment account 57,000 and debit capital. So what is the entry? Capital account debit to profit and loss adjustment account 57,500. 57,500. This is the entry. Did you understand this? Couple of adjustments will become little tricky when they use certain words like general ledger and then general ledger, sales ledger and then purchase ledger. This is one tricky name that they use. This is one thing what usually students ask a lot of doubts. I am telling other than this question. So remember, whenever they say there is a sale transaction correctly entered in sales ledger but not entered in general ledger. What do they mean? When they say sales ledger, it means debtors account. When they say purchase ledger, it means creditors account. I am not talking about debtors, sales account alla, sales ledger. They use the word sales ledger, purchase ledger, general ledger. These three are the concepts of self-balancing ledgers, which is a chapter which was there in CA IPCC long ago, and that got removed when now syllabus you're reading, no? Before that there was one syllabus was there, no? Before that one syllabus was there. Adralittu, self-balancing ledger. Under manual system of accounting that is there. So that topic is removed. Very nice topic. I used to love teaching that topic, but it's removed now. In a manual accounting, that's a savior, but now not required. So it's called as self-balancing ledgers. What is it called? Sales ledger, purchase ledger, general ledger. Sales ledger means debtors account. Purchase ledger means creditors account. General ledger is anything other than debtors and creditors. Bad debts is been correctly recorded in sales ledger but not posted to general ledger. I'll repeat. Bad debts has been correctly recorded in sales ledger but not posted to general ledger. What does that mean? What is the journal entry for bad debts? Bad debts account debit to debtors. Bad debts account debit to, bad debt is general ledger. Debtors account is sales ledger. It's been correctly written in sales ledger, not posted to general ledger means they have not written bad debts account debit, should debit bad debts account. Understood this? And sometimes second kind of tricky question that will come is they'll tell sales of rupees 10,000, sales of rupees 10,000 what not was correctly recorded in the sales book but not posted to ledger. I'll repeat. Sales of rupees 10,000 was correctly recorded in sales book but not posted to ledger. Not posted to ledger means, is it sales account or is it debtors account? Debtors account. Why? Sales account will include only total of sales book. I'll tell you the same statement in two ways. In one place the error is in sales book, in sales account. In one place the error is in debtors account. I'll tell. Credit sales of 10,000 was entered in sales book. Credit sales of rupees 10,000 was entered in sales book but was not posted to the ledger. The error is in sales account. Why? To the ledger. Sales book total will go to sales account. Individual transactions in sales book will go to debtors account. Let me repeat. Total of sales book will go to sales account. Individual transactions will go to debtors account. When they say the means, it is sales account. When they just say to ledger, it is debtors account. And if they use the word total, sales entry was correctly recorded in sales book but total was not posted. Total was incorrectly posted. Total will go to sales account. So the error is in sales account. If they talk about individual transaction, it is error in debtors account. This question is again there in our study material. So when you go through that, you will find this one error. So I'll tell you how to spot the error. If they tell entered in sales book but not posted to ledger, error, sales or debtors? Sales or, am I talking too fast? Error is, sales is correctly recorded in sales book but not posted to ledger. Debtors, not posted to the ledger. Sales is correctly recorded in sales book, total is incorrectly posted. Sales, total will go to sales account, total will not go to debtors account. Understood that part? Very good. So by this we are done with the concept of rectification of errors. Rest everything you guys try it by yourself. If in case you guys have any doubt, you can surely come back to me. And we have not just finished rectification of errors, we have also finished the topic of accounting process. Can we start with bank reconciliation statement? Okay guys, come on, let's now do chapter 3, bank reconciliation statement. Let us start with the topic of bank reconciliation statement. To start with, the first and foremost question is, what is bank reconciliation statement? The answer is, it's a statement. What is it? It's a statement. If it is a statement, why do we prepare bank reconciliation statement? Here we'll give wrong answer. We will tell to find balance as per passbook, to find balance as per cash book, which is wrong answer. Why? The objective of preparation of BRS is not to find balance as per passbook. Balance as per passbook will be available in passbook. Balance as per cash book will be available in cash book. Between them, there will be no coordination. There is differences between balance as per cash book and balance as per passbook. Let me repeat. There is difference between balance as per cash book and balance as per passbook. They are not matching. Because they are not matching, we want to identify why are they not matching. What is it that is there in cash book but not there in passbook? Or what is it that is there in passbook but not there in cash book? Ninnalli irodenu, nannalli illade irodenu. So you are trying to find the difference. Why? That difference can be because of error. That difference can be because of, why do you want to compare passbook with cash book? To check if there is any error. If there is any error, we should do rectification of errors. What should we do? Actually, 50% of this BRS chapter is extension of rectification of errors. In rectification, they give the error, we rectify. In BRS, we need to check if there is an error and then rectify. Sometimes we find some difference which is not error, that we won't rectify. That is the only reason why BRS is not given in rectification. And one mistake what we do BRS first topic, or we do BRS and then we do rectification at the end. We shouldn't do. Should first finish rectification of errors and only then start with BRS. Whenever you do BRS before rectification, you're doing a big mistake in your life. Sorry, you're doing a big mistake in accounts. Life ante. So first one, what is BRS? It's a statement. Why do we do BRS? To reconcile. What is the second word? To reconcile. What do you mean by the word reconcile? Reconcile is knowing the reason for difference. What is reconcile? Knowing the reason for Very good. Whenever there is difference between cash book and passbook, we want to know why is there a difference between cash book and passbook, and we will rectify that mistake if there is one. So to reconcile means what? Knowing the reason for difference. Knowing the reason for. Now let's focus on the word difference. What do we mean by difference? What do we mean by difference? How can there be difference? The difference is between cash book and passbook. Okay. Difference is between cash book and passbook. Cash book is the record that we have kept. Passbook is the record that banker has kept. Let me repeat. Cash book is the record that we have kept. Passbook is the record that banker has kept. Between them, there might be some transactions which are there in cash book but are not there in passbook. Transactions which are there in passbook but they are not there in cash book. These errors have to be rectified. Okay, now let's see what is the reasons for difference. The first reason for difference. You have given a check to somebody. You have given a check to somebody. The moment you give them the check, you pass the journal entry, purchase account debit to bank account, or that party account debit to bank account. You pass the journal entry. The moment you pass that journal entry, your bank balance as per cash book will reduce because you pass the journal entry in cash book. Bank balance as per cash book will. However, this entry is not recorded in passbook yet. Why is it not recorded in passbook? After you give the check to that person should take that check to bank and deposit in bank. That's when the banker will clear that check. Banker has not yet deposited, the person to whom you have given the check has not yet deposited the check with banker, or he has deposited it with banker. Banker has not collected the money from my banker. Banker has not cleared it. So passbook balance will not reduce. I repeat, we have issued the check and we wrote the entry in cash book. It reduced. This check is not deposited with banker, or this check is not cleared by banker. So passbook balance is not decreased. Cash book has been decreased. Passbook has been not. This is the reason for difference. What is the first reason for difference? Check issued but not deposited, or check issued but not cleared. If this is the reason for difference, if your starting point is balance as per cash book, you should add. If your starting point is balance as per passbook, you should deduct. What if the starting point is overdraft balance? Ulta? No, don't do ulta. Balance as per cash book is overdraft of 10,000, right? Balance as per cash book minus 10,000. Don't change all the add items to less, all the less items to add because the opening balance is overdraft. Add items, let it be add. Less items, let it be less. Opening balance is overdraft, that balance will become minus. One item should not shake the entire table. Only that item you change. Are you getting it? So if you're still doing that approach of all the add items making it less, all the less items making it add because the balance is overdraft, don't do it. Are you getting it? So check is been check is been issued. So balance as per cash book has reduced. It is not cleared. Balance as per passbook has not reduced. If we are making changes in cash book, we will add. If we are making changes in passbook, we will deduct. That's it. If it is overdraft, write the opening balance as negative. Shall we go to next reason for difference? And this difference is timing difference. I'll tell you what is timing, non-timing later. Second one, check is received but not deposited, or check is received and deposited but not cleared. You received a check from some customer. When you received it, immediately you wrote bank account debit. Your bank balance as per cash book has increased. But you have deposited that check with the banker, or you have not deposited the check with the banker. Passbook balance has not increased. Even if you deposit, banker has not cleared. So the passbook balance has not increased. Is there a difference? Yes, there is a difference. So what should we do in this case? If you're starting with balance as per cash book, if your starting point is balance as per cash book, what should you do? Minus. If your starting point is balance as per passbook, add. Understood? Say something. Very good. Then direct deposit by customer into bank account. What do you mean by direct deposit by customer? Your customer went to bank and deposited the check or money in your name and came back. When your customer deposited money in your bank account, your bank balance as per passbook has increased. Your bank balance as per passbook has, but your bank balance as per cash book has not increased. Bank balance as per passbook has increased, bank balance as per cash book has not increased. Is there a difference? Yes. If your starting point is balance as per cash book, what should you do? Add. If your starting point is balance as per passbook, what should you do? That's it. Understood? Then you have asked the banker to make payments on your behalf without asking you. You have given standing instructions to the banker to make payments. You have given standing instructions to the banker to make payments. When the banker makes standing instructions on your behalf, balance as per passbook will decrease every time the banker make payment. You have not written it in cash book. Banker has paid, passbook has decreased, cash book no entry, cash book has not decreased. Are they in the same line? Is there a difference? Yes. Where are we making changes? If we are making changes in cash book, what do I do? Minus. If we are making changes in passbook, what do I do? Add. Did you get it? Very good. What about the next one? Receipts collected by the banker on our behalf. Without informing us, banker has collected money on our behalf. Interest, dividend, all of this. When the banker has collected money on our behalf, balance as per passbook has increased. Balance as per passbook has, balance as per cash book has not increased. Balance as per cash book has not increased. Passbook balance has increased, cash book balance has not increased. Where are we making changes? If you're making changes in cash book, you add. If you're making changes in passbook, you deduct. Understood? Then comes to the sixth one. Sixth one is where bank charges have been recorded by the banker, but we have not recorded it. Or bank charges is recorded in passbook only. If the banker has recorded bank charges, bank balance as per passbook would reduce. Entry is not made in cash book is not changed. Where are we making changes? If we're making changes in cash book, we reduce. If we're making changes in passbook, we add. Everyone got it? What if bank interest is collected by banker on our behalf? If the interest is collected by banker on our behalf, bank balance as per passbook would have increased. Cash book, there is no entry. If you're making changes in cash book, I should add. If you're making changes in passbook, I should deduct. Then next one. What if the error has happened in passbook or error has happened in cash book? We should see what is the error. Someone else has given check to somebody else. Someone else, not you. Someone else has given check to somebody else. Banker by mistake reduced your passbook balance. Because of that, passbook balance is reduced. Cash book is not. Making changes in cash book, minus. Making changes in passbook, add. Understood? What if by mistake banker has increased your passbook balance? Someone deposited check into their account. Banker should give credit to them, no? Banker wrongly gave credit to you. Because banker gave wrongly credit to you, your passbook balance has gone up. Your cash book balance is not. Where are we making changes? If you're making changes in cash book, what should I do? If you're making changes in passbook, what should I do? Understood? Say something. What if you have by mistake written a transaction in cash book at a higher amount? You are supposed to receive 1 lakh rupees from some customer. How much are you supposed to receive? You gave him 5,000 rupees discount. So how much will he give? 95,000. How much will he give? You tell me. In my cash book, in the bank column, I should write 95. In discount column, I should write 5,000. Am I right? There is an adjustment where erroneously the transaction was recorded in the bank column what? Gross amount. Gross amount is 1 lakh. Discount is 5,000. Net amount is 95,000. Gross amount is 1 lakh. Net amount is 95. Discount is 5. How much did you receive? 95. How much discount did you give? 5. Correct? In bank column, should you write 95 or 1 lakh? 95. We by mistake wrote 1 lakh. What happened? Balance as per cash book has increased. Passbook, how much will it go up by? 95. Passbook goes up by 95. Cash book has gone up by 1 lakh. Is there a difference of 5,000? Yes. If you're making changes in cash book, minus. If you're making changes in passbook, add. Understood this? That's it. These are the differences what we're trying to deal. Am I right? When are we doing all of this? In bank balance as per cash book and bank balance as per passbook comparison. When is BRS prepared? Some of them say weekly, monthly, quarterly, half yearly, yearly. When should we prepare? Whenever we want to prepare, we can prepare. Someday in the night at 12 o'clock, you're not getting sleep, you want to do BRS, you can do BRS. No one is stopping you. But mandatorily, you should do BRS before you do final accounts. Mandatorily, you should do BRS before you do final accounts. Why? Once you do final accounts, your bank balance is posted to balance sheet. What if that bank balance in the balance sheet is wrong? If that bank balance in the balance sheet is wrong, tappalva. So when you're preparing balance sheet, your trial balance is done and you're about to prepare balance sheet, just check once whether you are what is correct. Bank balance is correct. How do we do it? We prepare BRS. So you can do it at regular intervals based on management discretion, but it is mandatory that you must prepare it on balance sheet date. Do you get this? Now, which balance to show in balance sheet? Should we show balance as per cash book or should we show balance as per passbook? We should show balance as per amended cash book. We should show balance as per, what do you mean by balance as per amended cash book? This balance as per cash book is there, no, that is or that can be wrong. When we check cash book and passbook, we identified those differences. Those differences can be timing difference or can be non-timing difference. Among those differences, if there is any non-timing difference, that is basically error. We need to rectify the error. I told you what is the objective of preparation of BRS is to identify the error and rectify it. Whenever there is difference between these two, that should be timing difference. What difference? What do you mean by timing difference? Check is been issued, cash book it is reduced. Check is been not cleared, passbook is not reduced. By another day or two, passbook balance will reduce. You don't have to do anything from your end. When the check is issued, entry in cash book. When the check is cleared, passbook will entry. Right now the check is issued but not cleared. The difference is time. Today check is issued, 3 days or 4 days later check will get cleared. During those 4 days, you don't have to do 100 squats or you don't have to pray to the God for the check to get cleared. It will get cleared. It will get cleared by itself. Am I right? That is timing difference. Cash book it's come today, passbook it will come in 3 days or 4 days. What is that? Timing difference. What about check deposited but not cleared? Timing difference. Why? When you deposit the check, cash balance has increased. It will get cleared when the check will get cleared. Passbook will increase eventually. You don't have to do anything. But bank charges, interest, or direct deposit by customer, these transactions have been recorded in passbook. You have not recorded in cash book. Until and unless you record it in your cash book, difference will always be there. Difference will never go away. So you have to make the entry. That is clearly error of omission. Bank charges recorded in passbook only. Interest credited in passbook only. Direct deposit by customer recorded in passbook only. What are all of this? What are all of this? These are errors. Complete omissions. We should record in cash book. If we have not recorded in cash book, it is our mistake. If we have not recorded in our cash book, it is completely our mistake. We have to record it. We haven't recorded. We will record it now. We have to record it. We haven't recorded it. We will record it now. Did you all get it? Say something. Very good. So now we'll take some help in identifying timing and non-timing differences. What is timing, non-timing difference? Difference between passbook and cash book other than the reason of time. Time andre enu. By some time it will get cleared. You give some time and the difference will no longer be there. Okay. Now, check is issued but not deposited. Or check is issued, deposited but not cleared. Timing, non-timing. Timing difference. You give little time and it will get cleared. What about check deposited but not cleared? Check received but not deposited, or check received and deposited but not cleared? Timing. How about direct deposit by customer into bank account? Non-timing difference. How about payments made by the banker on behalf of the account holder, not recorded in cash book? Non-timing difference. How about receipts collected by the banker on behalf, not recorded in cash book? Non-timing difference. How about bank charges recorded in passbook only? Non-timing difference. How about interest recorded in passbook only? Non-timing difference. How about errors in cash book? Non-timing. How about errors in passbook? Thank you. Now, if it is error in cash book, it will get rectified only when we do it. If it is error in passbook, we don't have to rectify. Banker will rectify. We just have to wait. All of these which are red flags, no, non-timing differences, they will come in amended cash book. Where will they come? However, if it is green color flag, it will continue to appear in BRS only. It will continue to appear in. Did you all understand? Remember, all the non-timing differences are errors, needs to be rectified in amended cash book. Timing differences will continue to arise in BRS only. If you prepare BRS without doing amended cash book, timing, non-timing, everything will come in BRS. If you do amended cash book, from all the differences, timing differences will continue to be there in BRS, non-timing differences will go to amended cash book. Let me repeat, in your BRS, timing, non-timing, all the errors, all the differences will be there. After BRS, if you prepare amended cash book, everyone, I don't want to tell again and again, everyone, either here or out, or if you are here, you should be quiet. Entire row. Okay, please don't make me tell once again. So, what was I telling? All the differences from BRS, it will be there in BRS. When we prepare amended cash book, what do we write in amended cash book? Only non-timing differences. If we prepare BRS after amended cash book, what will come in BRS after amended cash book? Only timing differences. Only, did you everyone understand this? Sir, in amended cash book, what to write on debit side, what to write on credit side? Very simple. If it is a plus item, write debit. If it is a minus item, write credit. Plus item in BRS will appear in debit side in amended cash book. Minus item in BRS will come in credit side in BRS. Here you will ask one beautiful doubt. Sir, some items are plus sometimes if you start with cash book. The same item is minus if you start with passbook. What to do? Remember, the appropriate way of doing cash book, BRS is always starting with cash book. You will never start with passbook balance. You should always, remember this, you should always start with balance as per cash book, never with balance as per passbook. Sir, but in material there are a lot of questions where we start with passbook. That is because we don't have balance as per cash book. If we have balance as per cash book, we should always start with balance as per cash book. Only and only if we don't have balance as per cash book only in the question. They give us balance as per passbook. Then we'll start with balance as per passbook. If you start with balance as per passbook and arrive at cash book, you can't do amended cash book like that. Then you should do one more BRS CB to PB and then do your amended cash book. Are you getting it? And do amended cash book in the exam only and only if it is asked. Only and only if it is asked. When they ask, they'll tell very clearly. Tell me, compute the amount to be shown in balance sheet. They'll ask, or prepare amended cash book. Buy bit to care. If they ask, do amended cash book and BRS after amended cash book. Okay, say something. By this, we are done with BRS topic. Let's quickly see that one question that is there in the material on BRS. Sorry, one question that is there in our RTP. Can we? Okay, guys, come on. RTP question. Summer and Company. Please read. On 31st of December 2023. Showing a. Okay, favorable balance is positive balance. If they would have told unfavorable balance, I would have just started it with the same number in brackets as minus. How much is it? 1,05,980. Okay, this did not agree with the balance as per 1,05,980 is balance as per passbook. In the question, if they give us balance as per cash book, we'll always start with balance as per cash book. Here they haven't given balance as per cash book. That is the only reason why I'll start with balance as per passbook. What is our starting point in this? 1,05,980 passbook balance. Am I right? Okay, read the first one. Deposit of had not been credited by the bank till. So deposit is being made. When you make the deposit, cash book balance has increased. When you make the deposit, cash book balance has increased. It is not been credited by bank. So passbook balance has not increased. I'll repeat. Cash book balance has increased. Passbook balance has not increased. Where are we making changes? Passbook. What should I do? Add. How much do I add? 30,825. 30,800. Okay. Now let me show the answer to you. See, 30,825 is added. Starting is 1,05,980. Done. Come to next item. Read the next item. 48,400 not presented. When you issued the check, balance as per cash book has decreased. When will passbook decrease? When the check is cleared. Cash book has decreased, passbook has not. Where are we making changes? Passbook. What should I do? Minus 48,400. Observe. Less check issued but not presented. Minus 48,400. Done. After that, on 25th of September 2023, firm had entered into hire purchase. We have a similar one in ICS study material as well as in our material. Into hire purchase. Agreement to pay by bank order sum of rupees 25,000 on 10th of each month commencing from October till year end. Year ending is December. We're doing it is when? December 31st. So October, November, December, 3 months, 25,000 rupees in each month. We have paid by bank order. We gave instructions to bank. Banker has paid. How much? 25,000 for October, 25,000 for November, 25,000 for December. How much has banker paid? 25, 25, 25, 75. Banker has paid. When the banker has paid, passbook has decreased. For this transaction, there is no entry in cash book. Cash book entry is not written. Passbook balance has decreased, cash book balance is not. Where are we making changes? What should I do? Add how much? 75. Observe, add hire purchase installment 75. Clear? Some of us have this habit of writing all add items at one place, all less items at one place. There is no need. And you don't even have to draw two columns. Write everything in one column. One add item, two less items, one more add item, one more less item. In the order of adjustments given in the question, go on writing. Don't try to segregate. Time waster and space waster, and you will get irritated also slightly. Okay. Then add, and then you would have to do inner column and then total, inner column to outer column, then outer column total. Why? All the chaos. Then the next item. Third one over. Come to fourth one. A customer of the firm who received a cash discount of 4% on his account of 2 lakh. A customer has to pay us how much? 2 lakh. We gave him 4% discount. How much is 4% of 2 lakh? 8,000 we gave him discount. So how much should he give us? 2 lakh minus 4%. 1 lakh 92,000. How much should he pay us? 1 lakh 92. How much will he give us? 1 lakh 92. So when he gives us 1 lakh 92 instead of 2 lakh, we gave him discount of 8,000. In my cash book, I should write 8,000 in discount column, 1 lakh 92 in bank column. Am I right? Read. Paid the firm a check on 22nd December. The cashier erroneously entered the gross amount. So how much did he write in bank column? How much you should have written? 192. Because he wrote 2 lakh. Cash book went up by 2 lakh. And passbook went up by 1 lakh 92. Cash book went up by 2 lakh. Passbook went up by 1 lakh 92. How much is difference? 8,000. Cash book has increased. Passbook has not increased. Where are we making changes? What do I do? How much? 8,000. Shall I add 8,000? Observe here. 8,000 rupees checks received after discount. Wrongly entered at gross amount in cash book. Okay. After this, bank charges amounting to rupees 1,250 had not been entered in cash book. 1,250 rupees bank charges. Passbook balances decreased. This is not entered in cash book. 1,250 rupees entrance, bank charges when is entered in passbook balance has decreased, but cash book balance has not decreased. Where are we making changes? What do I do? How much do I add? 1,250. So I will write add bank charges not entered in cash book 1,250. Got it? Next, dividend of rupees 25,000 collected by bank was not recorded in cash book. So 25,000 is being collected by bank. Because the banker has collected this, bank balance as per passbook has increased. Because it is not entered in cash book has not increased. Where are we making changes? Passbook. What should I do? Minus. I will write here minus dividend received but not entered in cash book minus 25,000. This is how we arrive at balance as per cash book 147,655. Here this question you can't do amended cash book. To do amended cash book, starting point should be cash book. Understood? Then what do? We'll check timing difference, non-timing difference. All the timing differences are only 3. Check received but not cleared, checks issued but not cleared, errors in passbook. These 3 are timing, rest everything is non-timing. All the non-timing differences will come in amended cash book. If it is plus when you're starting with cash book, debit. If it is minus when you're starting with cash book, credit. When you close your amended cash book, whatever balance you get, should start with that balance and then do BRS after amended cash book. And that balance as per amended cash book is what will go to our balance sheet. And this is our discussion with regard to bank reconciliation statement. I hope everyone understood. And I hope there is no problem also with this. Very good. So far we have finished accounting process and bank reconciliation statement also. Okay. Shall we take a short break? Once we take a short break and come back, we'll do valuation of inventory and depreciation. Once we finish those two, we are done for the day. Okay. Short break. Welcome back, people. Let's now start with chapter 4, valuation of inventories. To begin with, whenever you use the word valuation, valuation means representation in terms of money. We are trying to represent inventory in terms of money, because inventory is a very important aspect in determination of our profit as well as determination of financial position. If we don't write the correct value of inventory, our profit will be wrong. If we don't write the correct value of inventory, our balance sheet net worth will be wrong. So we need to figure out the right value of inventory. Inventory usually includes three variants: finished goods, work in progress, and raw material. For instance, if we are selling shirts, shirt is our finished goods, which is kept in the ordinary course for sale. This shirt is made out of cotton, which is raw material. But cotton to become shirt, first it should become thread. That thread, which is in the process of becoming the shirt, is work in progress. And in the raw form, when we bought it, it is cotton. That cotton is what we call as raw material. Did you get it? Say something. Very nice. So raw material is the material that will be consumed in manufacturing of finished goods. Work in progress is the item which is in the process of being produced as finished goods. Finished goods is the item which is held and used for the purpose of sale. Do you get it? Very good. So this inventory has to be valued correctly, because of this inventory will determine our profit and our financial position. Now, significance of inventory valuation. Like I told you, it will help us determine our income. If in case it is wrong, our profit will be incorrect. Just to make you understand, do you know this formula that gross profit is equal to sales minus cost of goods sold? I can reiterate this by identifying the value of cost of goods sold. Cost of goods sold is opening stock plus purchases plus direct expense minus closing stock. Opening stock plus purchases plus direct expense minus closing stock. Now, this closing stock, if it is wrong, cost of goods sold will be wrong. If cost of goods sold is wrong, then our gross profit will be wrong. Do you get it? Okay. Or if you see the trading account approach, we'll write opening stock, purchases, direct expense on the debit side, and then we'll write sales and closing stock on the credit side. If our closing stock, what we write on the credit side, is wrong, the total that we get will be wrong. If the total on the credit side is wrong, total on the debit side will be wrong, which if it is wrong, the gross profit resulting will also be incorrect. How will it impact? If in case I increase the value of my closing stock, what will be the impact on GP? Shall we see? Now this is the this is the trading account. Do you see this trading account? Does it look fine? Does it look fine? Correct? Absolutely correct. There is nothing wrong in this. Now let us say we'll increase the value of our closing stock. Instead of 25, assume that I made a mistake and then I wrote it at 30. What will happen to the total on the credit side now? Total will become 1,30,000 on the credit side. Debit side total also will become 1,30,000. Then how much will be our GP? 1,30,000 minus 55. 75,000 will become our GP. So GP was 70 when closing stock was 25. When I increase the closing stock from 25 to 30, my GP increased from 70 to 75. So can I conclude by saying, by increase in closing stock, GP will increase. By increase in closing stock, GP will. Let us check other way around. Instead of making 25 as 30, let us say I took 25 as 20. When I take 20 in the place of 25, what will be total on the credit side? 1,20,000. Total on the debit side will become 1,20,000. How much will be GP in that case? 40 plus 10 plus 5, 55. 55 minus 1,20,000. So what happened? When the closing stock increased, GP increased. When the closing stock decreased, GP decreased. I'll repeat, when the closing stock increased, GP increased. When the closing stock decreased, GP decreased. When you guys come late, just sit where the place is available. You shouldn't make everyone change their places when you come to sit. Either come on time. If you come late, then don't make everyone stand. That's basic classroom decorum. And when you're already late and you're walking in, from there you cannot come with phone in your hand, earphones in your ear. Everyone has phone. Keep your earphones in your pocket, phones in your pocket, and then walk into class. And already late using the phone throughout when you come till here, then sit and then talk to your neighbor. Completely disrespectful and unaccepted behavior. I'm focusing on the subject. Let me please do that. You keep all of this outside the classroom. Don't do it for your good. I don't want to start with everything. Will you? Please remember, you are attending a class and it is not mandatory. You don't even have to come if you don't want to come. You should come only if you want to learn. you want to be on your earphone or on the phone, or if you want to talk to your neighbor, you with your friend with your phone and earphones, you can get out. Please remember. Then the conclusion is, with increase in closing stock, profit will increase. With decrease in closing stock, profit will decrease. Let us see what will be the impact of opening stock. Opening stock will also be impactful because of an error in closing stock. You know why? This year's closing stock will become next year's opening stock. So this year if the closing stock is more, current year profit will be more. Next year opening stock will be more, because of which profit will become less. So ultimately the profit don't change for both the years together. When by increasing your closing stock, you are increasing current year profit and decreasing next year profit. So how does that work? Observe a very similar example. In this morning, if you are having Chitrana, it is because last day you have Tanglana. Previous year's closing stock will become current year's opening stock. And with this logic, let's see this. Let us take the same numbers what we had previously. Total on the credit side will become 1,25,000. Debit side if I write 1,25,000. 55 if I deduct, how much is GP? How much is GP? 70,000 is our GP. 55 minus 1,25,000 minus 70. Sorry, minus 55. Unlike my previous adjustment, I won't change my closing stock. Let me change my opening stock. Opening stock is 10. Let me make it 15. If I make my opening stock 15, debit side total, credit side total won't change. GP will change. Total is 1,25,000. 1,25,000 minus 45. Sorry, minus 15 minus 40 minus 5. GP will become 65. So with increase in opening stock by 5,000, GP decreased by 5,000. If it was increase in closing stock by 5,000, what would have added to GP? GP would have increased by 5,000. Am I right? Very good. Now with decrease in opening stock, instead of making 10 as 15, let me make my 10 as 5. If I make my opening stock 5, total will be 1,25,000. Deduct 45, 5 and 5. 70,000 if you deduct, we get 75,000 as our GP. So the conclusion is, opening stock if it increases, gross profit will decrease. Opening stock if it decreases, gross profit will increase. So the behavior is opposite. Do you get it? Closing stock increase, profit increase. Closing stock decrease, profit decrease. Opening stock increase, profit decrease. Opening stock decrease, profit increase. How do you remember this? Very simple. You know this movie Om Shanti Om? In this song, they keep on adding actors every 1 minute, every 10 seconds in fact. So when people go on adding, no, profit will decrease. They would have to give remuneration to all of them. Free nobody does. So Om Shanti Om, profits will decrease. In Om Shanti Om movie, when they go on adding people, profits will decrease. So OSO, opening stock overvalued, profit will decrease. If I change it, OSU, opening stock undervalued, it will be ulta to that one. It will become profits will increase. If I call it closing stock overvalued, one item is changing, no, opening to closing. It will be reversal of the first one. Profit increase. What if it is CSU? Two things are ulta. It will become profits will decrease. So this is an easier logic to remember. Got it? Then after this, you would have to practice some questions on this. Then I'll teach you the ascertaining financial position. I told you inventory is very important. You need to value the inventory at its monetary value and then write in books of accounts. It will not just affect profit in P&L. Inventory will be written in balance sheet asset side also. If you write wrong value in the balance sheet asset side, capital and net worth calculation will also go incorrect. Got it? Then how do we value our inventory? It should be as per accounting standard 2. How should we value it? It should be valued as per accounting standard 2. As per para 5 of accounting standard 2, inventory should be valued at cost or NRV, whichever is less. How do we record it? Cost or NRV, whichever is less. And this entire process of valuation of inventory, remember, it is accounting policy and it is not accounting estimate. Valuation of inventory is accounting policy. In chapter 1, when we discussed for accounting policies, I gave valuation of inventory as an example. Now, this cost or NRV, whichever is less, important point to remember, we should do item wise, line to line, we should do cost or NRV, whichever is less. If they give 3-4 items of inventory, all the 4 items have cost, all the 4 items have NRV. Don't do total cost, total NRV, whichever is less. No, wrong. You should do each item of cost, each item of NRV, whichever is less. Each item of cost and NRV, whichever is less. Each item. You should do it for, we should not do it for total. Got it? Say something. Very good. After that, when we talk about the word cost, what and all will cost include? Cost will include purchase price. Cost will include freight, cost of conversion, any other directly attributable expense. Any other directly attributable expense. Expense that you incurred to bring the goods to its present location and condition. Important thing to remember, if there is input tax credit, if there is tax paid, if there is input tax credit available, that will be adjusted against amount payable, so not to be included in cost. If input tax credit is not available, then we'll include it in our cost. Understood this? If there is any general administration expenses and all of that should not be considered. If there is discount available, deduct that discount and take the net of discount amount. And there is certain amount of details with regard to cost, what should be included, cost, what should not be included. I'll tell you what is included, what is not included. Administrative overhead will not be included. If you say something as administrative expense, it should not be included. What if you say some losses? We should check whether it is normal loss or abnormal loss. Normal loss value will be included in the value of goods. Normal loss will be deducted only in units column. Amount value will be same. Number of units would come down. Because of this, the per unit rate of each good unit will increase. Let's say we have 100 units at rupees 10,000 rupees. 10 or 5 units got lost normally. I'll deduct from 100 units. Number of units will become 95. Value will remain as 1000. So previously for 100 units value was 1000. Now for 95 units value is 1000. So rate per unit will increase because of normal loss. We won't write anything in amount column. If it is abnormal loss, we deduct the amount also, because of which value of the units will remain same. Per unit value will remain same. Remember, abnormal loss should be excluded. Normal loss will only increase the per unit cost. What will happen because of normal loss? It will increase our per unit cost. Did you understand? What about storage cost? It should be usually not included. It should be usually not included. However, if that storage is mandatory process of production, if you don't do storage, that product is not complete. Timber, rice, paddy, wine. So in that case, storage cost is included. Otherwise, it is not included. You learn this in detail in CA Intermediate. Interest and borrowing costs are also usually not included. We'll discuss it in Inter. Accounting Standard 2, Accounting Standard 16. Right now, basics you understood? Say something. Very good. So what I wanted to know next is NRV. Whenever we say NRV, all the three you don't want. We'll only focus on finished goods NRV. When we talk about NRV, net realizable value, we should take selling price minus expenses to be incurred for selling those goods. We should take selling price minus expenses to be incurred to sell those goods. When you do selling price minus selling expenses, we get net realizable value. What do we get? Net realizable value. That is the value at which NRV will be considered. And we take cost or NRV, whichever is less, as the value of the assets. Understood this? Very good. Then the last part is about methods of determining the value of inventory. How do we find the value of inventory? We should check whether the inventory is ordinarily interchangeable or not ordinarily interchangeable. Ordinarily interchangeable means what? One unit can be replaced with another unit without any difficulty. There is no separate identity for each product. In that case, what do we do? Considering historical cost. Considering historical cost. We have FIFO, LIFO, SAM and VAM. Without considering historical cost, we have adjusted selling price method. However, if each unit is unique, each unit is customized, one cannot be replaced with another, then we follow something called as SIM, specific identification method. The value of each unit of inventory has to be separately identified. Example, jewelry shop or designer wear. Each unit is different. No two chains value will be same. No two sarees price will be same. There, each item's value you identified separately. If it is normal men's shirts and all, any shirt in the track will be same price. So find the value of one shirt multiplied with number of shirts. That's where we do what to say FIFO, LIFO, SAM, VAM and ASP. FIFO is units that is received first is issued first. So closing stock will be from the most recent purchase. Last in first out is what is purchased most recently. Lastly bandidu will go out first. So closing stock will be opening stock on very first purchases. Simple average method, we take entire inventory together. We'll take first rate plus second rate divided by 2. But this doesn't give any importance to units that we carry. If I purchase 100 units at rupees 10 and I purchase only one unit at rupees 12, Rate for 101 units is 10 plus 12 divided by 2. I purchased how many units at rupees 10? 100. I purchased only 1 unit at rupees 12. Let's say I have all 101 units in my closing stock. You know what is the value? 101 units multiplied by, what is the rate? 10 plus 12 divided by 2. How much is 10 plus 12 divided by 2? 11. 11 rupees per unit for 101 units. How much is the value? 101 into 11 is how much? 1000. Why are you guys getting different answer? 101 units into 11. 1000. 1111. 101 units into 11. But actually how much did you pay? For 100 units you pay 10 rupees. That is how much? 1000. For 1 unit you pay 12. What is the value? 1012. You should get 1012 as value. You are getting 1111. How did 1111 become 1012? Sorry, how did 1012 become 1111? Because we took average. So simple average is bakwas. It is incorrect. It doesn't give any significance to weight. It doesn't give any significance to. It is like me telling class has 100 students. 99 students scored 80 marks. Only one student scored 1 mark. Or only one student, let's say, scored 10 marks. How many students are there in the class? 100. How many students scored 90 marks? 99 students scored 90 marks. Okay, only one student scored 10 mark. Average I am doing 90 plus 10 divided by 2, 50% is the average score of the class. Is that right? No. I should do X and F, summation Fx divided by capital N. I cannot do only total of F and then divide by number of items. Incorrect, alwa. You get it? That's what we're doing in simple average. So we should go for weighted average. Weighted average is like summation Fx divided by N. We'll take weight into rate to arrive at the total amount. Are you getting it? Total amount divided by total units is done to find out the weights. So that is more appropriate. You always do this FIFO, LIFO, SAM and WAM from the perspective of inventory. See that like statistics. That will start making so much more sense. See that like identifying mean. It will make so much more sense. Are you getting it? Very good. Then after this, we need to know the inventory record systems. There are two inventory record systems. One is periodic, other one is perpetual. Periodic means we use the COGS formula to apply the valuation of inventory. This is incorrect, unscientific. Perpetual is detailed and scientific. We maintain records for every unit coming in, every unit going out. If you ask me what was the inventory on 15th of May, I will tell. If you ask me what is the inventory on 23rd of May, I will be able to tell. Under which method? Perpetual. Under periodic, I can't tell like that. The day you tell me how much inventory, I'll physically count the inventory, I'll apply the formula and tell. If the date has passed, then I can't tell the value. If there is some loss that has happened, we cannot identify how much have we lost because there is no control. However, if we do perpetual, as per books we'll arrive at some inventory, as per physically there is some inventory, we can compare them and tell if there is anything wrong. Understood this? Then we'll quickly see the stock reconciliation. This is your favorite questions from the topic. Am I right? So there are two kinds of stock reconciliations. One is forward, other one is backward. And there is one special one involving physical inventory. What do you mean by stock reconciliation? That stock adjustment problems? Very simple. In order to write the inventory in balance sheet, we cannot look at any ledger and write. Purchase total you can get from purchase account. Sales total you will get from sales account. But inventory, there is no ledger account. Do you prepare anything called inventory account or stock account? So inventory value has to be computed by physically counting the inventory. Physically look at the inventory and then count it. But to count the inventory, you might not be able to do it on 31st of March sometimes. 31st of March you are busy or the client is not letting you count the inventory or some other problem. Because of this, what's happening? You counted the inventory on 5th of April or you counted the inventory on 25th of March. Now using the inventory that you counted on 25th of March, you want to find the inventory on 31st March. Or using the inventory that you counted on 5th of April, you want to count the inventory on 31st of March. This is what we mean by reconciliation. You are not doing the inventory count on the day you want the inventory. You are doing it on a date ahead or you're doing it on a date before. Using that, you are arriving it on 31st of March inventory. Let's say I counted the inventory on 25th of March. I know what is the inventory on 25th of March. Keeping 25th March inventory as base, can I find the inventory on 31st March? Yes. How? 25th March inventory plus purchases minus sales or plus inflows minus outflows between 25th and 31st. If we do that, I'll get 31st March. Am I right? I will go count the inventory on 25th March, come back with one number. That number is there in my mind. I will ask my client or the department or the company, give me details of purchase, sales and all the stock movement from 25th March to 31st March. They'll give documents. Only those documents I'll check. Add purchase, deduct sales. Add sales return minus purchase return. Over. I'll get 31st of March inventory. Got it? From 25th March, if you're going to 31st March, it is called forward problem. What is it called? You add inflow, you minus outflow. You add inflow, you minus outflow. Then we have something called as backward problem. What is it? You counted the inventory on 5th April. From 5th April, you are coming back to 25th of March. Sorry, 31st of March. You are coming back now. You are doing backward, ulta. So sales is usually minus. Purchase is usually add. Now we should do ulta. Sales will be added, purchase will be deducted. That is backward problem. Only thing that you should remember is when you are adjusting sales, you should adjust it at cost price. At what price should you adjust? See, after the year end, if the physical count is done after the year end, that is on 5th of April in our example, we are coming back to 31st March. What problem is it called? Backward stock reconciliation problem. What do you mean by before year end? From 25th March, you are going till 31st March. What problem is it called? Forward stock reconciliation problem. What is it called? Forward stock reconciliation. Very good. So if it is forward stock reconciliation problem, sorry, if it is backward, we are going from 5th April to 31st March. So usually forward, what do? I add purchase, deduct sales. But this is backward. What is this? I will add back sales and deduct purchases. Meaning I will add back, outflow, deduct inflow. Inflow should be added, outflow should be deducted. Am I right? We're doing backward. So what do? I will deduct inflow, I will add outflow. Understood? But sales should be written at cost. Sales should be written at cost. Remember to adjust sales with sales return, purchases with purchase return, and then write it. Sales will be at selling price, eliminate the profit portion and then write it at cost. Clear? Then after this, before year end, if you do it before year end, then what's happening? We're doing it on 25th of March, but we should find the inventory on 31st of March. How do we go from 25th March to 31st March? We're going forward. Inflow will be added, outflow will be deducted. Inflow will be added, outflow will be deducted. Did you all get this? If in case they give physical inventory, remember to adjust only if the physical inventory changes. Let's say they've given physical inventory on 28th of March. They want you to find physical inventory on 31st of March. Remember to add only if the physically goods are moving. Remember to deduct only if the physically goods are going out. Are you getting it? I'll repeat. If they give book inventory is all of this. One kind of question what people find difficult is stock movement which is physical. They'll tell inventory, physical inventory in the go down as on 28th of March, so and so. Find the physical inventory on 31st of March. How do you find? If the goods are sold, we won't do minus. If the goods are sent, we do minus. Goods are not sold but sent, still we will deduct. Goods are received, we will add. Goods are purchased but not received, we will not add. Goods are purchased but we have not yet received it, will you add? Goods are received but actually not purchased, we'll add. So basically we'll take care of what? Physical movement of goods only, not bookish movement of goods. Are you getting it? You should remember consignment and goods sent on return or approval also carefully here. With regard to goods sent on return or approval, remember that goods will be only sent, not sold. Goods will be only sent, not sold. If I've sent goods on return or approval, it is not sale. It is not sale. The inventory is with the customer, but it belongs to me. That entire inventory, what I've sent on return or approval, it is not sale. It is my inventory. I should include it in my stock. I should add it back. If you take physical inventory on 31st of March or 5th of April, that in my go down when I count the inventory, is that stock counted? Why? That stock is with customer. Does that belong to him? It belongs to me. So should add it. I should add it. What if he has returned it to me? If he has returned it, it's already there in my go down. When I count it, it will be already counted. So I don't have to add again. Let us say I have sent goods on return or approval basis 10,000. He has returned 40% of the goods before the counting. So 40% is in my go down. I've already counted it. I don't have to add 40%. How much do I have to add now? 60%. What if that 60% is accepted? Then I don't have to add. Why? It is sales. Do you agree with me? Yes or no? That 60% is not accepted. Then I would have to add back. I should add back at cost price. Should add back at. Everyone understood this? This is one goods sent on return or approval adjustment. Next, consignment adjustment. What will be with regard to consignment? Let's say I am consigner and I have someone called as consignee. I have sent goods to my consignee. Have I sold it? I have only sent goods on consignment. When I send goods on consignment, the inventory will not be in my godown. It will be with my consignee, but I have the ownership. That inventory will belong to me. I have the ownership and that inventory will belong to me. Let us say 10,000 worth of goods are sent on consignment. 10,000 worth of goods are sent on consignment. I don't have that inventory with me. Do I have it with me? I don't have it with me. But is it mine? Yes. When I physically count the inventory, would I have counted it? Why? I counted only inventory in my godown. Though that inventory is not in my godown, though it is with consignee, it belongs to me. So I would have to add it. One question in your material, it has ulta adjustment. You have received the goods on consignment. So you are the consignee. If you have received the goods on consignment, are you the owner? You are only keeping possession of the goods. It is there in your godown. When you count the inventory, that is also counted. But does that belong to you? No. What should you do? Deduct. What should we do? Deduct. This is the adjustment with regard to goods sent on return or approval and consignment. With this understanding, if you go back and then solve those problems, you will be surely able to solve that problem without any difficulty. Can we go ahead now? We are done with inventory actually, but we'll see that RTP question on inventory. RTP lane question is there. There is a trader who has purchased goods. Okay. A trader has prepared his accounts on 31st of March every year. Due to some unavoidable reasons, no stock taking could be possible till 15th April. So where have they taken stock taking? 15th April. When are we trying to find the value of inventory? 31st March. Are we going forward or are we coming back? We're coming back. So remember, we're doing backward. Inflow will be deducted. Outflow will be added. Total cost of goods in the godown came to how much? 50,000. On what date? 15th of April it is 50,000. 15th of April it is 50,000. This is question number 6. Let me make some small notes here, not in detail. Yeah, observe. Physical inventory as on 15th of April, 50,000. Everyone understood this? Say something. Okay, very good. What is happening after this? Sales is 41,000, including cash sales 10,000. We don't care whether it is cash sales or credit sales. We don't care whether it is cash sales or credit sales. Sales is outflow. Sales is, but we are doing backward. So I will add. Did you understand why am I adding sales? Nobody has doubt with this. So I will add back sales. I'll mark whatever I picked into green color. Is that fine? So I will add sales. How much is that sales? 41,000. I'm writing it add, but I am not actually adding it. Why am I actually not adding it? We should do it at cost price. We should do it at what price? 41,000 is selling price. 41,000 is. So I'll adjust sales return, then I'll eliminate profit and then I'll add. What is the next adjustment? Purchases 5,034. Doesn't matter cash or credit. Purchase is how much? 5,034. Purchase is usually added. But because it is backward, what do we do? Deduct it. I'll write minus purchases. How much? 5,034. There is no adjustment of selling price, profit and all in purchases. Purchases is always at cost. Am I right? Third adjustment. Sales return 1,000. Sales return 1,000. I can treat it like purchase or adjust it from sales. It will become easy. It will become easy if I adjust it with sales. How much is sales? 41. In that return is 1,000. Net sales will become 40. So from sales I'll eliminate 1,000. Please don't try to add sales return here separately. Why? This 1,000 is at selling price. We should eliminate profit from that 1,000. There is a very high likely possibility that you will forget profit margin if you treat it separately. So always remember sales return deduct from sales. Purchase return deduct from purchase and then take the net purchase or net sales after profit adjustment to output. So from 41,000 sales, I'll eliminate sales at 1,000, making it 40. Okay. Then what do we have? On 15th of March, goods of sale value 10,000 were sent on sale or return basis to a customer. Now I have sent these goods. Have I sold or have I sent? Does those goods belong to me or to my customer? Belong to me. When will it belong to my customer? When he accepts the goods by saying yes, or time to return the goods lapses. Unless until they mention the time has lapsed, or he has told yes, it is not sales, it completely belongs to me. Am I right? Continue. The period of approval is 4 weeks. That is, time is there till 15th of April or sometime. He returned 40% of the goods by 10th April. He returned it by 10th April, how much? 40%. So out of 10,000, 40% has come back to me. When did it come? When did I count the inventory in my godown? When did I count? 15th April. When did I count? 15th April, when I counted the stock in my inventory. Have I counted that 40%? Yes. Why? It came on 10th. I counted on 15th. So 40% is already included. Before I add 40%, how much of that 10,000 belongs to me? Entire 10,000. How much is my inventory? Entire 10,000. Does 10,000 belong to me? Why are you saying no? 10,000 belongs to me. Have I sold it? I've only sent it. Only possession has been transferred. Ownership is still with me. Entire 10,000 belongs to me. By 10th April, he returned 40%. 40% when I counted on 15th of April, it's already there. How much should I additionally include now? Very good. How much should I additionally include? Did you understand? Now continue reading. Approving the rest. The customer was billed on 16th April. Doesn't matter. Why? We're finding the inventory as on 31st of March. As on 31st of March, has he accepted it? No. 31st of March, entire goods will belong to me. So entire 10,000 should be taken in my inventory. When I counted on 15th April, 40% is already counted. 60% is not counted because it is there with customer. I should add that 60%. How much is 60% of 10,000? But that 6,000 is that selling price. I should eliminate a profit margin and then take. So I'll add 6,000 by writing it here. Did you understand this? Goods sent on return or approval basis, selling price 60% should be included. Then trader also received goods costing 8,000 in March for sale on consignment basis. So we are consignee. Who are we? We have received goods worth 8,000. Are we the owner? We are not the owner. What do we have? Only possession. What do we have? Is it my inventory? No. When I count the inventory on 31st of March or 15th of April, will that be there in my godown? Yes. Would I have counted that? Yes. But is it mine? No. What should I do? Minus. Correct? Huh? But read further. 20% of the goods have been sold by 31st March. So 20% goods have gone out of the factory, out of the godown. How much is there in the godown? Only 80%. So in the closing stock, how much will be there? 80. How much should I eliminate? 80%. 80%. 20% is gone. 80% is there in the factory. When I count, how much would I counted? 80. So how much should I eliminate? Understood? That is not over. Further they're telling another 50% is sold by 15th April. When am I counting the inventory? By 15th of April, 20 and 50, 70 is gone out. How much is there on 15th of April in the godown? On 15th of April, when I'm counting, how much is left out? Does that 30,000 belong to me? Whom does it belong to? Consignor. Who am I? Consignee. When I took that opening balance, whatever we counted here, that 50,000, that includes this 30%, which will eliminate now. 30% of 8,000 is how much? 2,400. 8,000 into 30% is not 24,000. How much is it? 2,000. 2,400. Let us deduct. Shall we deduct 2,400 here? That's it. Minus. And finally, they have given profit is 20% on sales. Here we have sales, no, 40. Profit of 20% you deduct. 8,000 damar. 40 minus 8, 32. Here we have sale price of 6,000. Eliminate profit of 20%. 1,200 if I eliminate, what will I get? 4,800. That's it. Everything is done. 50 plus 32 minus 5,034 plus 4,800 minus 2,400 will give us 79,000. 366. Did everyone understand? Pakka? Very good. That's how we find the value of inventory. I've given a small note to understand the concept of goods sent on return or approval basis also. In case you read this, you will understand. I'll share this complete solution for this particular question to you people later. Yes, sir. Same question is there with different numbers or same numbers? Same numbers. Whatever. Even if it comes in the exam, just don't tell same numbers. I won't solve. Same question is there. ICS study material. Don't write like that. Please write. No. ನೀನ್ ಮಾಡಿದೆ ಅಂತ ಹೇಳ್ತಿಲ್ಲಪ್ಪ ನಾನು ಜನರಲ್ ಆಗಿ ಹೇಳ್ತಾ ಇದ್ದೀನಿ. If you would have done the same question, let's say RTP question, something comes for the exam. Don't tell same question is there in RTP. Refer question number 6. Don't write like that. Write your answer. It's okay. Then they will say same result like what happened last time. Check your last time result. Don't play games with ICI. Okay. Then by this we are done with our valuation of inventory also. So next in we would have to do depreciation. Tomorrow na? Jasti aita ivattige. But are you happy with what we did? Does this give you a sense of satisfaction that yes, we have done something in class today? Very good. So let us start with depreciation and amortization in tomorrow's class. I'll quickly run you through methods of depreciation and how depreciation is computed. We'll do an RTP question. Amortization is something new. There will spend little time on amortization. I'll tell you how is amortization different from depreciation, and that one new problem what is in the material we'll just glance it through because it is newly added. Then we'll do bills of exchange, final accounts, NPO and incomplete records. Is that all fine with you all? So we plan to do 1, 2, 3, 4, 5. We have done only 1, 2, 3, 4. I hope that doesn't leave you unhappy at the end of the day. Good enough? Did it help you the last few hours of discussion on 1, 2, 3, 4? Please go home and then solve questions on 1, 2, 3, 4 and then ensure that you practice it today only. Then hoping you all to get a good night's sleep and hoping to see you all tomorrow in the class on time. So did you guys learn something new today? Did you guys have little fun today? Remember, life is not a battle to be struggling. It's a game to be enjoyed. Till the time you're learning something, you're having fun. It's all good. The day you guys stop learning something new or you stop having fun, trust me, you might start struggling because you might be in a battle. So thumb rule to stay happy is pretty simple. It is to stay in the game. So for one last time on this day, I have just one simple question for all of you. Are we in the game? Are we in the game? Come on to the top of your voice. Are we in the game? That's it, guys. Tada, bye-bye. Take care. See you all tomorrow in the afternoon at 3 p.m. Till then, have a great time. Get lost. Bye. For people watching it on YouTube, I hope it was helpful to you people too. See you all tomorrow at 3 p.m. on the same YouTube channel. Till then, take care. Bye-bye. Good afternoon, everyone. Yes, it's indeed a very good afternoon. Welcome back to CA Foundation Marathon Revision. We were discussing CA Foundation accounting in yesterday's session of Marathon Revision as well. And yesterday we finished 1, 2, 3 and 4. So we had to finish 5, but we were overboard with regard to time. So today let's start with 5. That what we had to do yesterday. So 5, 6, 7, 8, 9 is the target. Let's see how much can we do. Hopefully we should be able to do 5, 6, 7, 8, 9. I don't want to keep anything more than 10 and 11 for tomorrow. That itself is good enough for tomorrow's class. So can we get started with chapter 5, depreciation accounting along with amortization? I didn't get any yes. Depreciation accounting previously was a chapter which dealt only with depreciation, but now that has another word along with it. Depreciation along with amortization. So initially our discussion will be about depreciation. Towards the end of the topic, I will tell you what is amortization, how is it different from depreciation, and how are we going to amortize an intangible asset. So to begin with, depreciation. What is the accounting concept that we discussed yesterday which provides for depreciation? We discussed 10 concepts yesterday, if you remember. Can you recall as to which concept is most important when it comes to depreciation, or what concept enables us to charge depreciation? It is matching concept. If in case you purchase an asset once and you record that asset in the balance sheet asset side, and you don't write it in P&L account because it is a capital asset, and you use that asset in your year to year production, and using that production you sell the goods, you make the revenue, you earn the revenue, you earn the income, it's written in P&L account credit side. But on the debit relating to the income, there is no expense. That expense is systematic apportionment of the asset from the balance sheet to P&L. So depreciation is provided in order to ensure that we compute correct amount of profit. If in case you don't provide for depreciation, the value of the profit that you find in your P&L account by writing income from sale of goods will be incorrect. So depreciation provides for matching of current year expenses with current year income, because you buy the asset 1 year but you use it over 10 years. So that asset's useful life is 10, the asset's utility is 10, asset's value has to be apportioned over 10 years. How to apportion, that is what we'll learn in this chapter. So that apportionment of the entire cost of the asset over the useful life has to happen in a systematic manner. That systematic manner is what we call as method of depreciation. So what is depreciation? In simple sense, it is decrease in the value of the asset. Why do we decrease the value of the asset? To ensure that we systematically allocate the cost or the depreciable amount of the asset over its entire useful life. This definition is actually given in Schedule 2 of Companies Act 2013. Then talking about why do we provide for depreciation? There are several reasons, like wear and tear of the asset, technological decrease in the value of the asset, effluxion of time, change in technology, change in trend, change in consumer needs. So there are several reasons why the asset can be depreciated. The objective is to show the profit at the correct value. If I buy an asset for 1 lakh, I write it in the balance sheet asset side, use that asset in my business and write the income that I earn from asset as my profit, I'll be doing a completely wrong thing. What should I be doing? I should apportionate that asset in my P&L account over the useful life, so that it will get matched with the income that I earn to find the profit. So the objective is to show the correct income in our profit and loss statement, and also to show the correct position in the balance sheet. I purchased an asset for 1 lakh 3 years ago. Since 3 years it's there in my balance sheet at 1 lakh rupees only. Do you really think the value of the asset remains 1 lakh even after 3 years? No, there is decrease in the value of the asset. You have to provide for such decrease in the value of the asset, and that is done by providing for depreciation. So true position of the financial statement will be known only when you write the asset at its depreciated value and not at its original value. And if in case you record the asset at 1 lakh, then you use that profit completely for distribution as dividend, or use it for some other purpose. At the end of the useful life of the asset, when the asset is thrown, you would not have any money to replace that asset. However, when you provide depreciation, your profit will decrease. So you get to know that though you have cash of 50,000 in your balance sheet, profit is only 20. So remaining 30,000 what is there in cash but it's not there in profit is not your profit. So much of cash has to be kept aside in order to arrange for funds for replacement of the asset at the end of its useful life. So that replacement of the asset will be done only and only if you provide for depreciation. If not, you think every rupee of cash in your balance sheet is your profit. Do you get it? So you need to keep some money aside for replacement of the asset, and that's possible only if you provide for depreciation. And if you want to know what is the value of each unit you produce, you have to allocate depreciation to that asset. Now, whenever you depreciate plant and machinery, you write it in your manufacturing account debit side. If you don't write that, from the manufacturing account to trading account, what you transfer, no cost of production, that will be incorrect. So in order to realize and in order to understand the cost of production of a unit, we have to provide for depreciation. So that is the reason for depreciation. Looking at on what is depreciation charged. Depreciation is charged on fixed assets. We won't charge depreciation on intangible assets. On intangible assets, we charge something called as amortization. Previously, we used to use the word fixed assets. Now we use the word property, plant and equipment. What is a new word in the place of fixed assets? PPE. Previously, there was a standard by name Accounting Standard 10 that used to talk about fixed assets. And there was Accounting Standard 6 which used to talk about depreciation. In the recent times, means like almost half a decade or slightly more than half a decade ago, about 7 years now, the standard which dealt with fixed assets, A10, got removed. And standard which talked about depreciation, A6, also got removed. In the place of both, we have one new standard called as Accounting Standard 10, which is named as Property, Plant and Equipment, which talks about fixed assets and their depreciation. So we now have only one standard, that is AS10 PPE. It's not fixed assets. What is it? PPE, Property, Plant and Equipment. Then After this, we need to understand the meaning of the word property, plant and equipment. What is property, plant and equipment? Like fixed assets, PPE is a tangible asset. What is PPE? Tangible asset. But it is called as a PPE when it is used for one among the following purposes. It can be used for renting, it can be used in administration process, or it can be used in producing goods or rendering services, provided its estimated useful life is greater than 12 months. So it's a tangible item which is held for the purpose of production of goods, rendering of services, administrative purpose or rental purpose, and provided that its useful life is for a period longer than one accounting year, that is greater than 12 months. Only then it will be called as PPE. So when do we call an item as PPE? When it is tangible, it is used for production, rendering services, rental purpose or administrative purpose, and its expected useful life is greater than a period of 12 months. That's when it's called as property, plant and equipment. And you will read this in detail in Accounting Standard 10 in CA Intermediate. For now, let us see the kind of important factors that you should consider before you charge depreciation. So depreciation is dependent upon these three factors. Number one, cost of the asset. Number two, estimated useful life of the asset. Number three, residual value at the end of its useful life. Let us say the cost of the asset is 1 lakh and useful life is 10 years and scrap value or residual value is 10,000. So 1 lakh is the value of the asset, 10,000 will be the value at the end of useful life. So 1 lakh minus 10,000, what we get, 90,000, is called depreciable amount. So this 90,000 will be depreciated over 10 years. Are you getting it? 1 lakh is the cost of the asset, a residual value is 10,000, useful life is 10 years. So out of 1 lakh, 10,000 is what you will realize at the end of the useful life if you sell. So 90,000 is the total decrease in the value of the asset over the period of 10 years. So 90,000 has to be depreciated over 10 years. How to depreciate? Would you write 9,000 every year, or would you write 15,000 in first year, 13 in second year, 12 in third year? That is it, are you writing decreasing or are you writing same amount, or are you finding any other pattern? That is chosen by method of depreciation. But these are the three important factors what will decide how much is the amount of depreciation that you will charge every year. Are you getting it? So then comes the methods of depreciation. So before going for methods of depreciation, cost will include purchase price, directly attributable cost and estimated cost of dismantling. So this will skip for now, because if we try to do every bit of the theory that is there in the topic, then I'll take 3 to 4 days only to finish depreciation. Yeah, methods of depreciation are several. However, as per Accounting Standard 10, property, plant and equipment, what you learn in Inter, the methods that are allowed are only 3. Straight line method, WDV method and production units method. However, in your CA foundation, you have several methods. You have to learn what is straight line method. You will learn what is return on value method. You have production units method. These three are the methods which are accepted by Accounting Standard 10. In Inter, you will do only these three and nothing other than these three. However, in foundation, you will continue to learn something called as depletion method, machine hour rate method, and sum of year-digits method. These are the other methods that you have. So we'll try and understand each method in detail. Are you ready? How many methods do we have? Straight line method, diminishing balance method, production units method, machine hour rates method, depletion method, and sum of year-digits method. This 6 method is what is there in your CA foundation syllabus. But what is continued to be read in CA Inter, what is part of AS10? Only 3 methods. What are the 3 methods? Straight line method, diminishing balance method, and production units method. Shall we start with straight line method? Straight line method, as the name itself says, no, depreciation is a straight line. Depreciation is a straight line. See, year 1, year 2, year 3, year 4. If I draw a chart for the depreciation expense charged to P&L, it will be a straight line. First year depreciation, second year depreciation, third year depreciation, fourth year depreciation. Everything is same amount. How are we charging the same amount as depreciation? We are charging this because we are under a notion that the effective utility of the asset over the useful life is same. The usage of the asset over the useful life is same. The benefits taken from that asset is same. So the amount that we are charging as expense is also same. Going back to our example, I told you 1 lakh is the cost of the asset, 10,000 is its scrap value, depreciable amount is 90,000, meaning over the entire useful life I must charge depreciation on 90. That 90,000 I will charge depreciation over 10 years. Depreciation for each year will be 9,000. 90,000 divided by 10. Each year depreciation will be how much? 9,000. So depreciation charged to each year's P&L account will be same. Observe this. I'll tell you how it's computed. Depreciation for year 1, year 2, year 3 is same. Depreciation charged in each year during the useful life is completely constant. How do we compute this? Very simple. Depreciation per year is equal to original cost minus scrap value divided by useful life of the asset. How do we compute depreciation? Original cost minus scrap value divided by expected useful life of the asset. Then how is depreciation computed under next method, that is written down value method? Under this method, the depreciation will be very high in the earlier years and it will go on decreasing from year to year. This is because we believe that the utility of the asset is better in the earlier years. The production capacity, the efficiency of the asset is high in the earlier years. As the time progresses, it goes on decreasing from year to year. So we call it written down value method. What do we call it? Written down value method, or the other name is diminishing balance method. What is the other method? Or you also call it as reducing balance method. So either of the ways you call it, no matter what name you give, the method is same. So under this, like I mentioned, depreciation of year 1 is more than depreciation of year 2. Depreciation of year 2 is more than that of year 3. Depreciation of year 3 is more than that of year 4. From year to year, depreciation will go on decreasing. Yeah, you would have to be quiet. If not, can leave the place. Please don't make me tell this. Yeah. So like I mentioned, depreciation is more in year 1, less in year 2 in comparison to year 1. It is going on decreasing from year to year. How do we compute depreciation under written down value method? We'll do 1 minus nth root of residual value divided by cost of the asset. 1 minus nth root of residual value divided by cost of the asset. Here n is number of years useful life. Residual value is value at the end of useful life. Cost, original cost, we know, no, purchase price plus the cost, expected cost of dismantling and directly attributable cost. So this is how we find the value of the depreciation. So this is how we find the depreciation amount to be charged each year. When we do this, we actually get depreciation percentage. That percentage will be applied on the written down value or book value, not on the original cost. Let us say when you do this formula, let's say you get 10% as the depreciation. How much percentage? 10%. First year when the original cost of the asset is 1 lakh, you do 1 lakh into 10%, 10,000 as depreciation, value becomes 90. Second year 10% is not applied on original cost of 1 lakh, but it is applied on the written down value of 90,000. And that is how we compute depreciation under which method? Written down value method. Do you understand the difference between original cost and WDV? Very good. And you won't get questions to compute percentage of depreciation. Usually they give the percentage of depreciation. We just have to do computation. Okay. Once we are done with this, I'll make you do one question also from our material. There was one question in RTP which is on WDV method, if I am not wrong. Shall we finish it now only? Come on, let's see. So this is our RTP recent attempt. There's a question on depreciation, and we have a similar question in our class notes also, if you can recall. Trucks, 10 trucks, each truck costs 5 lakh, 4 lakh 50, 45 lakh. Together it costed 4 crore 50 lakh. Very much same example, but it's here it is 25 lakhs each. Shall we quickly do this answer and then continue our methods of depreciation? So after we do this question, we'll do the remaining methods of depreciation, and then once we finish our once we finish our remaining methods of depreciation, we will also do revaluation of the asset, change in the method of depreciation, and change in useful life, all those questions, and finally amortization topic also. Clear? Say something. Very nice. So start reading this. Mohit Transport Company purchased 10 buses at rupees 25 lakh each on 1st July 2020. This is on 1st July 2020 they purchased. 1st of October 2022. So 2020 no problem, 2021 no problem. In 2022, after 9 months, one of the bus involved in an accident. So whenever we do the ledger account, remember before you do ledger account, you must do working note. This is not second PUC. You don't say that I'll straight away do the working, we straight away start with the ledger account and in the ledger I'll do adjustments. You will get stuck. You will get stuck. And majority of the students usually skip doing okay. Fine. So what was I telling? Majority of the students, what they usually do is they'll try to skip doing working note, expecting that they will save time. But what usually happens is whenever you skip working note, no, you'll actually spend more time. That is 3 additional marks. Because you wouldn't know in computation of profit, in computation of depreciation, what item have you done wrong. So always ensure that you do working note properly before you go about and then solve your ledger. So always don't forget, whether it is easy or difficult, do working note. It will save time. Doing working note will save 3 months of time. So please don't skip working note. So now when we do working note, we'll prepare working note with 3 columns. One is total column. One column will do for 9 buses. One column will do for 1 bus. Why one column for 9 bus, one column for 1 bus? The reason is very simple. 1 bus met with accident. 9 buses will be continued to be held. If you do 10 buses, 1 column, on the day on which the bus met with accident, we don't know how to remove that bus from the cost of our assets. So what do? We'd have to do 1 column with 9 buses and 1 column with 1 bus. Do you get it? Very good. So accident completed, received in the insurance company full settlement. On the same date, another bus was purchased. So in our working note, we'll have date, particulars, total column, 9 buses which will be continued to be held, 1 bus which will meet with accident, 1 more new bus that will be purchased in the date, on the date when the bus will meet with accident. And after that, company writes off 20% of original cost per annum. So basically method of depreciation is SLM. Sir, how do we get to know? They told 20% of original cost. 20% of very good. So 20% of original cost means method of depreciation is SLM only. Correct or not? The company observes calendar year as its financial year. If they would have not told this, then we had a question whether to take April to March. Now, though it's very clear, we should take January to December. So 2020, we buy the asset in July. So January, February, March, April, May, June, 6 months, no depreciation. Depreciation will start only from July. Got it? And July to December will provide depreciation. And after July to December depreciation is provided, in the next year, we'll provide depreciation from January to December again. Third year, asset is meeting with accident on 1st of October. So we'll provide January to September depreciation. And then 1st of October, we'll book the sale of asset. You got it? Very good. So come on, let's start 7th one solution. So this is our bus problem. Sorry, truck. Our truck problem this is. I'll eliminate the data here and I'll freshly write the data. I'm deleting it so that we can write it all again from the beginning. So this is happening in the books of Mohit Transport. In the books of Mohit Transport. So buses, like I told you, we'll open out of the 10 buses, not trucks. 1 bus and then 9 buses. Buses alla. And then 1 new bus will be purchased later. 1 new bus will be purchased later when one of the bus meets with accident. So what is the date on which these buses are purchased? 1st of July 2020. 1st of July 2020, let me write purchase. Purchase. What is the value of 1 bus? 25 lakh. Am I right? So 9 buses value will be 25 lakh into 9. 2 crore 25 lakh. 2 crore 25 lakh. Can I say the total will be 2 crore 50 lakh? Then let us provide depreciation. When is our year end? 31st December. It is not 31st March. If in case it was 31st of March, I would have depreciated till 31st of March 2021. Now I'll write 31st of December 2020. 2020. Let me write here less depreciation. SLM 10%. SLM 10%. So depreciation is 25 lakh multiplied by 10%. Urgent Martbedi, you should do months. It is July, August, September, October, November, December. 6 by 12. 20%. Okay. Sorry. 20%. I forgot. Sorry. How much is 25 lakh into 20% into 6 by 12? We get 2 lakh 50,000. Similarly, we'll depreciate this asset also. Shall we? This multiplied by 20% multiplied by 6 by 12. It is 2 crore 25 lakh multiplied by 20% multiplied by 6 by 12. 22 lakh 50,000. Do you guys get that? Now, I'll come to 1st of January 2021. I'll put the total. I'll put here minus so that it will be marked as minus. This also will be minus. Depreciation alva. It is reduction in the value of the asset. ಇಲ್ಲಿ minus ತೆಗಿಬೇಕಾವಾಗ. Oh God. Sir, where do we get this soft copy? Mayuri, I will share this at the end of the session. I haven't shared after yesterday's class. Maybe I'll share it today, or let me do one thing. I'll finish it till tomorrow, and then once more I'll share it in one copy. One simple PDF, I'll share it to you. Is that fine? Rather than sharing one today and then sharing one more tomorrow. Someone downloads second day's file and then says, sir, what you did on first day and what you did on day 3 is not there. So I'll share it once for all after tomorrow's class. So opening balance will be this. Then when is the bus meeting with accident? 2022. So 2021, no problem. 2021 is a good year. I'll write 31st of December 2021. I'll write the same thing, less depreciation. But the beauty in this time is I don't have to do that months. Correct? No. So shall I write 2 lakh 50, 22 lakh 50 as depreciation? Why? SLM, no? Same amount. I should freshly compute. Okay. Shall I do 22 lakh 50 into 20%? No. Why? 22 lakh 50 is WDV. We are doing SLM. So I should do 25 lakh into 20%. SLM. And here I would have to do how much? 2 crore 2 lakh 50 into 20%. 2 crore 25. I am testing you people. You are like, you are like mundi lying without even thinking. Multiplied by 20%. Isn't it SLM, guys? Tell me, isn't it SLM? Okay. Just a message. Vishal, whoever it is, try elsewhere. It and all doesn't work here. We are all RCB fans. We are loyal only. Try that elsewhere. Those cheap tricks don't work here. You guys don't know about RCB fans. Okay, 1st of January to 16 years, no cup. Still we didn't lose loyalty. Do you really think we'll fall for this cheap tricks? Yeah, we've been doing what I'm doing right now from 2015. I finished over 60 batches of CA CPT. CA Foundation, they have not kept count. So please, I don't count number of batches that I've got. And I don't know what are you talking about. Sorry, it doesn't make sense to me. Let's see, this asset, what will be the value? 1 crore 57 lakh 50 is the value of 9 buses and 17 lakh 50 is the value of 1 bus. Am I right? Very good. So after 1st of January 2022, we need to be cautious here because the asset is sold on 1st of October 2022. Actually not sold, met with accident. Only 1 bus met with accident. So we will provide depreciation only on that 1 bus. Rest of the buses are working fine. We will not charge depreciation on them on 1st of October. We will provide depreciation only on 31st of December. So 1st of October 2022, shall I provide depreciation only on that 1 bus which is meeting with accident? That is the reason I opened one separate column here. Everyone got it? Come on, let's provide for depreciation on that 1 bus. How much is the depreciation on that 1 bus? 17 lakh 50 into 20%? 17 lakh 50,000 into 20% into 9 by 12. Correct? No. 25 lakh into 20%. Correct? 25 lakh into 20% into 9 by 12. 25 lakh into 20%. Original cost. 9 by 12 yake? It is sold in, it met with accident in October. So it is used only till September. How much is it? 25 lakh multiplied by 20% multiplied by 9 by 12. 3,75,000. Not to forget minus. Got it? So here let me write the total. So this truck became 0. Now this truck column is there, no, 17,50,000 column. This has to become 0 here. When I write book value here on 1st of January 2023, this has to become 0. Why should it become 0? Because the truck is removed, no, it's no longer there. But do this 17,50,000 minus 3,75,000. What do we get? 17,50,000 minus 3,75,000. What do we get? 13 lakh. 13,75,000 is still there. So to make it 0, I have to do minus 13,75,000. Correct? So basically that less is sold, or what do you say, damaged in accident. We are going to remove it. That's when it will become 0. 13,75,000 is the book value of the bus when it got damaged. How much is the insurance claim we got? 17,50,000. Oh my god, there is profit. And yako doubt bartade. Is this accident, or is like intentionally they made it, or they made it look like an accident? Why they'll get profit? No. Good idea, no? Buy a bus, do accident, receive insurance claim, make profit. Now we need to identify how much is the profit on this. Yeah. So let me write book value of bus which got damaged by accident. What is the book value of the bus that got damaged by accident? 13,75,000. I'll write here. And now let me write sale price or insurance claim. I'm sorry. Insurance claim. How much is the insurance claim on this bus as per question? 17,50,000. Because the insurance claim is so high, we are going to make profit. Why are we making profit? Because insurance claim is greater than book value. Because insurance claim is greater than book value, we are going to make profit. 17,50,000 minus 13,75,000. This is our profit. Everyone got this? Now let's understand how to write journal entry for the same. We'll receive money from the bank. Or if you think insurance company has not paid it to you immediately, we can write insurance claim account debit. If you write insurance claim account debit, later we have to write bank account debit to insurance claim. I hope you got it. Either ways is totally accepted. You can write bank account debit to asset and to P&L, or insurance claim account debit to asset and to P&L. Okay. Bank account debit. How much? 17,50,000 is received. I will credit my truck or bus account. How much bus? 13,75,000. Further difference is there, no? Sorry, 7 ಬಂದ್ಬಿಡ್ತು. 7 ಕಳಿಸ್ಬಿಡೋಣ. See, all this only till the time it is RCB versus CSK. When it is no longer RCB versus CSK, no, any day Dhoni is Dhoni. Won't forget his contribution. But when it comes to RCB versus CSK, then we have our reservations in conversation about jersey number 7. 18 any day. King is a king. When it comes to RCB. When it comes to IPL. Otherwise, great respect to Dhoni. Yeah, 13,75,000. Got it? Danced crazily when Dhoni got out. And I also cried very badly when Dhoni got out. So I've seen both the emotions. We are Indians, known for this. So 13,75,000. This is done. Now, remember, whenever you're preparing ledger, I'll go on writing journal entries looking at the total column. I'll think of the journal entry, go on doing the ledger postings looking at the total column. When I come to this 13,75,000 column, no, remember we have to look at working note number 2 and then only pass the journal entry or ledger posting. Remember, whenever we come to this part, we should remember that we have done working note and we should consider that working note in our ledger posting. So just to ensure that I don't forget it, I'll write here working note 2. I'll write here working note 2. Okay, say something. This asset got damaged. What did we do on that same day? On the same date, another bus was purchased by the company for a sum of rupees 30 lakh. So let me write the same thing here. 1st of October 2022. Right here, add purchase. One new bus. What is the value of new bus? 20 Oh, 30 lakh. That is for the last column is for the new bus. And this is going to be plus, not minus. And end of their depreciation, 31st of December 2022. Shall I provide depreciation? Type mana. Depreciation. How do I provide depreciation? 25 lakh. Hey, this bus is sold. Ilde ro bus alli depreciation elli kodtira. There is no depreciation in this case. Why? That bus itself is not there. Bus depreciation khatam. Over here, 2 crore 25 lakh is the original cost. These 9 buses are there for entire year. So we'll provide as usual, normal 20% depreciation. 2 crore 25 lakh, whatever is here, multiplied by 20%. How much do we get? 45 lakh. And what about this bus? Yeah, we have to provide 30 lakh into 20%. But we bought this only in October. October, November, December. How many months? 3 by 12. 1 lakh 50. How much is total depreciation? 4 lakh 50, sorry, 45 lakh plus 1 lakh 50, 46 lakh 50,000 total depreciation. Once you do this, you will get the book value here as total. How many years ledger account have they asked us to prepare? We are on 1st of January 2023. Give the bus account for 2 years ending 31st December 2023. So we should do for 2022 and 2023. Got it? Then book value is there on this date. We have it for individual buses also. Do we? Sorry, this has become 0. This hasn't. This has some value. Yes, boss. Yaudu? Oh, this is minus. This is not taken as minus. Okay, minus of minus plus agutide. It's taken as minus of minus. So it's become plus. Okay. ಇಲ್ಲಿ plus is showing green color. Plus will be. Okay, now check the total. 1 crore 12 lakh 50 plus 28 lakh 50. Does it come to 1 crore 41 lakh? 1 crore 12 lakh 50 plus 28 lakh 50. Does it come to 1 crore 41 lakh? So it's absolutely perfect. There is nothing happening in 2023. Straight away go to end of the year. You started the year, you are now ending the year. Depreciation. How much depreciation? Here to 0. Why 0 here? Hey, asset is only not there. Yeah. Here, same 2 crore 25 lakh. Into how much? 20%. Two crore 25 lakh multiplied by 20%. We get 45 lakh, exact same depreciation. How about here? Do we charge depreciation? Yes, we do. On 30 lakh multiplied by 20%. Should I do months? Should I do months? No, why not? Because it is used for entire year, no? 30 lakh into 20%. Any doubts here on this, guys? 30 lakh into 20% minus 6 lakh. Say something. Okay. 45 plus 6, 51 lakh. That's it. So let's go to 1st of January 2024. Book value. This is actually closing value. But that's okay. 90 lakh is the total value of the asset. We'll check if we'll get individually also same thing. That 9 trucks, what is the value? 1 crore 12 lakh 50 minus 45 lakh, 67 lakh 50. And this one new truck, 28 lakh 50 minus 6 lakh, 22 lakh 50. Check 67 lakh 50 plus 22 lakh 50. Do you get 90 lakh? Working note is ready. Tan, tan, tan. I understand that making working note is taking time. But how much ever time you spent in doing the working note, no? Same amount of time you will save when you're doing ledger. Now when you're doing ledger, you don't need question. Only look at the date column, particulars column and total column. Plus is debit, minus is credit. Plus is debit, minus is credit. Just to go on splitting it into two sides. Ledger is ready. They've asked not for 2020. They've asked us to do it only for 2021 and 2022. Only this much. Only this much. This much is what we need. Rest of it we don't need. Will you look at this much? Okay, na? Yellow. This much is what you should look at. So keep looking at this yellow. We'll go on posting it. Yeah? Why? See, red you can't see, no? Red is blazing in fire. So balance brought down on what date? 1st of January 2022. How much is the balance brought down of the asset? 2 crore 25 lakh. Sir, how did it become 2 crore 25 lakh? I put formula to this set. 2 crore 25 lakh. You depreciated it 50 lakh. Balance will be 1 crore 75. Look at the ledger. 2 crore 25 lakh. You depreciated it 50 lakh. Balance is 1 crore 75 lakh. Date change ಮಾಡ್ತೀನಿ 31st of December 2022. 31st of 1 second. ಅಯ್ಯೋ ಏನಪ್ಪ ನೀವು ರೆಡಿ ಆಗೋದು ಬೇಡವಾ? ಟೈಮ್ ಕೊಡ್ರು, ರೆಡಿ ಆಗೋದು ಬೇಡವಾ? Okay, then 1 crore 70. I finished the movie yesterday. I watched it 5 days. 5 times, nahi, 5 days. 20 minutes, 20 minutes, 20 minutes, 20 minutes. So much patience, Allah. So much time. One shot, if I give so much of unproductivity, no. So whatever makes you happy, split it and then enjoy it. Like you get them, just look, no. Say, smell it, taste it, keep it down, savor it, enjoy it, let it get processed, let it exit your body, then take one more sip. Henge. Okay. 1 crore 75 lakh next year opening. Observe. Next year, there is depreciation of 3 crore 75 lakhs. I will do depreciation of 3 lakh 75,000. 3 lakh 75,000, no depreciation. After that, damage 13 lakh 75 minus 13 lakh 75. Credit side I should write 13 lakh 75. But credit side, I won't write 13 lakh 75 straight. I'll write 17 lakh 50,000 credit and 3 lakh 75,000 debit. See, I'll write 17 lakh 50 money received from insurance company, and in that 13 lakh 75,000 will become profit. Sorry, 3 lakh 75,000 will become profit. Is this right? So consideration received 17 lakh 50, in that amount of profit 3 lakh 75. Do 17 lakh 50 minus 3 lakh 75. How much? 13 lakh. 13 lakh 75 is minus. Got it? Then 30 lakh purchase is there, no addition. I'll write 30 lakh purchase, debit side. Cool. Then we have one more depreciation here. 46 lakh 50, and then we'll have 1 crore 41 lakh closing balance. Let me write here 46 lakh 50 depreciation, 1 crore 41 lakh closing balance. Next year opening will become 1 crore 41. I agree here the dates are wrong. This is 1st of October 2022. This is also 1st of October 2022. And over here 1st of October 2022. 1st of October 2022. 31st of December 2022. 22. Oh my God. Okay. മോനെ ഹാപ്പി അല്ലേ? യാപ്പി happy. Oh, yappy. So 31st of December 2022, 1 crore 41 lakh is the closing year. 1st of January 2023, it will be balance brought down 1 crore 41 lakh. Third year to nothing is happening. There is going to be depreciation of 51 lakh. How much depreciation now? 51 lakh. Let me provide 51 lakh depreciation, closing balance 90 lakh. Here also you see, closing balance 90 lakh. Easy. 31st of December 2023, 31st of December 2023. Got it? That's it, guys. This is our RTP question. Easy to do. They have asked us on straight line method. But let's go back to our presentation. Now we know how to do whenever there is purchase of the asset in the middle of there, sale of the asset in the middle of there, and all of that. Do a detailed working note and then do the problem. Is there more than one question in RTP? No, only one question. Then production units method. Under production units method, we believe that the usage of the asset or the utility of the asset is manufacture intensive, meaning if you produce more units, depreciation will be more, or if you produce less units, depreciation will be less. And useful life is not measured in terms of years. Useful life is measured in terms of units. What is the useful life of this asset? We won't say 10 years. We'll say this asset can produce 50,000 units. If you produce 50,000 units in 1 year, asset will be scrapped after 1 year. If you take 10 years to produce 50,000 units, asset will be utilized for 10 years. If you produce it over 8 years, how much for each year? Depends upon how many units are produced in that year. Are you getting it? So here the useful life of the asset is computed based on the production units. If the production increases, depreciation increases. If the production decreases, this is production units. Depreciation also will follow the same pattern. Higher production, higher depreciation. Lower production, lower depreciation. Okay? Very good. After this, under this method, how do we compute depreciation? We'll take depreciable amount, that is cost minus scrap value. That will be multiplied with number of units that we manufacture during the year and divided by the total useful life in terms of units. We will take cost and deduct scrap value, multiply with number of units that we produce during the year, divided by total useful life in units. That's production units method. Similar to this is something called as machine hour rate method. Only point of difference is in production units method, useful life is measured in terms of units. Under machine hour rate method, it is measured in terms of number of hours the machine will work. That is in production intensive unit. This is in service based industry, where the machine is used for certain number of hours. After certain number of hours, no, that machine is waste. So same to same, we'll do cost minus scrap value multiplied by number of machine hours run during the year divided by useful life in total in machine hours. Do you get it? Then we have one last method called sum of year digits method. Depletion method is same as production units, but depletion method is applied specifically to wastage assets or natural assets like mine, ore, all of these mineral resources, oil well, there we apply depletion method. Otherwise, what depletion method says no is exactly same as what production units method says, but it is only dependent upon what natural assets extraction. Okay, now that's it. Then let's go to sum of year digits method. Here, this is going to be little interesting. How do we compute depreciation under sum of year digits method? We need to know sum of year digits. What should we know? Sum of year digits. How do we find sum of year digits is the point. Before that, it's the same. Cost minus residual value multiplied by remaining useful life at the beginning of the year divided by sum of year digits. How do we compute? Cost minus scrap value multiplied by remaining useful life at the beginning of the year divided by sum of year digits. If the useful life is 5 years, beginning of the year 5 years is a useful life. We should not take end of the year. We should take at the beginning 5 for first year. Second year 4. 1 year is over, no? Then 3, 2, 1. Denominator sum of year digits. What is sum of year digits? If the useful life is 5 years, we should do 5 plus 4 plus 3 plus 2 plus 1. If the useful life is 8 years, sum of year digits is 8 plus 7 plus 6 plus 5 plus 4 plus 3 plus 2 plus 1. Too many to do, no? How do we do this? There is a simpler formula to do. The formula is n plus 1 into n divided by 2. 5 plus 4, 9. 9 plus 3, 12. 12 plus 2, 14. 14 plus 1, 15. Do 5 into 5 plus 1 divided by 2. N into n plus 1 divided by 2. 5. 5 plus 1, 6. 6 into 5, 30. 30 by 2, 15. Same for 8 also. What is 8 plus 7 plus 6 plus 5 plus 4 plus 3 plus 2 plus 1? 8 plus 7, 15. 15 plus 6, 21. 21 plus 5, 26. 26 plus 4, 30. 30 plus 4, 34. 34 plus 3, 37. 37 plus 2, 39. 39 plus 1, 40. Do 8 into 8 plus 1. 8 plus 1 is what? 9. 8 9s are 72. Divided by 2. 36. Now ತಪ್ಪು ಮಾಡಿದ counting. 4 count ಮಾಡಿಲ್ವಾ? 2 times. Minus 4. 40 minus 4. 36. So 36. Did you understand this? Yeah. See, maths teacher alla. ಕರೆಕ್ಟ್ ಆರ್ ನಾಟ್? ಮ್ಯಾಥ್ಸಿಗೆ ಮ್ಯಾಮೇ ಕರೆಕ್ಟ್, ನಮೀಗ ಆಗೋದಿಲ್ಲ. ಕಷ್ಟಪಟ್ಟು ಪಾಸ್ ಮಾಡಿದ್ವಿ ಮ್ಯಾಥ್ಸ್, ಅದೇ ದೊಡ್ಡ ವಿಷಯ. ಅದ್ರ ಮೇಲೆ ಮತ್ತೆ ಮ್ಯಾಥ್ಸ್ ಹೇಳ್ಕೊಡ್ದು ಹೋಗಿ. So what I'm trying to tell is we can do like this: 1 plus 2 plus 3 plus 4 dot 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 plus 99 plus 100 is equal to n. How do we find sum up to 100 digits if the useful life is 100 years? Same thing ulta bariri. 100 plus 99 plus 98 plus 97 plus 2 plus 1 is equal to n. Correct? Now take the total. 100 plus 1, 101. 99 plus 2, 101. 98 plus 3, 101. 97 plus 4, 101. 2 plus 99, 101. 1 plus 100, that is nothing but, if you add everything, you will get 2n. How many times is it 101? 100 times. How many times? It is 101 into 100 times is equal to 2n. So n is equal to 101 into 100 divided by 2. That 101 is actually 100 plus 1. That is nothing but, if you want to find sum of 100 numbers, we are doing 100 plus 1 into 100 divided by 2. If you want to find sum of n numbers, we should do n plus 1 into n divided by 2. So in this formula for computation of depreciation, we'll do cost minus residual value multiplied by remaining useful life divided by sum of year digits, where sum of year digits is found as n plus 1 into n divided by 2. Clear? Very nice. So that's what you should know when it comes to sum of year digits method. You understood all the methods of depreciation. Remember very clearly, methods of depreciation is not an accounting policy, it is an accounting estimate. Can you change method of depreciation? Yes. When do you change? Whenever there is change in the usage pattern. Why? Because which method among these 6 will you pick? How will you decide which method to follow? That is based on the usage pattern of the asset. If the usage pattern of the asset is straight line, you will follow straight line method. If the usage pattern of the asset is WDV, if the usage pattern is dependent upon production units method. So however is the usage pattern of the asset, in that method, that's how we pick that method. And if the usage pattern changes, we will change the method of depreciation. Did you get it? Fantastic. After this, you should know what if there is change in useful life of the asset, change in method of depreciation, and change in scrap value. Like I just mentioned, change in the method of depreciation is change in accounting estimate. Let's say for the first 3 years or 4 years you followed SLM. Then you understood, IIO, my asset should be depreciated in a WDV. What do? First 3 years you did SLM. Don't change that. After 3 years you have some book value. Using that book value, from now you go on doing WDV method. Or reverse. First 3 years you did WDV. After that you realized SLM is the correct method. 3 years WDV over. Now you have book value. That book value after 3 years of WDV will be now depreciated in the straight line method. First 3 years, what is over is over. We don't touch it. Do you get it? Then remember, it's change in accounting estimate. We should give what effect? Prospective. Means from now we should change. We should not change the history. We cannot change the history, but we can rewrite the future. And in the future, there is red color jersey holding the cup. Don't forget. Yeah, ee sala namde. An organization has machinery bought for 1 lakh rupees with useful life of 5 years. Scrap value is 0. If 1 lakh is the cost, scrap value is 0, and then useful life is 5 years. How much is depreciation? 1 lakh minus 0 divided by 5. How much? 20. Correct or not? They followed SLM for first 2 years. 1 lakh. First year depreciation 20, closing 80. Second year opening 80, depreciation 20, closing 60. Third year we started with 60. We changed the depreciation to WDV 25%. Now what do? That 60,000 is there, no? On that we should charge 25%. By mistake there it is typed as 20. Adjust madkodi. Either you imagine the question says 20 or you imagine that answer says 25. Don't imagine both. Sir, I'll think question they have told 20 and I'll think you would done 25. Either ways, you don't want to try to find a mistake. You do always want to try and find mistake in what I do, no? Yeah, don't do that, okay? Rectification of errors is over yesterday. So we'll do 60,000 into 25% or 20%, and any more we'll try to apply WDV method. Okay, na? Yeah. Don't look at that pink like that. Nale audio the pinky. Tomorrow pink only, no? Yeah. Expected useful life of the asset. See, expected useful life is an estimate. We think the useful life of the asset is 10 years. So we'll be depreciating for 10 years. After 6 years, we realize that remaining useful life is not 4 years. 10 years if you expect useful life. After 6 years, how many years should be remaining useful life? 4. Let's say asset value is 1 lakh. Useful life is 10 years. Scrap value is 0. How much depreciation for each year? How much depreciation for each year? Cost of the asset 1 lakh. Scrap value 0. Useful life 10 years. How much depreciation? 10,000 every year. So you depreciate for 6 years. 60,000 depreciated. How much is remaining? 40. What is remaining useful life? 4 years. What is remaining useful life? 40,000 has to be depreciated over 4 years. 10, 10, 10. They say remaining useful life is not 4 years. It is 2 years. So this 40 will be depreciated as 20, 20. Are you getting it? So you give retrospective effect from then. That's what estimated useful life change has to be dealt with. What if there is change in residual value? I'll tell. 1 lakh is the value of the asset. Scrap value 0. Scrap value? Useful life 10 years. You depreciated it for 6 years. How much is each year depreciation? 10. 6 years over. How much is remaining? 40. Am I right? Now, you re-estimated the scrap value and found that scrap value at the end of 4 more years from now is, let us say, 15,000 or 10,000. So 40 is there, no? In that 10 you will deduct. 30,000 will be depreciated over remaining 4 years. So you will change it as and when the estimate changes. Estimate changing is not our mistake. Estimate is H by estimate, no? So that changes, that's okay. You get that? So this change in useful life and change in residual value is also accounting estimate. Do you get it? Then I want you to note, this is an example. However, we are done with this. I'll run slightly forward. Revaluation of property, plant and equipment. If you have assigned some value to PPE and you believe that that value is incorrect, then you are allowed to change the value. You can change the value in 2 ways. One, you can increase the value, that is called upward revaluation. You can decrease the value, that is called as downward revaluation. If in case you increase the value of the asset, you write asset account debit because asset value has to increase. Credit will be given to something called revaluation reserve. But where do we give the credit? That will not be credited to P&L account. Why? Conservatism. However, alternatively, if you decrease the value of the asset, asset will be credited. Debit will be given to P&L account only. Why? Conservatism. The reason why we don't write profit to P&L account is the same reason why we write loss to P&L account. If there is profit by revaluing the asset upward, that profit will not be immediately returned to P&L account. It will be written in revaluation reserve. That revaluation reserve will be transferred to P&L account over the remaining useful life in the proportion to depreciation. Because let's say the value of the asset is 1 lakh. 10 years is the useful life. How much is the depreciation for each of the 10 years? 10,000. If in case I revalue the asset upward from 1 lakh to 1 lakh 10,000, next 10 years depreciation will be 11,000. 1,000 increase, no? That 1,000 increase for 10 years is 10,000 profit. I don't want to book 10,000 profit now and book 1,000 expense every year for next 10 years. So that 10,000 revaluation reserve also will transfer to P&L account over next 10 years. Okay. However, if my value of asset is going from 1 lakh to 90, that 10,000 will be immediately returned to my P&L account. End of the game. Clear? Increase in value of PP, asset to revaluation reserve. It will be transferred to revaluation reserve, transferred to P&L account over the remaining useful life. How about downward revaluation? Immediately P&L account debit to asset. Everyone got this? Any doubts? Very nice. So after this, we have to understand the concept of provision for depreciation. What is the next concept? Now, whenever we charge depreciation on the asset, what is the journal entry we write? Depreciation account debit to asset. Am I right? What are we doing to asset? We are crediting it. Are we crediting the asset? Yes, we are crediting the asset. If you remember the rule for real account, what does it say? Credit what goes out, or credit decrease in the value of the asset. Is the asset going out? You purchase asset for 1 lakh, you depreciated it by 10,000. When you purchase an asset for 1 lakh and depreciate it by 10,000, do you really think the value of the asset is there is a part of an asset which is going out of the organization? Is it going out of the organization? So instead of writing depreciation account debit 10,000, to asset account 10,000. We feel like this is not correct. This is not correct. So instead of writing to asset, I'll write to provision for depreciation account. You get it? Say something. I'll tell you how the journal entries look. Let's say cost of the asset is 1 lakh. Depreciation. People usually complain that this part is difficult. If you don't understand the logic, if you blindly try to solve, this is obviously going to be difficult. Let's say you sold the same asset after depreciation. Let's take 75,000. Okay. Then now will the entire accounting be with provision and without provision? Shall I show? So now let me show the data to you. First, I'll show your favorite method, without provision for depreciation. If we show it without provision for depreciation, how does it look? So we'll write depreciation account debit to asset account. Depreciation account debit to asset account. This is my first entry. After this entry, whenever I am selling the asset, let's say, let's assume that we prepare our P&L account and balance sheet after this, and then we sell the asset. Or shall I show straight away the depreciation? Straight away sale of the asset now after this. So after this, I'll write the entry as bank account debit. Bank account debit will be 75,000. I'll credit my asset account at what value? 90,000. Sir, why 90? 1 lakh was the cost of the asset. I've depreciated by 10,000. So what will be the remaining book value? 90. I'll credit the asset by 90. When I credit the asset by 90, there is some difference here. That is our profit and loss account debit. How much is that? This is how we do the entry without provision for depreciation. This is without provision for depreciation. I'll show you how to do the same thing with provision for depreciation. Are you ready? I'll write here with provision for depreciation. When I do with provision for depreciation, when I debit depreciation, I don't want to credit my asset. Instead of crediting asset, I keep the money in one account called as provision for depreciation. This is again because depreciation is not actual. It is estimated. It is estimated decrease in the value of the asset. How can I actually deduct from the cost of the asset? So in the balance sheet asset side, rather than writing asset at 1 lakh minus 10, I'll continue to write the asset at 1 lakh. That provision is an estimated amount what will be either deducted from the asset or written on the liability side. Actually, it is deducted from the asset, but it is separate ledger. Next year again, asset is 1 lakh, provision is 10. It is not like next year asset is 90. Asset will continue be there in 1 lakh. We won't credit the asset. We won't credit the asset for depreciation. We will credit the asset only and only if the asset is sold. Do you agree with me? So here I write the entry depreciation to provision for depreciation. And I'll write bank account debit 75. Now asset credit will not be 90. Asset credit will be 1 lakh. Asset credit will be what amount? Because asset is there at 1 lakh. Provision for depreciation, previously we had debited, credited alva. That we are closing now. So that is why I am going to debit my provision here like this. So instead of crediting the asset here 10,000, I credited provision here. That provision, whatever I credited here instead of asset, is closed by debiting here. And that's provision for depreciation. That is provision for. Did you understand the point here? What I am trying to make with regard to provision? So if you keep this in mind, you will find it very, very comfortable with regard to doing provision. You just need to get the basics of the provision concept correct before you do big problems. Some questions, they won't just ask you to do with provision. They'll ask you to do with the disposal account. What is this disposal account? I'll tell you why does disposal account come into picture. Same logic what we just discussed. Why do we write it to provision and not write it to asset account? Depreciation. because until and unless we sell the asset, we should not credit the asset. Now, what is the journal entry in the with provision method for sale of asset? Please help me with journal entry. What is the journal entry? Read no once. Please read. Bank account debit, P&L account debit, provision for depreciation account debit to asset. Am I right? In your asset ledger, what do you write this? How will the posting be in asset account? By bank, by profit and loss, by provision for depreciation. So you credited your asset account 3 times. Did you sell 3 assets? You sold 1. You sold 1 asset and you're writing 3 entries in asset account. For people who look at that, will feel like, oh, 3 assets. 1 asset is you received money. 1 asset written off to P&L. 1 asset provision and the asset values become same, so you made it 0. That is the misconception. You don't want them to feel like this. So what do? You route everything through one dummy account called as disposal account. You route everything through one dummy account called as what account? Disposal account. Closely observe this entry. I'll show with the disposal account. Whenever they ask you to open disposal account is a savior. This entry is there, no? I'll write the same entry. With little bit of changes. First, I'll take my asset account credit. I'll write here. You know what will I write? Debit. I'll transfer my asset to disposal account. Then provision is there, no? Provision will tell if asset is not there, what will I do here? I don't want to be there on this planet anymore. So then I'll take provision for depreciation and I'll credit it to disposal account. 10,000. Then whatever money you get, no, you don't know where to write now. So that money, whatever you get, you will write that also to disposal account. Now closely observe disposal account. Closely observe disposal account. What is happening in disposal account now? We debited disposal account by 1 lakh. Am I right? We credited it by 10 and 75. So credit 85, debit 1 lakh. What is missing? Credit of 15. Correct, no? So this profit, whatever we receive, no, 15. So one journal entry, you broke it into 4 parts. For every debit, you put 1 credit disposal. For every credit, you put 1 debit disposal. That is disposal account. Why do people get scared about disposal accounting? It is actually something very, very simple, straightforward and easy. We'll try to complicate it because we don't see this root level journal entry. We straight away see some big problem with lot of journal entries and lot of adjustments. So when you get this concept clear at the root level and then go to bigger problem, that will actually sound very simple and easy. You get this? That's it with regard to depreciation. Any doubts? Any problems? Then comes the beauty, amortization. What is it? For tangible assets, we do depreciation. For intangible assets, we do amortization. Actually, amortization as a word is much bigger than depreciation, similar to depreciation for intangible assets. Any expenditure, what is split and written over a longer period is called as amortization. Any expenditure which is split and returned to P&L account over a longer period is called as amortization. If you incur expense once, but it is returned to P&L account in small parts over a longer period, that is what we mean by amortizing, deferring and amortizing. Intangible asset, whenever we buy an intangible asset, maybe we buy one patent, maybe we buy one copyright or anything. Let's say the utility or economic benefit from that intangible asset is going to last for 4 years, 5 years or 6 years. The entire value of that intangible asset has to be transferred to profit and loss account over those 5 years or 5 years, 4 years or 5 years. So scrap value will be usually 0. So that value divided by 5 or divided by 4 you do, and then you go on writing. That's almost like straight line method. There is about 2 problems in your study material. Please go through them with this understanding. It is easy. It is like straight line method for fixed assets or tangible assets. We do it for intangible assets, and that's amortization. Okay. You want me to run you through that ICA study material question, or is it fine? It's actually comfortable, simple. You want me to do beta? One question. Okay. Let's see that quickly. We'll do the same question from the material. Are we taking a short 5 minutes break once we finish this? Then we'll do bills of exchange. Study material under the new scheme. We'll go to CA Foundation. Did you people read after yesterday's class? Was it helpful? Someone is telling, sir, say hi to Venkat. Okay, which Venkat? Yeah, I actually saw Venkat other day here near Signal in Jayanagar. Yeah, the Venkat that you're thinking. Depreciation and amortization. See here starts amortization. It is systematic allocation of depreciable amount over the useful life. See, they have given one question. Kumar R&D company registered a patent, and what is the cost of the patent? 28 lakh. Spend 2 lakh rupees towards legal fees. So the total cost of intangible asset is 28 lakh plus 2 lakh, 30 lakh. And it has to be depreciated amortized over 10 years. 30 lakh by 3 years. 30 lakh by 10 years. 3 lakhs per year. See, the depreciation or amortization every year is 3 lakhs. 30 lakhs divided by 10 years. Easy. Time pass. We should do open one ledger. Right, 28 lakh plus 2 lakhs, 30 lakh depreciation for 6 months. Because it was acquired in July. For the first year, we will provide only 6 months amortization. Depreciation 1 lakh 50. So balance will be 28 lakh 50. Next year opening 28 lakh 50. Amortization 3 lakh. Balance 25 lakh 50. Easy. We'll open like depreciation account, amortization account. Debit side will write 2 patent. Credit side will write by P&L. Okay. We have one more again. 18 lakh is the value of the intangible asset to be amortized over 10 years. 18 lakh divided by 10 years. 1.8 lakh per year. So it has been 3 years over at the beginning of 4th year. So at the beginning of 4th year means first 3 years amortization over. 1 lakh 80 into 3. 5 lakh 40. 18 lakh minus 5 lakh 40. 12 lakh 60. I am taking class from morning 7 o'clock to 2 o'clock one class. And my brain is running. Okay. Yeah, badam neeral nelsputtu belige tinkomani. Okay. It will increase your memory. You will become sharp. Everyone told that, sir, but nensode martobidtini, sir. Nenestini belige tinode martobidtini. How do you that is the problem, sir, memory. Yeah. Okay. Done. 18 lakh divided by 10. 1 lakh 80 is amortization per year. 3 lakhs, 5 lakh 40. 18 lakh minus 5 lakh 40. 12 lakh 60. 12 lakh 60 has to be amortized over remaining period of 7 years. Am I right? But they're saying at the end of that 4th year, no, based on the decline in the viewership, Prime Streaming Company decided to stream the movie only for next 5 years. So that 12 lakh 40, whatever is there, will be amortized over only 5 years. Do 12 lakh 40 divided by 5. What read? 12 lakh 60. Oh, sorry, 12 lakh 60 divided by 5. 2 lakh 50,000 will be the amortization for the next 5 years. That's it. These are the 2 questions that is there in your material. Now don't ask me, sir, why did you not do 12 lakh 60 by 5? I don't know to do like this and then tell numbers. That's it. Your depreciation and amortization unit is over. We have finished 1, 2, 3, 4 and 5. This one we had to finish yesterday. We did not. We took about 1 hour 10 minutes now and we are done. We'll take a short break, 5 minutes. It's 4:25, 4:32 or 4:33. I'll start with bills of exchange. The plan is before our next break, we should finish bills of exchange and final accounts and then take break. Too much? Okay. We'll finish bills of exchange and then take one break. Okay? Chalo. 5 minutes. There we go. We're back on the loop. Now let's start with chapter 6 of your syllabus, that is bills of exchange. We have now just finished the topic of depreciation. This is changing the place now. Depreciation and amortization now shifted to our second day. Can we start with bills of exchange? This chapter 6 was previously a very big chapter, special transaction. There was consignment, goods sent on return or approval, average due date, account current, whatnot, everything. Now everything died. Only one thing survived. Bills of exchange. Bills of exchange. So can we start with bills of exchange? To begin with, the reason for a bills of exchange to arise is not a cash transaction. What is a cash transaction? Whenever there is a seller and there is a buyer, seller gives goods to buyer, buyer gives cash to seller, the transaction is settled then and there. It is cash settled. There is no bill of exchange. Bill of exchange will come into picture when the transaction is settled without cash coming into picture. Meaning what? The cash settlement is actually postponed to a later date. There is a seller who will sell the goods to buyer. Buyer will purchase the goods, but buyer doesn't pay the cash immediately. Buyer will say that he will pay the money later. He'll pay the money. Then the seller can say, yes, okay, you pay the money to me later. But what if on a later date, the seller goes to buyer to ask for money and says, hi, how are you? You had purchased goods from me. Then the buyer will say, hi, but who are you? I don't think I purchased goods from you. Then if he doesn't even remember the fact that he has purchased goods, do you really think he will pay money? Definitely no. So just to ensure that he is at a safer place, seller, whenever he gives the goods and the buyer denies to give the cash immediately, seller has to ensure that he keeps that in writing. Seller will give the goods, will ask for money, paisa. Buyer will tell tomorrow. Seller will tell, wait, sign here. Sign here. Why should he sign? Saying that you will give tomorrow or will give after 3 months. What would I write in? What would I have written in that paper? In that paper, I'll write saying that I order you to pay me rupees 10,000 at the end of 3 months, and he will sign. I'll keep that paper with me. After 3 months, if he doesn't recognize me, I'll show the paper and see, okay, do you recognize your signature? You pay me money. If not, ನಮ್ಮ ನಿಮ್ಮ ಭೇಟಿ ಇನ್ನು ಮೇಲೆ ಕೋರ್ಟ್ ನಲ್ಲಿ ಆಗುತ್ತೆ. ನೀವು ನಮಗೆ 10,000 ರೂಪಾಯಿಗಳಿಗೆ ಕೊಡಬೇಕು. ನೋಡೋಣ ನೀವು ಕರೆಕ್ಟಾ ನಾವು ಕರೆಕ್ಟಾ. So he'll go to the court and then sue him and collect his money. And that piece of paper, what the seller prepares and gets it signed from the buyer, is what we call as a bill of exchange. What do we call it as? Very good. See, when he sends the goods, along with the goods, he'll send one paper. And that paper, what you see is bill of exchange. Closely zoom into this paper. That, my friends, is bill of exchange. We'll write the date there. 1st of December 2023. This is the date on which seller has sold the goods to buyer. He'll write there, I unconditionally order you to pay me or my order a rupees of 10,000 rupees after 30 days. And then I'll give the document to him. If he wants to keep the goods with him, either he should pay money or on the same paper, our buyer should sign and then give it back to me. Look at it. He would have signed here. What is the name of the buyer? Drawee. What is the name of the buyer? So the name of the buyer is Drawee. The name of the seller is drawer. The name of the seller is, and that paper is called as bill of exchange. The one who prepares it is drawing it, he is drawer. The one who receives that is drawee. The one who receives it is drawee. So now let's see what is bill of exchange. It is an unconditional order. It is an unconditional order. Whenever I am the seller and I give the goods to buyer and the buyer buys goods from me, and he says that he'll pay the money later and then I'll give this document. Why muchkon sign madu? You cannot say, I will sign if you give me this, I will sign if you change this. No conditions. You cannot say conditions. He cannot change anything in the document. He has to do only one thing. What is it? Shut up and sign. So it is an unconditional order, meaning the buyer cannot place any conditions. Look at the wordings there. It is not, I respectfully request you to promise me, I respectfully request you to accept, nothing. I order. I not just order, unconditional, meaning you can't even place conditions. It's a yes from my side, provided, no provided. If you change the date, if you change that amount, if you change this period, nothing, sign. What is it? Goods beka, sign. Ilva. Okay, go is the point. So I unconditionally order. What happened? Okay, so I didn't tell anything. Who's preparing this? Drawer. Who prepared it? Drawer is also called as seller. Drawer is also called as seller. And the person who receives it and then signs it is drawee. Observe here, prepared by drawer. And it is signed by drawee, accepted by drawee. Drawee is nothing but buyer. Under the word buyer, let me write the word drawee. So it is prepared by drawer, accepted by drawee. That is our buyer. And the next thing, this document is there, no? Accepted by drawee. And he has signed it. Observe here. Then for a specific amount, for a specified sum, you cannot say, I unconditionally order you to pay whatever I ask, how much ever I ask. You can't tell. You have to specifically tell the amount. See, observe this document, there is amount written 10,000. Whatever I ask means I'll ask 1.1, give me one kidney. You can't give, no, like that. So you'll ask for, what happened? Sir, already irodu one kidney, sir. Innondu damage agutide. Either on a specific date or at the end of a specific period. So what do you mean by at the end of specific date or at the end of specific period? I told him, no, you need to pay me rupees 10,000 rupees. When? After 30 days. After 30, that is a specific day. Instead of writing 30 days, or I can write, you should pay me 10,000 rupees on 31st of December. I can either write the date on which you are supposed to pay, or I can write the period at the end of which you should pay. So it is a bill which will become due at the end of a specific date or at the end of a specific period. Do you get this? To drawer or his order. See, I can ask my drawee or my sell or my buyer or customer to pay the money to me or anyone whom I direct him to pay. Let us say he is supposed to pay money to me, but I am not in India. I have gone on an international trip. He cannot say, I will pay to him only and only when he comes back I will pay. Till then I won't pay. He can't tell that. I will tell, I won't be there, I am not available, pay to this person. So he has to pay to that person. Sir, how do we say that? It is mentioned in the bill of exchange. Observe here closely. I unconditionally order you to pay me or my order. Or my, I can ask you to pay it to me or to the person to whom I ask you to pay, you would have to pay. So that, my friends, will make it, will make our buyer payer. What will he become? Payer. The one who's paying the money is payer. One who's receiving the money is payee. Always remember, the person who's receiving is called orally. EE will be there. See, this guy will give the document, is drawer. This guy is called the document, EE, drawee. This guy will pay the money, payer. This guy will receive the money, payee. Are you getting it? Transferer, the one who gives. Transferee, the one who's receiving it. Anywhere, consignor was there, no? Consignor was the one who's sending the goods. Consignee is the one who's receiving goods. So every placement, the one who's receiving the goods will always have EE. Okay, employee will receive employment. Employer will give employment. Then after this, what are the various dates involved in bill of exchange? People skip this part. They immediately run to solving problems, and that's where a lot of problems starts happening. You need to be very clear with certain dates that is involved in bill of exchange. What are the dates that is involved? First one is date of drawing. What is date of drawing? Date of drawing is the date on which bill is drawn by drawer. Date of drawing is the date on which bill is drawn by drawer. In our example, if you observe, see the date on which bill is drawn by drawer. One line definition. In this example, in this bill, that 1st of December is there, no? That is date of drawing. That is date of drawing. Next, what is date of acceptance? The date on which drawee signs and accepts it. The date on which drawee signs the bill and accepts it. So let's look at what is date of acceptance. Date of acceptance is the date on which drawee has signed and accepted the bill. It can be the same date as in date of drawing, or it can be a different date. You get it? But date of acceptance cannot be before drawing. Before even he gives the bill, how can I accept it? Yeah, before even you propose, someone says, yes, I accept your proposal. I didn't make proposal only. You are actually making proposal, not accepting it in that case. So drawee will accept only after drawer has made the order. It can be the same date or a later date. Got it? Now we know date of drawing and date of acceptance. The next question is, what do you mean by bill date? What is bill date? Date on which bill of exchange is made. And the date of drawing or date of acceptance. On the date on which it is made is date of drawing, alva. Is bill date same as date of drawing? Is it date of drawing? Is it date of acceptance, or is it something else? It is something else. Bill date is the date on which you start counting bill period. Bill date is the date on which you start counting the bill period. Now, when to start counting bill period? This depends upon the type of the bill. This depends upon the type of the bill. Bill can be bill after date or bill after sight. Bill after date or bill after sight. So that is what will decide whether bill date is date of drawing or date of acceptance. Observe. What is bill date? Depends upon the type of the bill. Bill can be bill after date, bill after sight. Bill after date and bill after sight. Bill after date means it becomes a bill of exchange the moment it is drawn. It becomes a bill of exchange the moment it is drawn. Even before our drawee accepts it, it's a bill. He has to accept. But the moment he accepts it, no, even before he accepts, no, it's already become a bill. Let's say the bill is drawn on 1st of December. Drawee accepts on 3rd of December. Still the period is counted from 1st of December only. That is bill after date. So for bill after date, bill date is date of drawing. Bill after sight means it will become bill of exchange and bill period starts being counted from the date our drawee signs the bill. So in that bill which was drawn on 1st of December, accepted on 3rd of December, bill period starts from 3rd of December if it is bill after sight. Bill period starts from 1st of December if it is bill after date. Do you get it? See this, for bill after date, bill date is date of drawing. For bill after sight, bill date is date of acceptance. Observe, bill after date. See there heading, what is it given? Bill after date. From when do we start counting the bill period of 30 days? From 1st of December. However, if the question says bill after sight, from when do we start counting our bill period of 30 days? It will start from 3rd of December. Why? Look at the heading, bill after sight. So that heading has to be there. Sir, if that heading is not there, then assume it to be bill after date. If it is bill after sight, they have to specifically mention that it is bill after sight. Unless it is specifically mentioned, it is always bill after date. You get it? Very good. Because it is the drawer who's in the commanding position here. Okay, bill date is over. Next, what do you mean by due date? Due date is the date on which bill is due for settlement. Due date is the date on which bill is due for, and this due date depends upon the type of the bill. This due date depends upon the type of the bill. What's our bill after date, bill after sight? Those are not the only two types of bill. It is bill with specific period, bill with specific date. What are the two types of bill for the purpose of due date? Bill with specific period and bill with specific date. What do you mean by bill with specific period? In the bill, a specific period is written, 30 days, 60 days, 45 days, 1 month, 2 months, like that period is written. When that period is written, bill date we find, no? That is date of acceptance or the date of drawing, whichever, depending upon the type of the bill. For that date, we add this bill period. If you add bill period, what arises is due date for bill with specific period. If it is bill with specific date, in the bill all by itself you mention the date. I unconditionally order you to pay me 10,000 rupees on 31st of December. I mentioned the date. That date what I mentioned is due date. Shall we see this? See what is bill with specific period? It's like this. So here they mentioned 30 days. 30 days. That is the reason it is bill with specific period. Bill with specific period. In this we'll take that 1st of December. We'll take that 1st of December which is bill date and add bill period of 30 days. How do we find due date for bill with specific period? We'll take bill date which is 1st of December and to that I will add bill period of 30 days. 1st of December plus 30 days. 31st of December 2023. Sir, how did you add? 1 plus 30, 31, 31, 12, 2023. This is bill with specific period. What is bill with specific date? Very simple. In the bill all by itself, you will mention the due date. Shall we see it? Quickly observe here. I unconditionally order you to pay me or my order a sum of rupees 10,000 on 31st of December 2023. How much is the amount? 10,000. On what date should I pay? 31st of December. Date is mentioned. No bill period. 30 days, 15 days, 1 month, nothing. 31st is the due date. 31st is the due date. Due date is the specific date so mentioned in the bill. Now tell me, how do we find due date? It depends upon the type of the bill. Bill can be bill with specific date. Bill can be bill with specific period. If it is bill with specific date, that specific date mentioned in the bill is there, no? That itself is due date. However, if it is bill with specific period, then we should take the bill date. To that we'll add the bill period. That's how we'll arrive at the due date. Clear? Everyone? Next, let me take you to the next date, last date. What do you mean by maturity date? Only for period. What do you mean by maturity date? Maturity date is the last date for payment without penalty or without interest. If you do delay beyond maturity date, then you have to pay compensation. You have to pay interest. You get it? So usually the misconception is, sir, maturity date is due date plus 3 grace days. Not in all the cases. In certain cases, due date and maturity date are same date. So what is maturity date? It is the final date for payment without any delay. Are you getting it? So this again depends upon the type of bill. Again depends upon the type of bill. If it is bill with specific period, 30 days, 45 days, 1 month, then 3 grace days is allowed. After the due date, you have 3 grace days within which you should pay. However, if it is bill with specific date, the date so mentioned is due date, the date so mentioned is maturity date. So if it is bill with specific date, due date and maturity date is equal to specific date. If it is bill with specific period, to due date we'll add 3 grace days to arrive at the maturity date. Did you all get this? Yes or no? Very good. So remember, due date and maturity date can be same. Due date and maturity date can be same. Certain important tricks that you should remember, certain important things that you should not forget. Whenever they give 30 days, take 30 days. Don't take months. Whenever they give 1 month, take months. Don't take 30 days. So months are not equal. 1 month is not equal to 30 days. 30 days is not equal to 1 month. If you believe it, you keep it in your belief system. Don't try to do it in mathematics. And when you're computing the days, you would have to do somewhat like this, certain basic things. Yeah, let me take here date, month, year. Let's say 10th of September 2024 is where you are. And from this date, let's say you're supposed to add 30 days. How do you add 30 days? Don't write it as, how to say, September early, 30 days are there, 20 days will be over 10 days. And don't do all that. Simply just add 30. Then what do you get here? If you add 30, you will get here 40th of September 2024. Literally add like this. Then you'd see 40th September is not there. How many days are there in September? 30. Then you do here minus 30. After 30 days in September, what will it become? October. So it will become plus 1 here. So add 1 year. Then it will become 40 minus 30, 10. 9 plus 1, 10. 2024. If you do like this. Are you getting it? What if it is 10th of September plus, what to say, 125 days? Don't try to count the September 10 to September 20 days, October 30 days, 50 days over, then November 30 days, then December 30. Don't try to count like that. It's very irritating and there is very high probability of going wrong. Literally write 125 plus 10, 135th of September. Is there 135 days in September? Okay, 365 days hakbidi onde tingalali. So 135 days is not there in September, only 30. After 30 days it becomes October. So 135 minus 30, 105 October. Is there 105th October? No. Though Gandhiji is born, it has only 31 days. So I'll do minus 31 and plus 1 here. 105 minus 31. Henry? 74. 74th of November 2024. 74th is there in November? No. November has only 30 days. Am I right? 74 minus 30. 44th of December 2024. But we need to remember that there is no 44th in December. So December has how many days? 31. After 31 it will become next month. No, it will become next year. After that it will become next year. And here this will become what? Again from the beginning will start. Correct or not? Yes or no? Or nimage ashtu confuse adre. Here you do plus 1. You leave it like this. 44 minus 31. 13th month 2024. 13th month ಇದೆಯಾ? ಹಾ ಸರ್, ಒಂದೊಂದ್ಸತಿ ಅಧಿಕ ಮಾಸ ಬರುತ್ತೆ. ಈ ಅಧಿಕ ಪ್ರಸಂಗ ಮಾಡಬೇಡಿ. ಆಫ್ಟರ್ 12 months it is going to be plus 1 year. So this will become 2025. 12, 13 minus 12, 1. 13th of January 2025. So always do like this. Don't try to count the days. Don't try to count the days. Do mathematics. Literally add. Clear everyone? Now I'll tell you two more scenarios. Shall I? Let us say we are on 31st of October 2024 and you're supposed to add 1 month. What do you get? 31st of November 2024. 31st November is not there. November has only 30 days. So what do you do? 1st of November, 1st of December. One thing will jump ಮಾಡ್ಬಿಡ್ತೀರಾ? 1st of December. You should take 30th of November. From any day in October when you count 1 month, it will come to November. It cannot go to December. October in the November ಅಲ್ಲಿ ಯಾವ ದಿನಕ್ಕೆ ಬೇಕಾದ್ರೂ ಒಂದೇ ತಿಂಗಳಿಗೆ. October ಅಲ್ಲಿ any day you take, add 1 month. It should not go to December. It should go to November only. Are you getting it? However, if it is 31st of what do you say, October, we added 1 month. We got to 30th of November. We didn't go to 1st of December. Am I right? What if we are supposed to add 31 days? Then it will become how much? 62/10/2024. Is there 62nd October? I'll deduct 31 and I'll add 1 here. Am I right? 62 minus 31, 31. 10 plus 1, 11. 2024. Will it become 31st of November to 1st of December or 30th of November? It will become minus 30 plus 1 and we'll write 1st of December. Did you understand when to take next day in the next month, first day in the next month, and when not to take, when to take the same day in the same, last day in the same month? Whenever we have months, from any day during this month, plus 1 month will be next month only. It cannot go to the month after that. If you take days, then you can take. It doesn't say months, no, it says days. So many days you go on taking. Clear? Is this difficult? Did this make sense? Say something. Okay, next. What if it is 30th of September and we are supposed to add 1 month? Last day of September, no? If I add 1 month, what do you get? 30th of October or 31st of October? You should take 30th of October. You should not take 31st of October. From 30th September, 1 month is 30th of October only. But from 31st of October, 1 month is 30th of November. Why? 31st November is not there, so we take last date of November. Here 30th is there, no? Take 30th. Let me give another example. 28th of February 2024. Or let's say 29th of January 2024 plus 1 month. 28th of February 2024. No, 29th of February 2024. Sir, why 29th? Leap year, no, 2024. Oh my god, sir, ನಾವು ಈ ಕಡೆ ಫೋಕಸ್ ಮಾಡ್ತೀರಿ, ನೀವು ಈ ಕಡೆ. ಚೆಸ್ ಹಂಗೇನೆ, ಇಲ್ಲಿಂದ ನೋಡ್ತಾರೆ ಹಿಂಗಿಂದ ಬಂದು ಗುಂಬೇಕು. Correct or not? What happened? You both played chess? Oh, 3 people played chess together. Nice. Next time call me, I'll also come. Yeah, 4 of us can play together. I will take horse, we will take elephant. Okay. 29th. Hey, shh. Maintain decency in class. So 29th of February 2024. Did you all understand this? Sir, how do we get to know that it is leap year? Very simple. Whichever year they give, no? Am I right? Divide it by 4. Divide it by 4. When you divide it by 4, if you get a round number, whole number, it is a leap year. If you get decimal number, it is not a leap year. Once every 4 years is leap year. Once every 4 years is leap year. Anyone in the class who's born on 29th of February in class? No one? Anyone in class who's born on 29th February? Really? He's younger to you then. He's younger to you. He is younger. He's younger. How many birthdays would have you celebrated? 5 birthdays so far? 4 or 5 birthdays. 5-year-old elder brother. He has a 5-year-old elder brother because he celebrates one birthday once in 4 years. No. Child marriage? No. No offense. Okay. Hey everyone, listen. Shh. My best wishes to your brother. Now, if the maturity date what we compute falls on a holiday, then what to do? We should check the kind of holiday. Holidays can be two types: known holiday and unknown holiday. Don't tell Gandhi Jayanti, Nehru Jayanti, Kanaka Jayanti, Basava Jayanti, Valmiki Jayanti. All of these are holidays. I agree. But for the purpose of bills of exchange, don't consider all of these as holidays. You get what I'm trying to tell? We have holiday for Mahalaya Amavasya also. You get it? And then like a lot of holidays are there. But for the purpose of bills of exchange chapter, no, there are two kinds of holidays: known holiday, unknown holiday. Known holidays are only 5. How many known holidays are there? Only 5. What are the known holidays which are 5? Independence Day, Republic Day. Independence Day, Republic Day. After that, first of April, beginning of financial year. 30th of September, half yearly closing, and Sundays. These are the only 5 holidays. Don't take Christmas, Ramzan, Bakrid, Mahashivaratri, Good Friday, and then Deepavali, Matte Dasara, Ramanavami. All of these are not holidays for bills of exchange. You celebrate any day however you want to celebrate, but don't take them as holiday for the purpose of bills of exchange. How many holidays? Only 5. What are the 5 holidays? Independence Day, Republic Day, 26th of January, 15th of August, 1st of April, beginning of financial year, 30th of September, half yearly closing, and all Sundays. So should I mug up the calendar and then go for Sundays? If they tell it is a Sunday, it's a Sunday. If they don't tell it is a Sunday, it's not a Sunday. Sir, I know, sir, 20th of August 2023 is Sunday. That day she ditched me. Don't remember. You want to remember, you cannot forget, it's okay. But in the question, if it falls on 20th of August 2023 and you know that it was Sunday, don't use it. Unless they mention in the question that it is Sunday, don't take it. You get it? So they should mention. Other than this, if they mention any other day as holiday, as a known holiday, then we'll take it as known holiday. If they don't mention it as known holiday, don't take it. Even if it comes to 25th of December in the adjustment, even if it comes to 2nd of October, if they tell you, take. If they don't tell you, don't take. You get this? Sometimes they'll tell this day was a known holiday. You don't ask why is it known holiday. Don't ask. They tell known holiday, you take it. If they will only tell it was emergency holiday, then take it as emergency holiday. For a known holiday, because you know that that day is holiday, the day before that will become maturity date. For a known holiday, because you know that that date is holiday, the day before that date will become the maturity date. For an unknown holiday, the day after that, the next working day will become the maturity date. Do you get this? This is for maturity date, not for due date. If due date falls on a holiday, that day itself is due date. And this is applicable for bill with specific period only. This is applicable for bill with specific period only. If it is bill with specific date, if it is bill with specific date, if it is bill on presentment or bill on site, the day we present the bill, the day we ask for money, that day itself is the maturity date. There is no concept of 3 grace days. 3 grace days will come only and only if it is bill with specific period. Bill payable after 30 days, payable after 60 days, payable after 1 month. Only if you say that, we'll give 3 grace days. Let's say I and you signed a bill. I told I unconditionally order you to pay me rupees 10,000 rupees on 15th of August. I have written 15th of August in the bill. You signed it. When should you pay me the money? 15th of August. Due date 15th of August. Maturity date 15th of August. If you pay the money to me on 16th of August, I can charge you 1 day interest. Why? You signed, no? When you signed, did you not know that Britishers left the country 14th of August in the night and then 15th is Independence Day? School they'll sing national anthem, college they'll give chocolate. You don't remember that? Not my problem. You signed no 15th of August. No, pay me on 15th of August. Got it? That's with regard to known and unknown holiday concept. After this, we need to remember the accounting entries, and before that, quick summary of types of bill. Based on our bill date, we categorize the bill into how many categories? Bill with specific date, bill with specific period. Sorry, bill after date and bill after site. And based on the maturity date, bill with specific period, bill with specific date, bill on site, bill on demand, or bill on presentment. What is this bill on site, bill on demand, and bill on presentment? The day I ask for money, that day you have to pay me money. The day I show you the bill and ask for money, that day you have to pay me money. No concept, that day itself is due date, that day itself is maturity date, that day itself is date of payment. If you don't pay me on that date, from next day start counting interest. I and you are friends. So I will say bill on site. Like whenever I want money, I will ask. If you have money on that date, I'll give the bill and collect money. There is no bill period written. There is no bill. There is no maturity date written. I need money. I'll ask you, hey, do you have money? You'll say, no, I don't have. Like, okay, fine. Tell me when you have money. I'll ask. And I'll keep quiet. Next, after 3-4 days, you'll say, hey, you asked for money. You can collect it now. You'll say, okay, fine. I'll give the bill today. And I'll give the bill that day. That day becomes our maturity date. What if we fight? What if you go to match without calling me? Or you have pani puri without me? I am angry. Then I'll say, I want my money now. You will say you don't have. I'll say, I don't know. Today is due date. Today is maturity date. If we give tomorrow, 1 day interest. Got it? So that is our bill on site demand or presentment. Clear? So we've discussed this part. Discussion. Next we should see accounting entries. What should we see next? Accounting entries under all the circumstances. Let's quickly finish accounting entries under all the circumstances for a bill of exchange. And then let's go to final accounts. The accounting entries, they will ask it in the books of drawer or in the books of drawee. And the accounting entry depends upon the transaction that is taken up by drawer. As a drawer who has drawn the bill and received the acceptance, you have 3 options. How many options with you? 3 options. Option number 1, you can hold the bill till maturity. Option number 2, you can discount the bill with banker. Option number 3, you can endorse it to the person to whom you are supposed to pay money. Let us say, as a seller, you decide to keep the bill with you till maturity. You want to keep the bill with you till maturity, wait for the maturity and encash the bill. Okay. For time being, let us assume I am seller, I am drawer, you are drawee. Who am I? Seller. Who am I? Drawer. Seller and drawer. You are drawee. Let's see. When I sell the goods to you, what is the entry? For me, it is sales entry. Drawee account debit to sales. You are supposed to pay me money. I'll write your name drawee. I have sold the goods to you. I'll credit sales. So in my books entry is drawee to sales. Ouch. In my books the entry is drawee to sales. You have purchased the goods from me. You will write purchase account debit and you are supposed to pay me money. Am I right? So to you will write liability. What is the liability that you will credit? Drawer account. So in my books entry is drawee to sales. In your books entry is purchase to drawer. After this, I will give a bill. You will sign it and give it to me. To me it is bills receivable asset. I will write bills receivable account debit to drawee. To you it is bills payable liability. You will credit bills payable and debit drawer. I will keep the bill till maturity. For holding the bill till maturity, there is no journal entry. On the maturity date, I will ask you for money. You can become a good person and give me money. You can become a bad person and not give me money. It's up to you. Either ways, our journal entry is ready. First one, if in case you maturely honor the bill on the maturity date, you give me money. I receive money. Am I right? I'll write cash account debit and I'll give the bill to you. Bills receivable. You will write cash account credit because you gave me money and you will debit bills payable. Why? Your liability bills payable is reducing. So your entry is bills payable to cash. My entry is cash to bills receivable. Clear? Next, what if the bill is dishonored? You didn't give me the money. If you didn't give me the money, I should actually put it on paper officially that you have failed to give the money. I would have to ensure that it's on paper that you have failed to give me money. What will I do? I'll ask you for money. You will say you won't give or you don't have. Then I'll go to court of law and then sue you there. In the court, the judge will ask, hey, why did you not give him money? You will say, no, sir, I am ready to give money. Then judge will say, give money. Then you will give me money. Judge will be looking at both of you like, do I look like a fool? Like you told he's not giving me, now he's giving me money. Why are you wasting the court time? So the situation won't go till court for this nonsense. So what should you do? When I say that I want money from you and you say that you won't pay me money, what will I do? I would have to have it on record that you have failed to pay. I will go to notary and I'll tell my notary that, okay, see, this guy should pay me money. He has not paid me money. So notary will send you a notice saying that you have to pay money to my client or to this particular person. He's telling that this bill is there. If in case you don't pay money, he will sue you in the court. So he'll give you a warning. If in case you pay the money, settled. If in case you fail to pay the money, notary will put a seal and then sign and by saying that, yes, this bill is authentic, this person owes money, this person has failed to pay the money. Then that will become a mistake on your part. For this entire noting, notary will charge me some money. And using that notarized bill, I can sue you in the court of law in a financial case. Are you getting it? If in case I go through banker will only pay noting charges on my behalf and I would have to pay banker. You get it? So this noting charges, who's supposed to bear? You are supposed to bear. Why? This entire scene is happening because of you, no? But you won't pay. Why? The bill amount only you didn't pay. Will you pay noting charges? I incurred noting charges because you didn't pay bill amount. So when you're not paying bill, how can you pay noting charges? So I will pay on your behalf. When I pay, I'll write the entry noting charges account debit to cash, just like any other expense paid. Will I pay chumma just like that? No, bidala. I will collect bill money from you and I'll also collect noting charges from you. This noting charges is like expense debited. It is not my expense. So I will credit it. Along with this noting charges, I will give you the bill also back. You have to pay me bill money also. And you owe me your name, drawee account debit, bill amount plus noting charges. Because you are now supposed to pay me not just the bill amount but also noting charges. Together total money you would have to pay me, I would have to collect it from you. Got it? After this, in your books what will be entry? You would have to pay. So your liability is reduced by way of bill because you get that bill back to you. And noting charges account debit because it is your expense. Against this you would have to pay me bill amount plus noting charges. I am your new liability, so you credit my account. After that, this noting charges being expense, you transfer it to P&L account by writing P&L account debit to noting charges. Are you getting it? So this is the accounting entry when the bill is held till maturity. When the bill is held till maturity. Not every time you will pick these first options. So I can have another option of discounting it with banker. What can I do? When you gave me the bill, I can hold it till maturity and then wait. If I want money immediately, I will immediately go to the banker and ask the banker to help me with money. I will give the bill to banker. Banker will take some money towards discounting charges and he'll give me the balance money. Banker will take some money towards the discounting charges and he'll give me the money. So if that happens, that's what we call as discounting with banker. What do we call it? Now in that case, same purchase entry, sale entry, bill drawn entry, receive entry, everything will be same. I'll tell you what is the new thing here. When I discount it with banker, I give the bill to banker and banker will give me money. Because the bill is given to banker, bills receivable is going out credit. Banker will give me money, so I'll debit bank account. The difference of the amount what I don't collect from the banker, which banker cuts, is called as discounting charges. This is expense in nature, so I am debiting it. And according to you, it's going to have no impact. Whether I hold the bill till maturity, whether I discount the bill with banker, whether I endorse it, whether I eat it, whether I throw it, to you it doesn't matter. To you, what is it? On the maturity date, you will pay money. Whether it is to me or to my creditor or to the banker, it doesn't bother you. Got it? Say something. Very good. So on the maturity date, I also won't write any entry if it is honored. Why? My banker will collect money from you, so I won't write entry. But you will write the same entry, bills payable account debit to cash. Whether you pay the money to me or to banker or to the customer of mine or to my supplier, anyone you pay, your entry is same. If in case you fail to pay the money, what do we call it? Bill dishonored. What do we call it? Bill. When the bill is dishonored, what happens? I'll throw the bill back on your face. But for me to throw the bill back on your face, I should have the bill. Who has the bill? Banker has the bill. Banker will throw the bill on my face. So banker has given me the bill, bills receivable account debit. And banker, once he throws the bill, no, he'll collect full bill money from me. Not after discounting proceeds. He'll collect full money. So banker will give me the bill, bills receivable debit. I will give the banker full money, bank account credit. So entry is bills receivable account debit to bank. Bills receivable account debit to bank. After that same dishonor entry, I will give the bill to you. So your account I will debit and I'll credit my bills receivable. If I paid noting charges to cash, then I'll credit my noting charges. You will pass the same dishonor entry. Bills payable account debit, noting charges account debit to drawer. And this noting charges will transfer to your P&L. So to you, it doesn't really matter. To you, it doesn't really matter. Clear? This is the three options that is there with our drawer. No. Two options that is there with our drawer. We have one more option. What is it called as? Endorsing the bill. So till now, there were two people, no? I am seller, you are buyer. I am drawer, you are drawee. When I am selling goods, I am purchasing goods from somebody here. This person is supplier. I have to give him money. You have to give me money. I sell the goods to you. I draw the bill on you. You accept the bill and you give it to me. This person is about to draw a bill on me. I will say, don't draw the bill. Wait. You have given me one bill saying that you have to pay me money. I will give the same bill to him. And I'll ask him to collect money straight from you. Are you getting it? So in that case, what will be the entry? Sale entry same. To you purchase entry same. To me raising of bill entry same. To you acceptance of bill of entry same. The entry comes when I endorse the bill to my supplier. Who am I? Seller. Who are you? Buyer. Who's he? Supplier. I am drawer. You are drawee. Correct or not? Now I am going to give the bill to my supplier. I become endorser. Whom do I become? And my supplier will become endorsee. The one who receives the bill in endorsement is called as endorsee. Let me repeat. Seller, buyer, drawer, drawee, supplier, endorser, endorsee, payer, payee. Got it? You pay the money, he will collect the money. I am out of this. So when I give the bill to him, my bill is going out. Bills receivable credit. I was supposed to pay him money. Supplier is a liability. No, liability will reduce. Supplier account debit to bills receivable account. Supplier account debit to bills receivable account. And just observe here, entry will be supplier account debit to bills receivable account in the books of drawer. And in your books, you will write no entry. Why? I am doing business with my supplier. Why are you bothered? You will write no entry. And on the maturity date, two things can happen. Honoring, dishonoring. Let us say bill got honored. You pay money to him. I won't write any entry. You will write bills payable to cash. I will not write any entry. If in case you don't pay the money, he will come to me. He will give the bill to me. I'll write bills receivable account debit to supplier. I would have to pay him money. He is given me the bill. I give that to you. So I'll write your name account debit to bills receivable account. If there is noting charges, if I have written noting charges to cash, then I'll then I'll credit noting charges to you and ask you to pay me noting charges also. Understood this? So this is the entry on honoring and dishonoring. Ultimately, remember in the books of drawee, it doesn't matter whether a bill is held till maturity, whether a bill is discounted or the bill is endorsed. Entries will be always the same. Got it? Very good. By this we are done with all the three options. Now let's talk about settlement of bill. I'll take about next 5-10 minutes. We'll finish this topic and then take break. Okay. Next we'll talk about settlement of this bill. What do you mean by settlement? Taking the bill and giving money. Now you have to take the bill and give me money. I have to give the bill and collect money. What date should we do this? On maturity date. When should you pay? Maturity date. When should I collect? Can we settle the bill on a date other than maturity date? Answer is yes. I will be happy if you pay me the money before maturity date. I will be sad and angry if you pay the money after maturity date. If in case you pay me the money before maturity date, I am happy. I give you discount. I give you that discount is given when you pay the money before maturity date. Payment of the money before maturity date is called as retirement. What is it called as? Settling the bill before maturity date is called as retirement of bill. What is it called as? In the case of retirement, drawer will give discount. As a drawer, what do? I give discount. Drawee, you will get discount. You will get discount. To me, discount is expense. To you, discount is income. To me, discount is expense. To you, discount is income. I will write the journal entry like this. Cash account debit for the amount that you gave. For the amount that I am asking you to not give, discount account debit to bills receivable. To you, to the extent you give money, you credit cash. To the extent you don't have to give money, your income, you credit discount received. Debit will be bills payable because liability is decreasing. This discount received or discount allowed is there? No. That will be found using P into T into R. P, principal, here it will be bill amount. Time period for which the bill is retired. How many months before are you paying? How many days before are you paying? The period before the due date for which you pay, that period. Rate of discount that will be given in the question. If you multiply, you will get the amount. Got it? Next one is renewal. Meaning you have to pay me money on the due date or on the maturity date. You pay me late. You say that you will pay later. When you pay later, I am angry. I am upset. My money is getting stuck for a longer time. So I don't want just money. I want something more than money. Yeah, interest. More than money. So we will ask for something more than money called interest. That interest is again dependent upon the period of delay. If the period of delay is 15 days, we will charge interest for 15 days. If the period of delay is 30 days, we can charge interest for 30 days. Are you getting it? Usually for that delay, we will sign a new bill. Let us say today is the maturity date. You are supposed to pay today. You will ask for 1 month extension. When you ask for 1 month extension, that old bill is no longer valued. So today I will draw one more new bill for 1 month period. Today I will draw one more bill for 1 month period. That one more bill that we draw for 1 month period, no, that will be usually including interest. Or if you don't want it to be including interest, you can pay interest in cash today. For only the balance amount, I'll draw a new bill. Let's say you're supposed to pay me 10,000. How much are you supposed to pay? There is going to be 1 month delay. How much delay? If you say that you can give 4,000 rupees right now, then the new bill will be for 6,000 plus interest on only 6,000. New bill will be for 6,000 and interest on 6,000. It should not be on 10,000. Or you can say you will pay 4,000 and interest on that 6,000 now only. New bill will be for only 6,000. So remember, for the delay, interest is computed only for the amount of delay. If the partial amount is paid and partial amount is delayed, for the partial amount what is delayed, only for that amount we compute interest, not for the entire amount. Did you get it? Make some noise. That's with regard to our concept of settlement of the bill before due date, settlement of the bill after due date. If in case there is no settlement, you don't pay, then it will be bad debt to me, expense. If you give the money, I'll write cash account debit to bills receivable. If you don't give money, instead of cash, I'll debit bad debts. To me, it is bad debt expense. To you, it is called deficiency. It is like income, not actually income, but it is like income. If the cash is received, we debit cash. If the cash is not received, I'll debit bad debts. If the cash is paid, you will credit cash. If the cash is not paid, you credit deficiency. Did you get it? Sometimes there will be partial collection and partial failure. Be careful with that. Last topic that is there in the top chapter of bills of exchange is accommodation of bill. Usually all of this what we discussed so far is trade bill. What is it? There is a trade, there is a purchase, there is a sale. This purchase or sale transaction is backed by a bill. This purchase or sale transaction is backed by a bill. What do we mean when we say accommodation of bill? There is no purchase, there is no sale. One purchase illa, one sale. One high illa, one buy illa. What is happening? There is nothing. Just like that. I want money, you want money. So what will you do? We both will come with a scheme. I have a beautiful scheme. What is it? I will draw one bill on you. Okay. You accept it. You will say, hey, I don't have to give you any money. No, yeah, it's okay. Yeah, you just wait. You sign it as if you are supposed to give me money, as if I've sold you goods. You sign one bill for 10,000. You give it to me. I will take it to banker. I will get it discounted. Banker will cut 500 rupees, give 9,500 rupees. 9,500 rupees ali 50 nanige, 50 ninige. What about balance 9,400? Did not understand. I will draw a bill on you for 10,000. You will sign it and then give it to me. I will discount it with banker. Banker will give 9,500. In that 50 for me, 50 for you. 50, 50, 100, no. What about 9,400? 50, 50, 50%. So 9,500 only 50% is 4,750 rupees to me, 4,750 rupees to you. We got free 4,750. I will use 4,750, you will use 4,750. On the maturity date, banker will come and ask you 10,000 rupees. Then you don't tell what 10,000, I don't know, this is all a bill. You can't tell that. Both of us will go to jail. So when the banker asks you for 10,000, you call me. I will give you 5,000. You put 5,000 from your pocket and you give the banker 10,000. Do you get it? We paid 5,000 each to the banker. We got 4,750 each from the banker. So we got 4,750, we paid 5,000. 250 rupees for me expense, 250 rupees for you expense, 500 rupees for bank income. Are you getting it? So basically, this is the kind of adjustment what we call as accommodation of bill. When I raise the bill on you and discount it with the banker, whatever is the ratio in which we share that amounts between us, in the same ratio we share bank charges. In the same ratio, we gave the proceeds to the banker on maturity. The problems becomes interesting when the ratio is not 1:1, 2:1 ratio. They keep the ratio as 2:1 or 3:2. I keep 3 parts, you take 2 parts. It will become more interesting when on the maturity date you are supposed to pay the money to banker. You don't have money. You will say like this, banker will come and ask me money. When banker asks me money, I'll pay 10,000 to bank. I pay 10,000, your 5,000, my 5,000. Together I pay 10. So now you are supposed to pay me 5,000. Am I right? I'll ask you for money. You say you don't have money. Then I will draw one more bill on you for 15,000 rupees. You will sign and I'll discount it. I'll get some 14,000 rupees from bank. You take 7,000, I'll take 7,000. But in that 7,000, what belongs to you? 5,000 you have to give me, no? I'll take 5 and give you only 2. So when I give you 2,000, it means I adjusted old 5 and still given you 2. Basically 50-50 again, 7-7. Then on maturity, banker will ask you for 15. Then you should pay 7,500, I should pay 7,500. That day you don't pay money, banker will come to me, I'll pay full 15,000. You will say, go in the I don't have money, bad debts. That is the kind of questions. One variety of question, drawee becomes insolvent. Drawee fails to pay the money. Another type of questions, I am a drawer, you are a drawee, you sign the bill, I take the bill, I get it discounted, we share the proceeds. On the maturity date, banker asks you for first bill 10,000. I should give 5,000, I don't have 5,000. I won't give 5,000, you pay 10,000 to banker including my 5,000. So now I owe you 5,000. In that case, you will draw a bill on me. You become drawer, I become drawee. I will sign, I will give it to you, you discount it with banker. Discounting proceeds, whatever you get, you divide it in the old ratio. You will take the money that I am supposed to give you. Balance money, you give it to me. On the maturity date, banker will ask me money. That day I will say I don't have money. All these questions are same, guys. Second bill, bad debt guarantee. Second bill, bad debt guarantee. And ratio is usually same. First bill, second bill, ratio is usually same. There is hardly one question where the ratio is different. But you be careful. You remember that second bill, when it is discounted, you adjust the first balance amount and then the bill proceeds will be shared. You get it? That one thing if you keep in mind, you will be able to do accommodation of bill questions. If you want, let's quickly see the question from our RTP. RTP, bill of exchange, what question do we have? We have one question, this Ritu Chavi question. We need to write the entries from whose perspective? Ritu's perspective. Shall we quickly finish this? 5 minutes. Come on, read this. Chavi owed, from whose perspective are we seeing the entire transaction? Ritu. Okay, who are we? Accountants of Ritu. You are not Ritu. We are accountant of Ritu. Who are we? Ritu ante. Who are you? I am Ritu. Go home. Tell mom. Amma, nanu Ritu. Chavi owed 1 lakh to Ritu. Chavi accepted a bill drawn by Ritu for amount of 3 months. So for us it is bills receivable. What is the entry? Bills receivable account debit to Chavi. Am I right? How much? 1 lakh, 1 lakh. Wait a second. Let me close this. This also went up. Oh, this is CA intermediate consolidation. RTP alva. See, when we receive the bill from Chavi, bills receivable account debit to Chavi account. 1 lakh, 1 lakh. Clear? After that, what's happening? After 3 days, Ritu got the bill discounted with banker for 99,000. When you get the bill discounted with the banker, banker will give you 99,000, 1,000 discounting charges. Entry is bank account debit 99,000, discounting charges account debit 1,000 to bills receivable account 1 lakh. See, bank account debit 99,000, discounting charges account debit 1,000 to bills receivable 1 lakh. Got it? What is after that? Before the due date, Chavi approached Ritu for renewal of bill. Chavi told, hey, please, I can't pay you within 3 months. Okay, please give me extension. But I'm like, but I don't have the bill. Bill is with banker. If it is there in my hand, I can tear the bill and then sign a new bill. No, bill is with banker. But Chavi requested, Ritu accepted. Ritu accepted. So now Ritu is telling us we need to renew the bill. But as accountants now, we are telling we don't have the bill with us. It's with banker. So what should we do now? We should give money to bank and then collect the bill back from bank. In order to collect the bill back from the bank, we should pay money to bank. Am I right? How much should we pay to bank? 99,000? Bank will say, I want 1 lakh. I want 1 lakh. That's how bank work. You get it? So you need to pay the bank 1 lakh rupees and collect the bill from them. Bill is coming in. Bills receivable account debit. Money is being paid. Bank account credit. Entry will be bills receivable account debit to bank 1 lakh, 1 lakh. Observe. Bills receivable account debit to bank 1 lakh, 1 lakh. Now I will give this bill back to Chavi. Chavi has to pay me now 1 lakh and bill is now given to Chavi. Entry is Chavi account debit to bills receivable. How much money does Chavi owe now? 1 lakh. Now what are we going to do? Ritu agreed on the condition that 50,000 be paid immediately together with interest. So how much should Chavi pay me now? 50,000 with interest. So 50,000 she'll give. What is the balance portion which is delayed? 50. For the delay of 50,000 we should compute interest at 12% for 3 months. Do 50,000 into 12% into 3 months. 1,000. This is not the 50,000 which we received now. This is the 50,000 which we don't receive now. So 50,000 into 12% into 3 by 12 comes to 1,000. 1,500 is interest. So I will receive 50,000 plus 1,500, 51,500 from her. How much cash will I receive? 51,500. And balance amount she'll give the bill 50,000. Got it? In this interest 1,500, income Chavi had to give me 1 lakh, that 1 lakh. So I receive 51,500 and 50,000 rupees bill. In that 1 lakh is because she was supposed to give 1,500 is my interest income. Got it? What is after this transaction? Chavi should accept a new bill for 3 months. These arrangements were carried out. Mugitu. But afterwards, Chavi became insolvent and only 40% of the amount could be recovered. Oh my God. She jumped into water and she didn't dissolve. We could recover only 40% of the money. How much is she supposed to give me? 50,000. How much will she give? 40%. 50,000 into 40%. Remaining 30,000 go in the bad debts. So I'll write the entry Chavi account debit 50,000. First we'll write the dishonor of the bill. Then I will write cash account debit 20, bad debts 30, Chavi account credit 50. Khatam. Got it? Yeah. So do practice problems on bills of exchange. Come back to me if you have any doubts. Let's take a short break here. It's 5:34. Can we all meet at 6 o'clock? When we come back at 6, let's start with final accounts. I'll teach you the GST part in final accounts with specific, and I'll tell you overall overview what should you remember when it comes to final accounts. And after that, we will head on to the topic of NPO, incomplete records. We will be doing the entire topic in detail. We've done the entire topic in detail and the video is there in the YouTube wall by itself. You can watch the entire chapter of incomplete records. Okay. So post break, we'll do final accounts and NPO. That's the target for today. Got it? So far it's going smooth, no? Not finding it hectic also. Yesterday you found it hectic? No? Okay, cool. So let's take a break. See you all at 6 o'clock, 6:05. When we come back, let's do final accounts and NPO. Yeah, take a break. Welcome back everyone. We were discussing the topic of bills of exchange and now let's get started and continue with final accounts of company. Sorry, final accounts of sole proprietor. Final accounts of sole proprietor has two parts. One is manufacturing entity, other one is non-manufacturing entity. In a manufacturing entity, you don't buy finished goods. You buy raw material. After you buy raw material, you will convert raw material to finished goods and then sell them. However, if you are a non-manufacturing entity, you buy finished goods and you sell them. Only point of difference is, if it is a manufacturing entity, you prepare manufacturing account, trading account, P&L account and balance sheet. If it is a non-manufacturing entity, you prepare trading account, P&L account and balance sheet. It is never manufacturing or trading. It is always manufacturing and trading. It is manufacturing and trading for a manufacturing entity. For a non-manufacturing entity, it is only trading, P&L and balance sheet. So we will not discuss non-manufacturing first and then manufacturing. We will do manufacturing first and then non-manufacturing. Because if we do manufacturing entity, non-manufacturing will get completed alongside in the same flow. So we'll do the GST part also. Give me a little time, we'll do the GST part. This is what we did yesterday. No, this is I think our what question? Our exam question, RTP question. If by the end of this unit, if I don't discuss GST, just remind me. We'll finish GST and then go ahead after final accounts. So like I told you, final accounts are prepared to evaluate financial position and performance and also to help in decision making. When did I tell this? Yesterday we were discussing objective of accounting. And in final accounts, we prepare manufacturing, trading, P&L, balance sheet and cash flow statement. But for sole proprietorship, cash flow statement is not mandatory. You learn it in ES3 Inter as to when is it mandatory, when is it not mandatory. And P&L appropriation account also we don't prepare in the case of sole proprietorship. We'll adjust it through capital account. We'll prepare P&L appropriation account in partnership, which we will be doing in tomorrow's session. So when do we prepare final accounts? Usually at the end of the year. However, if required, We can prepare it for a period shorter than a year also. How to prepare final accounts? That is what we are trying to learn in this chapter. I told you manufacturing account is always, it is manufacturing and trading if you are a manufacturer. If you are a only trader, you don't prepare manufacturing account, you straight away prepare trading account. Now, inventory in a business will include three variants: raw material, work in progress, finished goods. Raw material, work in progress, finished goods. Finished goods will appear in trading account. But in manufacturing account, you'll have raw material, work in progress and finished goods. In manufacturing account, you'll have raw material, work in progress and finished goods. Whereas in trading account, you'll have only finished goods. Raw material and work in progress will not go to trading account. It will be there only in manufacturing account. Okay, whenever it is manufacturing account, try and recall the concept of factory. It's like a factory. The moment you open the doors of the factory, what do you see? Work in progress. Semi-finished goods will be lying everywhere. So in our manufacturing account, imagine manufacturing account, debit side will start with opening work in progress. Closing will be closing work in progress. Debit side, instead of opening stock, will write opening work in progress. Credit side will write closing work in progress. What you put inside your manufacturing account is raw material. What is it that you put in your manufacturing account? Raw material. And raw material, we don't write opening stock on the debit side, closing stock on the credit side, purchase on the debit side. We won't write it that way. With regard to raw material, we write consumption of raw material. What do we write? See, usually opening stock is on the debit, purchasing is on the debit, closing is on the credit. Am I right? Here we write everything together. Opening stock plus purchase minus closing stock. That is nothing but consumption. In the morning, you had 10 chocolates in the pocket. During the day, you purchased 30 chocolates. End of the day, you have only 5 chocolates in the pocket. 10 was there in the pocket. You purchased 30. It becomes 40. At the end of the day, in your pocket, there are only 20. That means you ate 20 chocolates. That is consumption. Beginning of the year, raw material worth 10,000 is there. During the year, you purchase raw material worth 40. Total raw material should be 50. End of the year, you still have 20. So consumption is 30. So 30 raw material is now transformed to work in progress or finished goods. So it is expense. It has to be debited in manufacturing account. How do we find consumption of raw material? Opening raw material plus purchase of raw material minus closing raw material. Let me repeat. Opening raw material plus purchase of raw material minus closing raw material. What is that? Consumption of raw material. In your manufacturing account, opening WIP here, closing WIP here, consumption of raw material here. In consumption of raw material, I write opening raw material plus purchase of raw material minus closing raw material. And raw material, if you keep and then say Om, Beam, Barack Obama, it doesn't become finished goods. You need to incur expenditure to make it finished goods. Electricity, lighting, heating, wages, lot of expenditure will be incurred. All of that expenditure will be debited in manufacturing. Opening work in progress, closing work in progress. Consumption of raw material, manufacturing expenses, lighting, heating, and then wages or any other transportation expenditure, any expenditure will be debited here. And manufacturing account is prepared not with an objective of determining profit. There is no profit in manufacturing. Manufacturing account's objective is to determine cost of production of finished goods. So there won't be anything called sales and profit. There will be transfer of finished goods to trading account. That will be the cost of production. Objective of manufacturing account is to find that. However, in the process of manufacturing, there might be some scrap that will be produced. We will sell this scrap. That will reduce our cost of production. That will reduce our expenses. Expenses is not debit. Sale of scrap will come on the credit. And this is our manufacturing account. I'll tell all the items once. Have a look at it when you see this account. Manufacturing account. Debit side opening WIP. Credit side closing WIP. Consumption of raw material here, which is opening plus purchase minus closing. Manufacturing expenses here. Sale of scrap. Cost of finished goods manufactured transferred to trading account. That's it. Once again, opening WIP, closing WIP. Consumption of raw material, manufacturing expenses. Sale of scrap and then goods transferred to trading account. Do you get it? If there is any depreciation on plant and machinery, that will come in manufacturing account as direct expense, not in P&L account as indirect expense. Please note that that's one place where people do mistake. And by this, we are done with our manufacturing account. Any doubts in manufacturing account? Perfect. Going forward. So let's quickly go and understand how do we work with our trading account. How do we work with our trading account? I told you manufacturing account is prepared with an objective of determining the cost of finished goods manufactured. Trading account is prepared with an objective of identifying the profit on sale of goods. This is gross profit. So in our trading account, opening stock on the debit, purchase of finished goods on the debit, direct expense on the debit. Sales and closing stock on the credit, will get gross profit on the debit side as balance figure. If it comes on the credit side, it is gross loss. Come on once again. Opening stock on the debit, purchases on the debit, trading expenses on the debit. sales and closing stock on the credit, we'll get gross profit if any, and the debit side as balancing figure. If this is a manufacturing entity, we won't be rating two purchases. Why? We no longer purchase finished goods. What we buy is raw material. Those raw material will be converted to finished goods in manufacturing account. From manufacturing account, those finished goods will come to trading account. So in our manufacturing account, credit side I'll write by trading account, finished goods manufactured and transferred to trading. In trading account on the debit side I'll write to manufacturing account, finished goods transferred from manufacturing to trading. Do you get it? If we are non-manufacturing entity, we will purchase finished goods. In trading account I'll write to purchase. If we are manufacturing entity, we don't buy finished goods. We'll buy raw material purchase, which will come in consumption in manufacturing account. Finished goods so manufactured will be shifted from trading account, from manufacturing account to trading account. Did you get it? Make some noise. Very good. So, and that's how we prepare our trading account. Any expenditure incurred in the process of trading will be written here. Wages or any other direct expenses. Have a look. Another point to be noted, if in case there is something called as purchase return or sales return, please adjust purchase return with purchases and sales return with sales. Don't say, I'll write purchase return on the credit side, sales return on the debit side. Impact is same. I agree. You did that in first PUC, second PUC. Please don't do it in CA Foundation. I'll tell you the reasons. Whenever they give gross profit as a percentage of cost or percentage of sales and everything, when you're computing it, if you have taken sales less return, net sales in the outer column, you will do percentage on that and you get the answer correctly. If in case you have written sales on the credit side, sales return on the debit, GP is given as percentage, you compute GP percentage on sales and then write on debit side, no? Gone. Your GP is wrong. Once your GP is wrong, your NP is wrong. NP is wrong, capital in the balance sheet is wrong. Balance sheet is completely wrong. On 5-6 mark, damar. So why do you take risk? Adjust sales return from sales, adjust purchase return from purchases. Don't take risk. Okay, now. Fantastic. So after this, I want you to remember the formula for cost of goods sold. Why? In certain questions, they won't give purchases. Here there is purchases, no? They won't give purchases. They'll call it adjusted purchases in the question, in the trial balance. If in case they use the word adjusted purchases in the question, in trial balance, remember that adjusted purchases actually means cost of goods sold. That adjusted purchases actually means cost of goods sold. How do you find cost of goods sold? Opening stock plus purchases plus direct expenses minus closing stock. Let me repeat. Opening stock plus purchases plus direct expenses minus closing stock. What is that? Cost of goods sold or adjusted purchases. Usually in trial balance, purchase, opening stock, direct expense will come in trial balance. Closing stock will come outside trial balance. When closing stock comes outside trial balance, that closing stock should be returned to trading account debit side as well as balance sheet as asset. If in case closing stock comes to trial balance, it will be given as debit. That will go only to balance sheet as asset. Why? The moment the closing stock comes in trading account, in trial balance on the debit, it is already deducted from purchases to change the purchases to adjusted purchases or cost of goods sold. So remember, closing stock will usually appear in adjustment. You should take it to trading account debit and balance sheet asset. If in case closing stock appears in trial balance, it will be debit and that balance will go to asset side. Don't write it in trading account. Why? The purchase what is given in trial balance will be now called as adjusted purchases or cost of goods sold, which is actually after deducting closing stock. So we don't have to adjust that closing stock in trading account separately. Are you getting it? There are some questions on this. If in case you practice this, you will get it. And let me quickly run you to the next topic in our topic. That is manufacturing account done, trading account done, P&L account. P&L account is a place where we write all our indirect expenses and indirect income. From trading account, whatever gross profit which exists, we bring it down to P&L, and in P&L account, we write all the indirect expenses, indirect income with gross profit to find our net profit. Do you get it? And items in our P&L account should be written on accrual basis. What basis? Expense incurred should be recorded whether paid or not. Expense incurred should be recorded whether paid or not. Income earned should be recorded whether received or not. Don't tell conservatism. Conservatism is about expected income. I'm talking about earned income. Income what is earned should always be recorded. Conservatism will apply to expected profit. Profit which is not earned. I'm talking about income which is earned. Income which is earned is your income. You have the right to receive. You have to record it in P&L account, whether received or not received. If there is outstanding, prepaid, accrual, adjust it in balance sheet. But you have to write the full income what is earned, full expense what is incurred in our P&L account. Understood this part? Yeah, we do this chapter over 3.5-4 days, but you guys understand now we're doing marathon revision. I have to run it quick. If I do it in detail, then 3 days, yesterday, today, tomorrow, we'll do only final accounts. Next, talking about indirect expenses. I told you, it has to be recorded on accrual basis. Now, with regard to expenses, there are some things called as prepaid expenses, something called as outstanding expenses. What do you mean by prepaid expenses? Expense paid is actually not incurred. Expense paid is actually not incurred. That is prepaid expense. Like let's say I paid 14 months rent when I've used the property for 12 months. What is the 2 months extra I paid for next year? So next year rent paid now is next year expense, not this year expense. Payment is this year, expense is next year. You should not write 14 months rent in P&L account. Current year there are 12 months, only 12 months rent should come in your P&L account. Additional 2 months rent will come in your balance sheet of the current year as prepaid rent asset. In the next year, from the balance sheet, it will go to P&L account. Why will it go to next year P&L? Because it belongs to next year. Why did it not go to P&L account current year? Because it belongs to next year. Okay, in other ways, because it doesn't belong to this year. For temporary overnight stay, it will stay in balance sheet. The moment next day starts, it will go to P&L account. Similarly, there is something called as outstanding expense. What is outstanding expense? I paid 14 months rent this year. 2 months rent of last year I paid this year. Will that 14 months rent go to P&L account? No. That 2 months, what we are paying now, was not paid last year. Though it was not paid last year would have still written it in P&L account. But the payment is made this year. So last year, because we did not pay, but still we wrote the expense, we would have recorded it in the last year as outstanding rent, in the balance sheet as liability. This year when we pay, our liability will reduce. Got it? So be cautious with regard to outstanding and prepaid items. Same with regard to incomes also. Prepaid expense is asset, outstanding expense is liability. Similarly, with regard to income, pre-received income is liability, accrued income is asset. Okay, now, very nice. Then next point to be cautious, which can come in the topic of partnership accounts also, is managerial remuneration. So the manager who works in your organization, you can pay him remuneration. This remuneration can be amount 10,000 per month, 15,000 per month, 50,000 for the entire year. If they give this amount, no, it's very easy. It is not going to become difficult. Write so much money in P&L account, debit side, pay that by cash. But it becomes quite interesting when that is given as a percentage of profit. Manager is entitled to remuneration as a percentage of profit. Whenever manager's remuneration is given as a percentage of profit, what do we do in that case? We got to check, is it before charging basis or is it after charging basis? What should we check? Is that expense on before charging basis or is that expense on? If that expense is on before charging basis, what basis? Simple, profit multiplied by that X percentage. Profit into X by 100. That's it, simple, over. Profit into X by 100. However, if the question says on after charging basis, please do X divided by 100 plus X. Please do X divided by 100 plus X. So why? The logic is detailed discussion. If you want, you please send me a message. I'll send a detailed video on that. We have it on YouTube only. If you search for managerial remuneration, you will get it. Managerial remuneration, CA Rajavardhan, you just search. You'll definitely get a video on that. I've taught you this before, after. Why do we do it? Along with that one equation question, general manager, sales manager. I don't know if you can remember. I'll show the question. A very interesting one. So only thing that you should remember right now is if it is before charging basis, we do X by 100. If it is after charging basis, we do X by 100 plus X. Got it? Say something. Then this is the question that I was talking about. If there is a sales manager and general manager, if sales manager is entitled to remuneration 10% of profit after paying general manager's remuneration, and general manager is entitled to remuneration at 15% after paying sales manager's remuneration, then if the profit is 1 lakh before paying both the remunerations, how much is the remuneration to be paid? A very interesting and foundation or CACPT examination question. So little tricky. You will get good understanding if in case you can solve this. So I'll show the question for about brief period of 10 seconds so that whoever wants to try can click a screenshot. So I will request you people to try solving this question at home when you are at free place. And if in case you get stuck, you ask me, I'll share the solution to you on this. But you should be able to solve this. Got it? Okay. Later you can open the YouTube video also and take the screenshot if you don't want to take the photo right now. Done. Cool. After this, we would be doing full-fledged lengthy questions on our trading P&L and balance sheet preparation. One thing where people again get stuck is in the topic of provisioning. Let me explain provisioning and then come to balance sheet. Provisioning. How to provide for provision. Bad debts, provision for bad debts, provision for doubtful debts, discount, additional bad debts, and all of these things. See, in this family, the members are very few. Debtors, bad debts, provision for bad debts, and provision for discount. To us, no provision for bad debts or provision for discount, it's the same, provision. So, how many items do we have? 3. Debtors, bad debts, and provision. Remember, debtors is the amount that we should receive from our customers, our asset. Bad debt is the amount that we are supposed to receive, but we will not receive, which is our expense. Provision is expected not receiving money, or money that we expect not to receive. Has the customer told that he won't pay? No. He has not told. We think he might not pay. In the future, it might become bad debt. So today it is called as provision for bad debt. Yako, I feel doubtful that this person might become my bad debt in the future. Got it? So with regard to debtors will appear in balance sheet asset side. Bad debt is an expense. Journal entry for bad debt is like this. Journal entry for bad debts is bad debts account debit to debtors. What is the journal entry for bad debts? Bad debt account debit to debtors. After you write this expense, we need to transfer it to P&L. For which the entry is P&L account debit to bad debts. Let me repeat. Journal entry for bad debts is bad debts account debit to debtors. When you transfer it to P&L, entry is P&L account debit to bad debts. Now, bad debts can be given in trial balance to the question, or bad debts can be given in the adjustment to the question. If bad debt is given in trial balance to the question, it means already bad debt account debit to debtors journal entry is passed. This entry is already done if it is given in trial balance. So you don't have to deduct again from debtors. You only have to pass this entry, that is by writing in P&L. However, if bad debt is appearing in adjustment, then both the entries are not passed. We have to pass both the journal entries. I'll repeat. If in case bad debts is appearing in trial balance, then bad debts to Sunday debtors entry is already passed. We only have to pass the entry P&L account debit to bad debts. However, if bad debt is appearing in adjustment, both the entries have to be passed. We have to write bad debts account debit to debtors and P&L account debit to bad debts. Both the entries have to be passed by us. Do you get it? Say something. Fantastic. I've given the quick summary also here for you to note. Don't use this logic if it comes in trial balance one time, if it comes in adjustment 2 times. Who tells all of this, man? Weird logics. Don't tell all of that. Journal entry. What is passed, what is not passed. Remember the journal entry and then pass it. Professional students, not second PU students. Done. Next. What is it with regard to creation of provision? Whenever you want to create provision for bad debts. Remember, provision is actually a liability. What is provision? It is expected decrease in the value of the debtors, which is not actual. So, what is provision? On creation, it is an expense. Once created, it's a liability. On creation, it is an expense. Once created, it is a liability. So, when it is an expense, when it is created, you will write in P&L account debit side. So, for provision, entry is P&L account debit to provision account. What is the journal entry for provision? P&L account debit to provision account. A very, very important thing what you have to remember from this is, check that entry. Is there debtors anywhere there, debit or credit? No. So when you create provision, debtors value doesn't change. When you create provision, debtors value doesn't change. It is only expected decrease in the value of the debtor, not actual. When you write debtors minus provision, there is no journal entry for deducting provision from debtors. Don't try to figure it out in a way. There is no journal entry. Provision on creation, it is an expense. Once created, it is a liability. On creation, it is an expense. Once created, it is a very good. On creation, when it is expense, we'll write in P&L account debit side. Once created, it's a liability. It should appear in the balance sheet liability side. But whenever there is a provision created against a specific asset, you don't write asset on the asset side and provision on the liability side. This provision will be deducted from the value of the asset in balance sheet only for presentation. Let us say the provision is 1000, debtors is 10,000. I won't write debtors 10,000 on asset side and provision 1000 on liability side. No. I'll write this 1000 provision as minus from debtors. I'll write 10,000 inner column debtors, minus 1000 provision, 9000 in outer column. When I write this, my debtors is not 9000, debtors is 10,000, provision is 1000. Don't tell next year debtors will be opening balance 9, debtors will be 10 in next year, provision will continue to be 1 in next year. Are you getting it? Next year, let us say the question says provision has to be maintained at 15%. Provision has to be maintained at 15% should be not computed on 9000. 15% should be computed on 10,000. Why? Debtors was, debtors is, and debtors will be 10,000. On 10,000, when you compute 15%, provision becomes 1,500. Already there is provision of 1,000 created in the last year. Should create additional provision of only 500. Should create additional provision of only that 500 additional provision what you create will become expense in P&L account. And in the balance sheet you take 1,500. I'll repeat. Previous year, debtors 10,000, provision 1,000, closing balance of debtors in the balance sheet only is 9,000. Next year, debtors is 10. If the question says provision has to be maintained at 15%, you do 10,000 into 15%, provision deduction from debtors should be 1,500. Already 1,000 provision is there, but you are deducting 1,500. 500 is the additional provision created during the year. This will be debited in P&L account. And from debtors will deduct 1,500. Outer column debtors will be 8,500. Got it? Alternative scenario. Previous year, debtors 10, provision 1, closing balance in balance sheet is 9. This year, let's say, they say provision is to be maintained at 8%. Provision is to be maintained at, on 10,000, I'll compute 8%, comes to 800. Provision to be deducted from 10,000 is 800. 10,000 minus 800, 9,200 in the outer column. But we had provision of 1,000, no? Provision from 1,000 it is becoming 800. So provision is decreasing by 200. That decrease of 200 is provision written off. What is it? Provision. For creation of provision, entry is P&L to provision. For writing off of provision, entry is provision to P&L. Creation of provision is expense. Writing off of provision is income. Let me repeat. Creation of provision is expense. Writing off of provision is income. This will go to P&L account credit side by provision 200. Got it? And last point, if in case there is recovery of bad debts. If in case there is recovery of, please remember it has no impact on debtors, it has no impact on bad debts, it has no impact on provision. It is a very separate item. It's a far relative. You get it? It is not at all connected, very close to our family. Relative, but far. It won't come inside the family. They won't come to our house. Got it? So what is the journal entry for bad debts recovered? Cash account debit to bad debts recovered. And that bad debts recovered is income. It will be transferred to P&L, for which the entry is bad debts recovered account debit to P&L account. So what is the entry? Cash account debit to bad debts recovered account debit to P&L. Cash account debit to bad debt recovered and bad debt recovered account debit to, that's the entry for bad debts. Clear? Then ultimately what you need to remember is with regard to balance sheet. Balance sheet, you all know you will write assets and liabilities. Among assets and liabilities, we need to segregate them as current and non-current. When do we call it current? When do we call it non-current? I have discussed in yesterday's class when I discussed the definition of asset. I hope you remember. The order of writing the items in balance sheet is called as marshalling. What is it called as? M-A-R-S-H-A-L-L-I-N-G. There are two orders that we follow. One is liquidity order. Other one is reverse liquidity order. Liquidity order means liquid items will write at the top. We'll start with cash, bank, inventory, trade receivables, that is debtors and bills receivable, and then fixed assets, land, building, machinery. That is liquidity order, which we don't follow. We always follow reverse liquidity order. It is called as order of permanence. What is it called as? Sir, who follows liquidity order? Banks. Banks financial statements as per Banking Regulation Act 1949 when we prepare, we write liquidity order. We start with cash, bank balance with other banks, balance with RBI, investment in gold and other securities. They write like that. Fixed assets building, they write at the bottom. Whereas for other than banks, NBFCs and financial institutions, when we prepare balance sheet, we follow reverse liquidity order. It is called as also order of permanence. What is it called as? And that's how this will look. So now we have conceptually covered our topic. There is no concept which is left untouched, but definitely problem practice has to be happening from your end. If you guys want, I will do this question from our RTP. Shall we do this question from our RTP? Very good. We can do this question from our RTP. And alongside with this, what I would want to also discuss is the concept of GST. Shall we do that? First to start with, shall we do this question from final accounts in RTP? Shall we do RTP question? Come on, have a look. Mr. Samuel. Is this the one? Are you ready? Come on, let's quickly start with question number 9 from our RTP. One question on final accounts. So to begin with, we have capital. Where will this capital of 9,50,000 appear? Balance sheet, liability side. So we're going item wise item. We will not do first a trading account, close it, and then do P&L account and then do balance sheet. No, that is not how will it happen practically. That is not how you should do. Should keep your trading, P&L, balance sheet, manufacturing, everything open. Read the items in the order. Whichever item we read, wherever it belongs to, write it there and then go to next item. To begin with, we have capital. How much capital? 9,50,000. Let me take you to balance sheet. In the balance sheet, on the liabilities side, let me write capital. How much? 9,50,000 inner column. Why? There might be drawings, interest on capital, and profit to be added or loss to be deducted. So I'll write in inner column 9,50,000. Then I have with me sundry creditors of 3,25,000. That's also liability. I'll write it in my balance sheet liability side again. Let me write here sundry creditors. How much is that? 3,25,000. I have purchase returns of 50. Purchase returns, if you remember, I mentioned it should be deducted from our trading account. And I'll go to trading account. So this is our manufacturing account, first table, then trading, and then P&L. In trading account, I would be writing our opening stock and then purchases. This is a manufacturing company, no? So purchase return is purchase return of raw material. In consumption of raw material, we will do opening stock of raw material plus purchase of raw material minus closing stock of raw material. Purchase returns will be deducted from raw material consumption. So in my manufacturing account, I will write here to consumption of raw material. I'll write here opening raw material plus purchase of raw material minus purchase return of raw material. How much is purchase return? We just read here minus 50. Okay. Then what is the next item? Loan from Mr. Sahil, 4 lakh. If you have taken loan from Sahil, it's your liability. In your balance sheet, on the liability side, after sundry creditors, I will write loan from Sahil, 4 lakh. Understood? What is after loan from Sahil, 4 lakh? There is provision for bad debt, doubtful debts of 25,000. See, this is the provision which is already created in previous year. This is the provision which is already created in previous year. This is computed as a percentage of debtors outstanding in previous year. We might have to change this provision. We might increase or we might decrease depending upon debtors. If debtors has increased, we might make additional provision. If debtors has decreased, we might make lesser provision. So this provision might be incorrect. Let's say later they say provision has to be created at so much percentage of debtors. That percentage comes to 30. Additional 5,000 will be P&L account. So I know that I would have to make provision. So what would I do is, in my balance sheet, on the asset side, I'll write sundry debtors. I'll write less provision. How much is the provision which is already there? 25,000. Let me just remember that it is 25. I'll write here 25. This is not the final number, okay? 25k. This is the old provision. I would have to scratch that 25. If in case actually though I don't want to write, but for you to remember and not to come back, scroll up the question later, I've written 25 inner column. Got it? Then sales of 44 lakh 20. Trading account, credit side. This is our trading account. Credit side, let me write sales. How much is it? 44 lakh 20. Why inner column? There might be sales return. What if there is no sales return? Then I'll write it to outer column. What if there is sales return and you written it in outer column? ಅದಕ್ಕೆ ಇನ್ನರ್ ಕಾಲಮ್ ಅಲ್ಲಿ ಬರೆದ್ರೆ ಯಾವಾಗ ಬೇಕಾದ್ರೂ ಔಟರ್ ಕಾಲಮ್ ಬರೀಬಹುದು. ಔಟರ್ ಕಾಲಮ್ ಬರೆದ್ರೆ ಆಮೇಲೆ ಇನ್ನರ್ ಕಾಲಮ್ ಬರ್ಕೊಳಕ್ಕಾಗೋದಿಲ್ಲ. ಯು ಗೆಟ್ ಇಟ್? ಯಾ, ಇಫ್ ಯು ಕೀಪ್ ಸಮ್ಮನ್ ಇನ್ ಮನ್ಸು ಯಾವಾಗ ಬೇಕಾದ್ರೆ ಅವ್ರನ್ನ ಹೊರಗಡೆ ಕಳಿಸ್ಬೋದು, ಬಟ್ ಹೊರಗಡೆ ಇಟ್ಟರೆ ಯಾವಾಗ ಬೇಕಂದ್ರೆ ಅವಾಗ ಒಳಗಡೆ ಕರ್ಕೊಳಕ್ಕಾಗೋದಿಲ್ಲ. ನೆಕ್ಸ್ಟ್ ಮೂವಿಗೆ ಡೈಲಾಗ್. ಓಕೆ, ದೆನ್ ಬ್ಯಾಂಕ್ ಓವರ್ ಡ್ರಾಫ್ಟ್ ಇಸ್ 6 lakh. Where do you rate bank overdraft 6 lakh? Yeah, liability side, balance sheet. Shall I write in balance sheet, liability side, bank overdraft 6 lakh? After that, raw material opening stock of 2 lakh 50. This will come in our manufacturing account in computation of consumption of raw material. I'll go to manufacturing account. Here we have consumption of raw material. Opening balance is 2 lakh 50. Then finished goods opening stock 4 lakh 25. This will appear in trading account debit side. So in my trading account, on the debit side, I will write here opening stock 4 lakh 25,000. Okay. After this opening stock 4 lakh 25, there is purchase of raw material 34 lakh. When there is purchase of raw material 34 lakh, this will be added in computation of consumption of raw material in manufacturing. Come to manufacturing, I have no opening raw material plus purchase. How much is purchase? 34 lakh. 34 lakh. After this 34 lakh, what do we have next? Land 50,000. Land is an asset. This asset will appear where? Balance sheet, asset side. Let me write here land. How much is the value of land? Sir, why are you not writing in inner column? See, there is no chance of depreciating land. So I'll write in the outer column. It has indefinite useful life, no depreciation. Then we have building 6 lakh. Illi depreciation irbodu. So I'll write in balance sheet asset side, but inner column. What if there is no adjustment about depreciation, sir? Then I'll write it outer column. After building 6 lakh, loose tools. Yeah, loose tools 1 lakh 50 is again asset. I'll write in balance sheet asset side. Loose stools. How much? 1 lakh 50. It's not loose stools. It is loose tools. It is not STOOLS. TOOLS. Sir, ಏನು ಡಿಫರೆನ್ಸ್? ಆಮೇಲೆ ಸರ್ಚ್ ಮಾಡಿ ಯೂಟ್ಯೂಬಲ್ಲಿ ಲೂಸ್ ಟೂಲ್ಸ್ ಅಂತ ಹೇಳ್ಬಿಟ್ಟು ವಿಡಿಯೋ ಬರುತ್ತೆ. ಪ್ಲಾಂಟ್ ಅಂಡ್ ಮಿಷನರಿ 3 lakh. Yeah, plant and machinery of 3 lakh is again asset. I'll write in my balance sheet inner column. Why? There might be depreciation on the same. After plant and machinery, we have investment of 2 lakh 50. This is also asset. Hey, investment, there won't be depreciation. So I'll write investment and immediately post it to my outer column 2 lakh 50. Okay. What is it after investment? Cash in hand and cash at bank. Cash in hand and cash at bank both are our assets in balance sheet. So let me write cash in hand and cash at bank both in my balance sheet. Cash in hand, cash at bank. 115,500 and 43,500. See, 15,500, 43,500. Then I have furniture and fixtures 1 lakh 25. Again, there might be depreciation on this asset. So balance sheet asset side, furniture and fixtures, but inner column 1 lakh 25. I will keep it there so that I can depreciate it later. Once I'm done with furnitures and fixtures, then I'll go to sundry debtors, which is 3 lakh 75,000. This 3 lakh 75,000, I'll write in my balance sheet on the asset side 3 lakh 75. See, now we got it. But we don't know how much provision to maintain. We will get to know eventually, then I'll do it. For now, it's 3 lakh 75. Okay. After this, there is drawings of 60,000. Drawing 60,000 is a decrease in our capital. In the balance sheet, on the liability side, capital 9 lakh 50, less drawings 60,000. Don't write it outer column. Still profit adjustments will be there. Then we have salaries 90. Salary is indirect expenditure P&L account. If it was wages, I would have written in manufacturing account, not in trading. Let me write in P&L. See, this is manufacturing, this is trading, this is P&L. Salaries, how much is it? 90,000. What is after salaries? Next item, coal and fuel. What will you do with coal and fuel? Manufacture 1 lakh 5,000. So in my manufacturing account, after consumption of raw material, direct expenses will be coal and fuel, or manufacturing expenses will be coal and fuel of how much? 1 lakh 5,000. What is after this coal and fuel? Factory rent of 77,000. This is again manufacturing expense. Let me write here factory rent 77,000. There is some adjustment, so I have written in inner column. What you can actually do is you can read the adjustments first. Just glance through what items have adjustments and remember to write them in inner column. How do you remember? Keep one dot next to those items in the question paper, so that you will know that this has to be written in inner column. Got it? Then we have general expenses of 39,000. P&L account debit side. Where do we write it? P&L account. After salaries, let me write general expense 39,000 inner column. Then sales return 35. Sorry, sales return 55. What do I do with sales return 55? I should deduct it from my sales. In my trading account, I'll write here sales less sales return 55,000. Got it? Next, bad debt is 15,000. This is appearing in trial balance. What does it mean when it appears in trial balance? It means it's already deducted from my debtors. I don't have to again deduct it from my debtors. So this 15,000 of bad debts, I'll post it to my P&L account debit side. Where would I post it? P&L account debit side. So I'll write in my P&L account debit side bad debts. How much? 15,000. What do we have after bad debts 15? Direct wages is 1,20,000. Direct wages is factory. In manufacturing account, let me write direct wages. How much? 1,20,000 in outer column. After direct wages, power. Power is also expenditure in factory. I'll write here to power 80,000 manufacturing account debit side expense. After power, I have interest paid on bank overdraft. This is also expense, but not in manufacturing, not in trading, in P&L. In my profit and loss account, I'll write here to interest on bank overdraft 90,000 rupees. Got it? Then we have carriage inwards of 30,000. Carriage inwards of 30,000 is direct expense and manufacturing account expense. Carriage outwards is indirect expense, P&L account. Carriage inwards is expenditure incurred to bring the goods into the factory. Carriage outwards is expenditure incurred to take the goods out of the factory, out of the showroom, to give it to customer's place. So carriage inwards, manufacturing account debit side, let me write carriage inwards 30,000. Carriage outwards, not trading, in P&L let me write carriage outwards 25,000. Once I finish this, I am done with trial balance. Now I am going into adjustments. First one, stock of raw material and finished goods at the end of the year is 5 lakh and 4 lakh 37,500. 5 lakh raw materials closing stock will come in consumption of raw material in manufacturing account. Here I do opening plus purchase minus purchase return minus closing raw material of 5 lakh. If I do minus closing raw material of 5 lakh, what would be the value of my consumption of raw material? Help me. What do we get? 31 lakh rupees. 31 lakh rupees is consumption of my raw material. This 5 lakh rupees, whatever is here, no closing raw material, that is still my asset. Because it is still my asset, I will write it in my balance sheet as stock. How much is the stock? Raw material 5 lakh. And we don't just have stock of raw material. We also have stock of finished goods to the extent of 4,37,500. 4,37,500 of finished goods, what is remaining is again my stock. Balance sheet asset side, below raw material, I will write finished goods 4,37,500, making my total stock to be 9,37,500. And this closing stock of finished goods will be written in trading account on the credit side. I will go to trading account. On the credit side, let me write here by closing stock 4,37,500. For every item, we have to think of double entry system. Check where and all will it go, write it and then only proceed to the next item. By mistake, if you don't post one portion of an item and then go forward, at the end your balance sheet doesn't tally, your net profit will be or gross profit will be incorrect. You won't be able to spot what is wrong. You will spend 5-10 minutes extra to spot what is wrong. And then also there is chances of you not getting what is wrong. So it's okay if you go slow, but go item wise item. Ensure that you write it at every place where it should be written and then go to the next item. Then provision for doubtful debt should be maintained at 5%. How much is debtors? Come to balance sheet. 3,75,000 into 5%. 18,000. So debtors mele provision deduction should be 18,750. But actually existing provision is how much? See, to be maintained is 3,75,000 into 5%, 18,750. Existing provision is 25,000. So provision is in excess. Provision is 25. We should reduce it to 18,750. We have to write off provision worth of 6,250. We have to write off provision worth of 6,250. Provision was there at 25,000. We want to maintain provision at 18,750. When you reduce the provision from 25,000 to 18,750, we are writing off provision of 6,250. We are writing off the provision of 6,250. If you create provision, it is expense. If you write off provision, it is income. Let me repeat. If you create provision, it is expense. If you write off provision, it is income. 6,250 rupees of provision, what you are writing off. 6,250 rupees of provision, what you are writing off, will become income, and we'll write it in our P&L account on the credit side. Provision written off 6,250, which is no longer required. Provision written off is liability decreasing. So liability debit, credit will be income. Am I right? Next adjustment. Building 10%, plant and machinery 15%, furniture 10%. Depreciation. Building and furniture 10%, plant and machinery 15%. Building 10%, 60,000, making it 5,40,000. Plant and machinery 15%, making it 45,000. Balance will be 2,55,000. Furniture 10%, making it 12,500. Balance will be 1,12,500. This 12,500, 45,000, 60,000, all the three together is expense, which has to be debited to P&L account. I'll take them to P&L account. On the debit, I'll write to depreciation, building, furniture, plant and machinery, 60. Manufacturing account will baribeko, ill baribardu. 60 plus 12,500 is 72,500 here. This plant and machinery depreciation will come where? In manufacturing account. I had put it with an intention. Nanige 1 second. Depreciation of plant and machinery 45,000. I'm thinking about something else also simultaneously. Okay, understood this depreciation 45,000? Yes or no? What is after the depreciation adjustment here? 1 month factory rent is outstanding. So what is there in trial balance is only 11 months rent. What is there in manufacturing account is only 11 months rent. How much is the rent in manufacturing account? 77,000 is 11 months rent. Do 77 divided by 11? 7,000 per month. 1 month rent they have not paid. So they have not returned. Now we'll write plus outstanding 1 month's rent 7,000, making it 84. That 7,000 what will be yet to be paid will become outstanding rent liability in balance sheet. I'll take it to balance sheet. On the liability side, I'll write outstanding factory rent 7,000. Did everyone get it? What is after this outstanding factory rent 7,000? Interest as accrued on investments and rate of interest is 10%. We have investment in balance sheet asset side 2,50,000. On this interest is accrued, means earned but not received. How much is 2,50,000 into 10%? 25,000 rupees of interest is earned but not received. 25,000 rupees of interest is earned but not received. It is our income and also asset. I'll repeat, it is our income and also asset. In the balance sheet, I'll write on the asset side, accrued interest on investments, 2,50,000 to 10%, 25,000. And this 25,000 being my income, I'll write in my P&L account on the credit side by interest on investments 25,000. It is income, so P&L credit. If it is received, cash balance would have increased. Not received, so cash has not increased, but I'll still write it in my balance sheet as an asset 25. Receivable. Whenever it is received, we will eliminate this and increase our cash when it is received. Interest on Mr. Sahil's loan is payable at 12% per annum. Loan was taken on 1st of October. Year ending is 31st of March. October, November, December, January, February, March. How many months? Compute 12% interest for 6 months on Sahil's loan of 4 lakh. 4 lakh into 12% into 6 by 12. This is interest outstanding. Because of that, it is liability 24,000. And because this 24,000 is not paid, I have written it in the liability side. Whether paid or not, this is our expense. I'll write in my balance, in my P&L account, debit side as interest on loan from Mr. Sahil, 24,000. Interest on loan from Mr. Sahil, 24,000. Got it? What do we have after this interest on loan from Sahil? That's it. You are required to prepare manufacturing, trading and P&L and balance sheet. We have everything ready. We have everything ready. I forgot to write closing balance. WIP, they have not given opening and closing balance. If they would have given opening, WIP would have come here and closing WIP would have come here. Now, entire manufacturing account is closed to determine cost of finished goods manufactured. Take the total 31 plus 1 lakh 5 plus 84 plus 120 plus 80 plus 30 plus 45. How much? 35 lakh 64,000. This is completely cost of finished goods manufactured, which is transferred to trading account. In manufacturing account, I'll write by trading account. In trading account, I'll write to manufacturing account 35 lakh 64,000, which is cost of finished goods manufactured. Opening stock is there, closing stock is there. In the place of purchases, manufacturing account is there, sales is also there. We can find GP. 4420 minus 55. 4365. 4365 plus 437,500. 48 lakh 2,500 minus this. 8 lakh 13,500 is GP. From trading account, I'll shift it to P&L account credit side. 8 lakh 13,500 plus 6,250 plus 25,000. 8 lakh 44,750. Here 72,500 total depreciation written already. Now help me find my net profit, which is balance and figure. 844,750 minus all of these items. 5 lakh 4,89,250. 489,250. I'll add it to my capital to find the capital to be going to outer column now. 890, 12, 13, 1379,250. Take the total. 1379,250 plus 3 lakh 25 plus 4 plus 6 plus 7,000 plus 24,000. 27 lakh 35,250. This is our liability side. Take the total on the asset side. 50 plus 5 lakh 40 plus 1 lakh 50 plus 2 lakh 55. 1 lakh 12,500. 2 lakh 50. Debtors per the outer column. Okay. 375 minus 18,750. Let's write 356,250. Add investment 2 lakh 50. Cash 15,500. 43,500. Debtors 356,250. Interest accrued 25. Stock of 9,37,500. Do you get 27,35,250? This is how you compute entire closing balance of your balance sheet. So balance sheet tallies and we end the story. So the moment you close reading the question, it is 1 minute away of tallying a balance sheet. Once you finish the question to the bottom, you should not waste too much time. Your balance sheet should have been tallied. Don't read the question 2 times, 3 times, 4 times. You should be able to read the question one shot and then be able to answer it. And that one is not like full one reading. Line by line, you go on reading. Line by line, you go on solving. By this, we are done with the topic of final accounts of sole proprietors. Oh God, yeah, thanks for reminding. We'll do that GST part. So GST part, there is one question which is journal entry based in this one. Am I right? Oh, okay. We were doing that question from our study material. We'll do one question from our study material on GST. It's the newly introduced question. Question which has been newly added. Second module ala or first module? First module, last chapter. First module, last chapter. My God, you were right. It is in manufacturing, no, non-manufacturing entities. So there you go. This is the question. I will give the reference. This is question number 9. Shri Mittal question in your book. So they have given trial balance, and in trial balance along with lot of other items, you have input CGST, input SGST, and then output SGST. Sorry, output IGST. Do you have any other items? No. Adjustment, nothing. See, You have input CGST of 9,000, input SGST of 9,000, output IGST is how much? 15,000 is on the sales that you have made. When you made the sale of goods, you have collected 15,000 from the customer. Let me repeat. Output IGST is the money collected on the sale of goods. We've done journal entry in yesterday's video. Whoever is not understanding the basic part of GST, you can definitely watch yesterday's video on journal entries. In journal entries, I've done the SGST, CGST basic journal entry question. You see that and then you come back to this video. I'm not talking to you, I'm talking to the people who are watching it recorded. So output SGST, output IGST of 15,000 means this is the amount that we have collected on the sale of goods from our customer, which we have to pay to government. Because we have to pay this 15,000 to government, this is our liability. What is this CGST and SGST input of 9 and 9? This is amount that we have paid on purchases to our supplier. And against this input is available. How much have we already paid? 18. How much did we collect? So we don't have to pay any SGST, any IGST. 3,000 still it will be remaining. 3,000 still it will be. We'll keep 1,500 in CGST and 1,500 in SGST pending. Both places will keep 1,500, 1,500. We will adjust that input with output. Input is 18, output is 15. If they both clash, input 3,000 will be still remaining. So we don't have to pay any tax. If you observe your balance sheet, in the balance sheet there will be input CGST and input SGST of 1,500 each. Or you can write input CGST 3,000, input SGST 0. Output won't appear. Shall we see the balance sheet for this question? Come on, Barana. Balance sheet. See, input SGST 3,000. So full CGST they have taken off. But can I do that like, sir, input CGST I'll write 1,500, input SGST I'll write 1,500? Yeah, you can do. First you will adjust IGST with IGST. Then CGST with CGST, SGST with SGST, input output. If there is excess available, then you will adjust it with IGST. Okay, got that. Observe here, output IGST 9,000. They have adjusted, they have given the story. But did you understand this? There should be one more question, and I think I have also given some amount of theory here. We did this in our fast track batch. Let me quickly touch upon that again. This is there at the end of the sheet. Did we discuss this yesterday? No, this is not yesterday. Let me do this topic once again. Let's say we have sold goods for 100 rupees. On this 100 rupees sales, there is CGST at 5%, SGST at 5%. How much will be CGST? 5. How much will be SGST? 5. Together, how much will we collect from our customers? 110. 110. So, journal entry is cash account or bank account debit 110. In that, sales is only 100. 10 rupees what is extra is what we have collected by way of GST from our customer, what we should pay to CBDT, Central Board of CBEC, Central Board of Excise and Customs. CBDT is direct taxes for income tax. So, we need to pay them. So, I'll write here 2 output input output SGST, output CGST 5 and 5. Understood? Then let's say before this sale, we've also purchased goods worth rupees 80. On that, SGST and CGST is 5%. 4. We would have paid 88 rupees. When we paid 88, purchase account debit will be 80, but bank account credit is 88. Excess 8 rupees what we paid is 4 rupees CGST, 4 rupees SGST. This is input. What we have paid to our supplier who has paid it to government on our behalf, which we can adjust against this. How much have we already paid to government? How much have we already paid to government? 8 rupees. How much have we already paid to government? How much have we collected from the customer on behalf of the government? I have collected 10. I have already paid 8. Difference of 2 is there. No? That's what we are talking about, the adjustment here. I already paid 8. No. Out of the 10 I have collected, I don't have to pay full 10. 8 is already paid. I will pay only balance 2 rupees. I will pay only balance. How much did I collect on behalf of the government? 10. How much should I pay to government? Actually 10, but I won't pay 10. Why? I will tell I already paid 8 rupees. That you adjust against this. I'll pay only balance 2 rupees. Are you getting it? This is what we call as input tax credit. Now let me show it to you with working. CGST and SGST paid on purchase is how much? CGST and SGST collected on sale is how much? Am I right? CGST and SGST to be paid is 2 rupees. Got it? We have collected 10, but before we collect 10, we already paid 8. Balance 2, I will pay now. Got it? Yeah, because CGST and SGST paid on purchases is eligible for credit. So I will write output GST. Listen here. Here output CGST, output SGST I have credited. Why have I credited? Because it is liability. I will debit that 515. I will credit my input CGST. Here it is asset. That is the reason it is debited. This asset I will nullify by debiting it. 4 and 4. 5 plus 5, 10. 4 plus 4, 8. Balance of 2. Payment to be made to bank account, 2 rupees. If you have paid, you will write this as paid. If you have not paid, you will write it as output GST, output CGST 1 rupee, output SGST 1 rupee in balance sheet liability side. If you have not paid. In this question, they haven't paid. They are yet to pay. They are yet to receive actually. Here they have paid more, collected less. So that will appear as asset in the balance sheet. See, on the asset side they have written. Hello, previous question. Oh, this is a different question. Wait. Here, observe here. Input GST 3000. Got it? Let's see the next question also data. Here what do we have? 10, 10, 8, 8, 6. Oh, how much have we collected? 8, 8 and 6. How much have we collected? 8, 8 and 6. How much have we already paid? 10 and 10, 20. See, CGST, we have paid 10. We have collected 8. So we paid excess 2000. It collect. Input SGST, we have paid 10. We have collected 8. How much extra have we paid? 2 more. So CGST we paid 2 extra. SGST we paid 2 extra. IGST is interstate. We have collected 6 rupees. Am I right? This 4 is there, no? Excess of CGST, excess of SGST paid. This 4 will be adjusted against this 6. Balance will be 2 of IGST, what I will pay. What I will pay. Either it should be deducted from bank balance as payment or it will appear in balance sheet as liability. Output IGST 2000. Understood this? Yes or no? That's what you need to know with regard to your input tax credit and GST. Now can I call that final accounts of sole proprietorship is done? Manufacturing, non-manufacturing, everything put together? Very good. So yeah, Papa, ಅಷ್ಟೊತ್ತಿಂದ ಮಾತಾಡಿ tired ಆಗಿರುತ್ತಲ್ಲ ನಿಮಗೆ. Final accounts is done. Let's take a short break, about 10 minutes. It's 7:10. See you all back at 7:20. When we start, let's do not-for-profit organization. So take a break. Come on guys, there we go. We're back. Let us now discuss the topic of not-for-profit organizations, NPO. Very good. Come on, let's start with not-for-profit organization. NPO. Number has been changed. NPO is now chapter 8. Can I have your attention? Not-for-profit organizations. As the name itself suggests, no, the objective of the organization is not to make profit. It is to promote a specific cause, fight against the social evil. fight for literacy in the people, educational institution, fight against malnutrition, providing child welfare, fighting against what do you say, social evils, creating what do you say, awareness or education among people like a library, or promoting one specific sport like IPL, BCCI. All of these are not for profit organizations. You want to provide healthcare facilities to people, hospital. The objective is not to make profit. Objective is to give service to people. Got it? So in these things, because the objective is not to make profit, we won't prepare P&L account. We prepare something like P&L but not P&L. We call it income and expenditure account. And there is one more change. We don't prepare cash book. We don't prepare it cash account. We call it receipts and payment account. What do we call it? And there is nothing like trading account. There is nothing like trading account. That purchase, sale, net off, if there is profit, actually you should not make profit. If you make profit, it will not be called as profit, it will be called as income, and it will be written in income and expenditure account only. So we don't have any separate trading account, it will all be adjusted in income and expenditure. So normal ledger accounts will be prepared like we do anything else. In the place of cash book, we prepare receipts and payment account. In the place of P&L account, we prepare income and expenditure account. And we do balance sheet exactly like how we do otherwise. We won't call it profit. If the income that we get is more and expense that we get is less, we won't call it profit. We call it excess of income over expense. We call it excess of income over, the new name to it is surplus. If in case our expense is more than income, expense is more than income, that is not called as loss. Instead, it is called as excess of expense over income, or that is called as deficit. What is the other name to it? Very good. So this surplus or deficit will appear in our income and expenditure account, and obviously we prepare balance sheet as usual. And the capital in the balance sheet is not one person's capital here, because it is a not-for-profit organization. We do fund-based accounting. We call it capital fund. What do we call it? Capital fund. And other than that, rest everything is basically based on our accrual system of accounting. Prepaid expenses are asset, outstanding expenses are liability. Accrued income is asset, and then pre-received income is liability. Asset will have opening balance on the debit side, liability will have opening balance on the credit side. Assets closing balance is on the credit, liabilities closing balance is on the debit. Prepare these kind of ledger accounts. Don't do plus minus. When you do this ledger, you will identify how much is the amount paid or received, amount income or expense. If it is paid or received, you post it to receipts and payment account. If it is income or expense, you post it to income and expenditure account. So opening balances and closing balances will be written along with receipts and payment account. You will find income and expenditure as balance. Or you write opening balances, closing balances, and income and expenditure to find receipts and payment as balance. In the question, usually they will give receipts and payment and opening balance sheet, ask you to prepare income and expenditure and closing balance sheet. Or they'll give opening balance sheet and income and expenditure, asking you to prepare receipts and payment and closing balance sheet. Or they can give you opening balance sheet and some data, ask you to prepare receipts and payment, income and expenditure, and closing balance sheet. There is one question where they have not given opening balance sheet, they have not given closing balance sheet. They want you to prepare receipts and payment, income and expenditure, opening balance sheet, and closing balance sheet. That becomes a master question. One thing that's slightly tricky that people find annoying here is subscription account. What is it? Remember that subscription is income to the entity. What is subscription? If in case that income is earned, that income will appear in the credit side in income and expenditure, here debit side in subscription account. If it is received, it will come in receipts and payment on the debit side, so in subscription account on the credit side. If it is subscription accrued but not received, asset, debit side. Opening debit side, closing credit side. If it is received in advance, it is liability, opening credit side, closing debit side. Don't do plus minus, always do ledger. You will become very comfortable, and then so you won't be annoyed with this kind of a problem. Other than this, it is very difficult to explain anything in this topic without taking up the numbers. We have to take up numbers. What we will do, straight away we will jump into our RTP question. Shall we? Oh, close our file. Let's open our RTP question. We'll solve this RTP question from our foundation. Revision test paper, foundation accounting, bills of exchange over, final accounts over, Let's see what question have they given in our revision test paper. They should have given first NPO question, alva, and then given incomplete records. Okay, first there is an incomplete records question. After that we have partnership question. After the dissolution, NPO question ilva. Either Hilfiger Sports Club gives you the following receipts and payment account. So they've given receipts and payment. They've given balance of assets and liabilities. They want you to prepare club's opening balance sheet as on 1/4/2022, income and expenditure account, and closing balance sheet. Shall we quickly do this question? Come on, let's solve this question. We are required to prepare club's opening balance sheet, income and expenditure account, and closing balance sheet as on 31st of March 2023. Solution to question number 13. Solution to question number 13. I'm just putting it in the right place. 9th one over, 10th one over, 11th one over, 12th one over. We'll do 13th one here. NPO. We'll first prepare our opening balance sheet. They've asked everything, no, in the same order. So I'll write here balance sheet as on. If they mention the date, I'll write the date. This will be my liabilities side, and this will be my amount column. Take 3 columns, should not be an issue. I'll have an nice inner column. Because I am doing it from the scratch. If you would want to do it along with me, you can. You are like, who will write, sir? You write. I am writing exam this time, no, not you. So I have an obligation to write. You don't have to. This is our balance sheet. Similar to balance sheet, we'd have to prepare our income and expenditure account. Shall I prepare income and expenditure account also? I'll keep everything ready and then start with my answer. Debit side, credit side, I'll write income. This will become particulars. If you want, you can write expenditure on the debit and income on the credit instead of particulars. That is also absolutely fine. What else do we have to prepare? We'd have to prepare balance sheet, closing balance sheet. We'd have to prepare closing balance sheet. So this is a question where we have to prepare 2 balance sheets. Interesting. And we might have to prepare few ledger accounts whenever there is adjustment. We'll see to it and then do it later if required. Shall I start from the beginning? Have they asked balance sheet as on 1/4/2022? This balance sheet is as on 1/4/2022. Closing balance sheet is as on 31st of March 2023. As on 31st of March 2023. So both the balance sheet dates are ready. Now we'll begin the question from the beginning. What is the name of the our NPO? In the books of Hilfiger Sports Club. Adu Tommy avaraду baruttalva. In the books of Tommy Hilfiger, no, only Hilfiger, Hilfigeri. In the books of Hilfigeri Sports Club. Ready? To begin with, first item. On the receipt side, we have opening cash and bank balance of 1 lakh 4. Opening cash and bank balance of 1 lakh 4. I'll write in my opening balance sheet as asset. I'll write cash and bank balance. How much is cash and bank balance? 1 lakh 4,000. Okay. What do we have after this? Subscription of 6 lakh 96,000. Subscription of 6 lakh 96,000. Whatever is received will become my income. If there is nothing called outstanding or pre-received, just look at the balances. Do we have anything related to subscription here? Yeah, subscription receivable 1 lakh and 2 lakh 40. What does that mean? That means there is some adjustment with regard to subscription. When there is adjustment, what do? I'll open ledger. Always, whenever there is adjustment, what should you do? Open ledger account. What is the name of the ledger? Subscription account. What is the name of the ledger? Understand, in our receipts and payment account, we have debit side to subscription. In our subscription account, what should I write? Credit side, I'll write by receipts and payment account. What is the amount? 6 lakh 96,000. This is the amount received. This is the amount. Everyone understood this? Okay. Safety care. I'll copy paste this ledger. We might have to open few ledgers. So I'll keep 2 ledgers ready. Let's see, if in case we need, I'll write. If in case we don't need, then I'll delete. Subscription account 6 lakh 96 done. Then we have donations of 2 lakh. This is donation received. Received. They should tell whether this donation is capital in nature or revenue in nature. If they tell that this donation received is capital in nature, I'll add it to my capital fund in balance sheet. If they don't tell, if they tell that it is not capital in nature, then I'll write it in my income and expenditure as income. Let us just see what have they given. Guys, you would have to stop munching, eating, and then focus. Not in a park. How many times should I say? You guys should understand when I tell it once. I try to ignore doesn't mean that you think I don't care. They have given very clearly donations are to be capitalized. So these donations of rupees 2 lakh has to be added to capital. In the closing balance sheet, I don't know my capital fund. I'll write here capital fund here. To this capital fund, I'll add donations. How much is donations? 2 lakh. I'll add 2 lakh here. Got it? What do we have after these donations of 2 lakh? Interest on investments is 24,000. Interest on investments. Is there anything called accrued outstanding here? Opening balance, closing balances, anything? Investment is there. Interest. See, 12,000, 12,000. There is some adjustment. So what do? Whenever there is adjustment, don't think too much. Open ledger account. Open ledger account. What is this ledger on? Don't think that you will handle it. When you say you will handle it, that's when you will mess it up. In investment account, in receipts and payment account, it is there as 2 interest on investments. So in interest on investment account, I'll write by receipts and payment account. This is interest received. How much is it? 24,000. If there was no adjustment, that would have become my income. Now there is some amount of excess received or shortage received. So we will deal with it in the ledger and then post it to my income and expenditure. In receipts and payment, it is 2 interest on investments. So in interest on investment account, I'll write by receipts and payment 24,000. Got it? What is after this 24,000? Sundry receipts is 6,000. We have collected some receipts 6,000. Is there any adjustment with regard to the sundry receipts anywhere here? No. So I'll assume that sundry receipts is my income. What is the sundry receipts? Income. This will go to income and expenditure account. In income and expenditure, I'll write on credit side by sundry receipts. For some miscellaneous services, you collected money. How much have you collected? 6,000. Got it? By this, we're done with the receipts and payment receipt side. Now I'll go to payment side. If in case there is adjustment, I will adjust it. If not, I'll straight away post it to my income and expenditure as expense. How much is my payment here? Salaries of 3 lakh. Is there anything like outstanding salary or advance of salary here? Yeah, salaries 20 and 40. There is some adjustment. Don't think I will add 20, deduct 40 or add 40, deduct 20. Don't think. Open one ledger called salaries account. Open one ledger called go on solving in the order and always open ledger. Ledger will save your time. Do you remember? Ledger will save your time. Sir, really? Yeah, 3 months. ಯಾರಿಗುಂಟು ಯಾರಿಗಿಲ್ಲ ಮುಂಚೆ 6 months. Now exam 3 times here, no? 3 to 4 months it will save. So in our receipts and payment I have written by salary. So in our salary I'll write 2 receipts and payment. How much is 2 receipts and payment here? 3 lakh. Got it? Understood? Then after that rents and taxes 1 lakh 8. If there is any outstanding prepaid adjustment, I'll open ledger. If there is no adjustment, 1 lakh 8,000 what is there as payment will become my expense. Check, do we have anything called rents and taxes? Yes, there is some adjustment. So what do? I'll open another ledger on our rents and taxes. Okay. Rents and taxes account. In receipts and payment, I have written by rent and taxes. So in my rent and taxes account, I'll write 2 receipts and payment. How much is receipts and payment? 1,08,000. What is after receipts and payment in rents and taxes? Electricity charges of 12,000. Do we have any adjustment with regard to electricity charges here? Yes. Don't give a second thought. Silent agi ledger open ಮಾಡಿ. If you open ledger, if anything goes wrong, you can check what has gone wrong. If you don't open ledger, if anything goes wrong, you don't even know what has gone wrong. And it is subject of accounts, not subject of statements. Electricity charges alva. You don't have to write full format in the exam. Just write debit credit and then just go on writing the amounts. Write the heading electricity charges, more than sufficient. How much? 2 receipts and payments. In our receipts and payment I have written by electricity charges 12,000. So in electricity charges I'll write 2 receipts and payment 12,000. Clear? What do we have after this 12,000? Sports goods 40,000. So sports goods worth of 40,000 is purchased. Don't write this 40,000 as expense. It's not expense, it is asset. But if you have purchased 40, if the closing balance is 30, 10,000 is sports goods destroyed, that is depreciation, or consumed, that will become expense. So sports goods, open one ledger. There will be opening or closing balance of sports goods. See, have they given? Yeah. 1,60,000 opening. So don't think much. Let me write here sports goods account. In our receipts and payment, we written by sports goods. In sports goods account, I'll write 2. If you don't prepare ledger, it might or might not tally. If you prepare ledger, there is no way you can miss even one item. 100% tally aage aagate. You might take 2 minutes extra, 3 minutes extra, 4 minutes extra. But it will not happen like it didn't tally. And if it doesn't tally, you know what went wrong. You finished 5 minutes early, but it didn't tally. What is the point? Am I right? Yeah. So doing it correctly is important, not doing it fastly. Library books 2 lakhs. Is there anything like library books here? Yeah. Library books 2 lakh. What is this? This is like opening balance. And then how much is it? Purchase is there. 2 lakhs. Maybe closing balance will become 4 lakhs. So yen madadu. Library books. Okay. I'll write here 2 receipts and payment. How much? 2 receipts and payment. How much? 2 lakh. Clear? What is after that? Newspaper and periodicals. There is no adjustments for this. Is there any item? Oh yeah, 8 and 10. So what to do? Again, simple. Silent solution. It won't take too much time. You have a big trust problem, no? Newspaper and periodicals. How much is it? Receipts and payment. 21,600. And we have something called miscellaneous expenses for which you have paid 1 lakh 8. Is there anything called outstanding expenses? Miscellaneous? No, there is nothing. So what do? Outstanding expenses, sorry, this miscellaneous expense, whatever you have paid, we will write it in our income and expenditure on the debit side as expense. How much? 1 lakh 8. Come to our income and expenditure ledger. This is our income and expenditure. I'll write here on the debit side 2. Miscellaneous expense. How much is that? 1 lakh 8,000. What do we have after this 1 lakh 8,000? The next item is last one. Closing cash and bank balance 2 lakh 40,400. This closing cash balance of 2 lakh 40,400 will appear in our balance sheet. Closing balance sheet. Let me write here. Closing cash and bank balance 2 lakh 40,400. This is the number. Got it? What do we have after this? Then we'll go to our trial balance kind of data. Outstanding expenses. First one, salary. Outstanding means what? Liability. Opening 20, closing 40. Come to our expense ledger. What ledger? Salary. Liability, opening balance, credit side. Liability, closing balance, debit side. Let me write by balance brought down. Opening outstanding. How much is opening outstanding salary? 20,000. And this same to same, I'll write closing outstanding. 2. Balance carried down. Closing outstanding salary 40,000. Opening outstanding 20 on the credit, closing outstanding 40 on the debit. And this will go to balance sheet. Opening outstanding is liability in opening balance sheet. Closing outstanding is liability in closing balance sheet. So let me take you to opening balance sheet first. In my opening balance sheet, I'll write on the liability side. Outstanding salary. How much is opening outstanding? 20. Same to same, I'll write in my closing balance sheet. This is my closing balance sheet. How much is closing outstanding? 40,000. So I've written 20 and 40. Done. Next item. Newspaper and periodicals. Outstanding. Opening 8. Closing 10. Again same. Opening balance sheet, closing balance sheet and in ledger. I'm here. No. Let me finish writing here. Outstanding newspaper periodicals. How much is closing outstanding? 10,000. This is closing balance sheet. This is closing balance sheet. 31st of March 2023. I'll write in my opening balance sheet. How much is opening balance sheet? This will go to our ledger account. This will go to our respective ledger. Let me go to our newspaper and periodicals ledger. In my newspaper and periodical ledger, liability alva, I'll write opening by balance brought down. How much is balance brought down? Okay, this is opening outstanding. I'll write here to balance carried on. How much is balance carried on? 10,000. Written in the ledger, written there. Now automatically when you find balance in figure, you will get income and expenditure. You don't have to think what should be added, what should be deducted. This is not mathematics. So maths paper you do plus minus. Accounts paper you do ledger account. You're like no, accounts paper lo maths e ಮಾಡ್ತೀನಿ. ಮಾಡಿ. Rents and taxes 12 and 12. Opening outstanding 12, closing outstanding 12. Come to rents and taxes ledger. Rents and taxes. Let me write here by balance brought down is how much? 12,000. I'll write here 2. Balance carried on is how much? 12,000. and this will go to my balance sheets, both the balance sheets. Let me write in both the balance sheets. Outstanding rents and taxes. Is it rents and taxes? Yeah. 12,000 closing balance sheet. Same to same will appear in my opening balance sheet also. This is my opening balance sheet. Let me write open outstanding rents and taxes opening balance is also 12,000. What is after this? Electricity 16 and 20. 16 opening, 20 closing. Let me write outstanding electricity how much opening outstanding? 16,000. Now in the closing balance sheet, how much is outstanding electricity closing? How much? 20,000. This has to go to our electricity charges ledger. Shall I go to electricity charges ledger? In my electricity charges ledger, opening balance, I'll write on the credit side by balance brought down. How much? 16,000. Balance carried down. How much? How much? 20,000. Where were we? Where did we stop? We wrote receipts. We wrote electricity charges opening and closing balance. No, 16 and 20. Then we have library books. Library books opening balance is 2 lakh. Wait, did we write this 16 and 20 in balance sheet? Let's see. See, we've written electricity 20 as well as 16. Then I have with me library books, 2 lakh rupees opening balance. I'll write in my opening balance sheet library books. How much is library books? 2 lakhs opening balance. And library books should appear in my closing balance sheet also. There they have put dash closing. Dash doesn't mean 0. Dash means don't know. Dash doesn't mean 0. Dash means don't know. You have to find it and then write. So I'll write library books in the balance sheet and then leave it empty. We will find it. I think we have opened one ledger called library books. Have we? Yes. There I'll write opening balance. 2 balance brought down. How much? See, 2 lakhs worth of books were there in the library at the beginning. 2 lakhs worth of books are purchased during the year. Do you really think the closing balance is 0? If you assume closing balance is 0, that means library books worth of 4 lakh are depreciated 100%. Newspaper and periodicals are depreciated 100% in the same year, not library books. People who come to library don't eat books. They keep the books there only. And 2 lakhs rupees worth of books it is purchased, it will be there for few years at least. Am I right? People might tear one page here and there, but book will be still there, no? Hardbind. So this has to be closing balance. If in case you don't prepare ledger, there is a very high probability that you might think closing balance is 0 and write 0 in the closing balance sheet. If you open ledger, this will trigger that, oh my god, closing balance is missing. We have to write. Got it? After library books, sports goods, 1,60,000 opening balance. Again, sports goods, it's not closing balance is 0. We have to find the closing balance. In my sports goods ledger, I will write debit side 2 balance brought down. How much is balance brought down sports goods? 1,60,000. And this sports goods 1,60,000 I will write in my balance sheet, opening balance sheet as asset. In my opening balance sheet on the asset side, let me write sports goods. How much? 1,60,000 in the balance sheet asset side. And in the closing balance sheet asset side, I will write sports goods. But I will not write amounts. Why? We have to find how much is sports goods. I'll find it and then I'll write it. Till then I won't write it. Got it? What is after sports goods? Furniture and fixture. Again, opening is 2. Doesn't mean closing is 0. We have to find the closing balance. I'll write furniture and fixtures. This is my closing balance sheet. So I'll leave it empty. I have to find. Once I find, I'll write. In my opening balance sheet, on the other hand, let me write furniture and fixtures. How much is it? This 2 lakh will also appear in my ledger. Come to furniture and fixture ledger. Furniture and fixture ledger. Furniture and fixture ledger. We haven't opened. So there is no receipt, no payment. There is no receipt, no payment. If they give depreciation adjustment, which they have given, we'll depreciate it and write. So what will I do? I'll write here 2 lakh in inner column. If I would have opened ledger, I would have written there. Right now it is 2 lakh. If there is receipts, it would have been, we would have added further money. Sorry, if it is receipts, it means it is sale, we would have deducted. If it is payment, then it means we have purchased the asset, I would have added. Right now I'll write in the inner column, waiting to depreciate the same. What do we have after that? Sports goods. Oh, sorry. Here. Where are we? Sports goods over, furniture over, subscription receivable. This is accrued income. Income earned but not received. What is this? Income earned but not received. 1 lakh opening, 2 lakh 40 closing. So in my opening balance sheet, I'll write here subscription receivable. How much is asset? 1 lakh. And in my closing balance sheet, I'll write subscription receivable. How much is the closing balance? 2,40,000. And both will go into my subscription account. It is asset, no receivable. I'll write on the debit side balance brought down. How much is balance brought down? I'll write here balance carried on. How much is balance carried on? 2,40,000. Got it? After this, we have investment in government securities. This is asset. If they have not told sold or purchased, same will be closing balance. In receipts and payment, they have not given any purchase or sale of investments. So 10 lakh, what will come in my balance sheet as an asset, same to same it will come in my balance sheet closing also as an asset. Investment in, how much is investment in government securities? This is asset in opening balance sheet. Same to same I'll write in my closing balance sheet also as asset. I'll write the same item as my asset in closing balance sheet also. Got this? After this, accrued interest 12,000, opening, closing. Accrued interest is asset. I'll write in opening balance sheet as accrued interest. How much? 12,000. I'll write the same thing in my closing balance sheet also. If you remember, we opened one ledger for interest. In that ledger, I would have to write this as asset. Interest on investment, asset, opening balance. I'll write to balance brought down. How much is it? 12,000. Here by balance carried down, 12,000. See, this question adjustments are simple. Adjustment can become much more complex. If you open ledger, whether it is simple or complex, more than one adjustment is same ledger. We will be doing the same thing. Are you getting it? So doing ledger will ensure that even a complex problem will become simpler because we don't have to remember too many things. Accrued interest 12 over. Now we have only 3 adjustments to do. Once I finish reading the question, my answer is 99% done. Read the first one. Furniture and fixtures 10%. Am I right? Here we don't know the value of furniture and fixture. Sorry, we do know. I'll write less depreciation here. How much is depreciation? At what rate? At 10%. How much is it? 10%. Can I say this will become 1,80,000? Very good. This depreciation is expense. It will go to my income and expenditure. I'll write here 2. I'll wait for all the depreciations together and then I'll go to put it outer column. But I will not wait for writing it. I'll write furniture and fixtures, but I'll write it in inner column. How much is the depreciation? 20,000. In my income and expenditure, I've written expense to depreciation, furniture and fixture 20,000. Then I have sports goods 20%. I don't know the value of sports goods. Do I know the value of sports goods? On that, I'm going to do depreciation of how much? How much percentage? 20%. So later, when I find the value of sports goods, I will write it here and then depreciate. For now, I won't. If you want, you can do it in the ledger also. If you want, you can do it in the ledger also, or we can skip. Not an issue. Then what do we have? Library books, 10% depreciation. Library books also should provide depreciation. Let's do the same. How much percentage? 10%. I don't know the value of library books. The moment I write it, I'll compute depreciation. For now, I will wait. Okay, here I'll write sports goods and library books also. Let's close the ledger later. Now don't go to the ledger. Now finish the question. Provide full depreciation on additions. So don't do any 6 months depreciation. We are assuming that assets are purchased at the beginning of the year and we provide depreciation 100%. Means like for full year. Like 10% for full year, not 100% depreciation. Donations are to be capitalized. We're already done with that. We just finished reading the question now. We went on reading the question in the order. We never went like back and forth, back and forth, back and forth. Full question finished reading. Now come to the answers. Balance sheet has to be closed. Opening balance sheet. Here everything is there. Only thing missing is capital fund. Only thing missing is capital fund. We will not close the balance sheet right now. We'll try and close every other ledger and then come to balance sheet. Why? What if there is some balancing figure in any of the ledger which is opening balance? So actually it's not there in this question, but such kind of adjustments are there in other questions. As a precautionary measure, I am not closing the balance sheet, but actually I can close the ledger right now. This income and expenditure also I'll close at the end. Why? All those ledgers what I prepared now, in those ledgers we'll get balancing figure as income and expenditure. We can. So I will not close. I will wait till the end. Then come to balance sheet. This also will be closed later. Not right now. Not in hurry right now. So I will go to what is there next. What is there next? On the ledger. Subscription. Opening is there, closing is there, receipts and payment is there. Balancing figure will be income and expenditure. Opening, closing, receipts and payment, income and expenditure. 4 items will come. If opening, closing, receipts and payment is given, balancing figure will be income and expenditure. If opening, closing, income and expenditure is given, balancing figure is receipts and payment. But in this question, opening balance, closing balance, receipts and payment, all three are given in the question. So every ledger will find balancing figure as income and expenditure only. Are you getting it? How much is the balancing figure here? 9,36,000 minus 1 lakh. Usually, if not, you should remember, no, opening accrued minus so, closing accrued add, opening outstanding, what to say, plus closing outstanding minus, so many things to remember. No? You don't have to do all that nonsense. So take the total on the credit minus the total on the debit. Easily you will get the balance. That will be income and expenditure. Do you understand that this becomes easy? It might make you feel like opening ledger will make it lengthy, but once the ledger is open, closing the ledger is very, very easy. Identifying the balance is very, very easy. There is no way that you will miss. There is no way that you will forget. You can stop the problem for 5 minutes, go one round, come back and continue the problem from where you left. Without remembering even one thing, you will be able to still close the problem. If you try to do thinking in the mind to identify the income, no, then you cannot stop the problem, go for one round, come back and then do. See, I stopped the problem, 10 minutes I stood here, I spoke to you people sweetly. I am back at doing the problem, I am still able to continue the problem without any hiccups. It will tally in the first go. Got it? So be ready for that. To income and expenditure 836. In income and expenditure, I'll write by subscription. How much is that? 8,36,000. So we closed our subscription ledger. Did we? Yes or no? Come to interest on investment. Opening 12, closing 12, 24. Receipts and payment is there. You tell me what will be balance and figure. Income and expenditure. We don't have to think too much. 36 minus 12. 24,000. This 24,000 is to income for current year. In interest on investments, I've written to income and expenditure. In income and expenditure, I'll write by interest on investments 24,000. Let me write here by how much? 24,000. Got it? What is after that? Interest on investment over. Come to salary. 3,40,000 debit. 20,000 credit. What is the balancing figure? Yeah, that will be income and expenditure only. Current year expense. (3,40,000 minus 20). 3,20,000. Correct? This 3 lakh 20 is income and expenditure debit side to salary 3 lakh 20. Shall I write? Come to salary, income and expenditure. Here you write debit side to salary. How much? 3 lakh 20,000. Done. After salary ledger, interest over, salary over, rent and taxes. There is opening balance, closing balance, receipts and payment. Balance and figure will be by income and how much? 1 lakh 8. In rents and taxes, I have written by income and expenditure. In income and expenditure, I should write 2 rents and taxes 1 lakh 8. Come here, let me write 2 income and expenditure 1 lakh 8. Sorry, 2 rents. How much? 1 lakh 8,000. Then after rents and taxes, electricity charges. Here we have opening balance, closing balance and balance carried out. Balance and figure will be by income and expenditure. Can I say it is 32,000 minus 16,000, which is another 16,000? Yes, this 16,000 I'll write in my income and expenditure as 2 electricity charges 16,000. Let me write here 2 how much is it? 16,000. What is after electricity charges? Come to next ledger, sports goods. Sports goods, opening 1 lakh 60, purchases is 40. Can I say closing balance is 2 lakh? We'll do it in balance sheet straight. All the other items are there, no? On this also we'll do depreciation there only. Can I write it in sports goods account as by income and expenditure? Yeah, I can. Here only I can write by income and expenditure depreciation. I can do it here 20,000 and write balance carried on as 1 lakh 80. But beda, other items are there, no? We'll do it here only. 2 lakh 2 lakh is sports goods. Depreciation on that is 20%, 40. Closing balance will become 1 lakh 60. This 40,000 depreciation will go to our income and expenditure debit side. Sports goods, how much depreciation? Instead, you can write that 40,000 in our sports goods account only credit side and income and expenditure account debit side. And here I can straight away write 160 as balance carried on from sports goods to here, which is absolutely fine. Allowed. You can do. Nothing wrong. I wanted to just write everything in the face of the balance sheet for the sake of writing. No other reason. Then, okay, we were closing the next ledger, no? Sports goods ledger over. Then library books. 2 lakh opening, 2 lakh purchased. Can I say 2 lakh is closing balance? Sorry, 4 lakh is closing balance. Balance carried down. 4 lakh. I'll write this entire 4 lakh rupees in my balance sheet. Shall I? Come to our balance sheet, library books, 4 lakh. Depreciation 40. Closing balance 3 lakh 60. And this 40,000 depreciation, whatever is there, no? I'll write it in my income and expenditure as expense. Depreciation. So 40. How much will become our total depreciation in that case? 40, 40, 20. 1 lakh. Got it? What is after this depreciation of 1 lakh? Next, library books ledger is also closed. Electricity over, sports goods over, library books over, newspaper and periodicals last ledger. There is opening balance, there is closing balance, there is receipts and payment. Balance and figure will be, what will it be? Yes, sir, amount kelila. Income and expenditure. How much will it be? 23,000. This 23,600, which is newspaper and periodicals. In my newspaper and periodicals ledger, I have written by income and expenditure. In income and expenditure, I'll write 2 newspaper and periodicals, 23,600. Come on, in my income and expenditure, I'll write 2. How much? Done. All the ledgers are closed. Now, balance sheet. Here, balance and figure is capital fund. How much will be capital fund? 17,76,000 minus whatever these items are there. 17,20,000 is capital. Ouch. $17,20,000 alva. 17,20,000 is capital fund. And this capital fund will come to our closing balance sheet. How much? 17,20,000. Got it? Then we'll close our income and expenditure. How much is our excess of income over expense? Or what do we call it? Surplus. How much is surplus? 8,66,000 minus 6,75,600. You got 1,90,400. 1,90,400 we'll add here. Surplus. See, you didn't find any difficulty in any adjustments. Which one to add, which one to deduct, because you did ledger. If you wouldn't have done ledger, you are supposed to think opening outstanding, closing outstanding, all that. I've written this in balance sheet, I've not written all the doubts. 21,10,400 capital fund done. Just scroll down to see balance sheet tally. 21,92,400, very comfortably it will tally. There is not even 1% probability of balance sheet not tallying. In incomplete records, in NPO, in final accounts, anyway, if you follow double entry system. Double entry system itself says that, no, double entry, it will tally. If you don't do this, if you think of shortcut, then be ready for some heart attack at the end that it will not tally. It will be missing some 30,000 or 40,000. Then you would have to search what has missed. You don't know where is that item. You might check 40 somewhere, but there might be two adjustments of 20,000 which you missed. One of 30, one of 10, or one of 90,000, one of 40,000, because of which 50,000 there is difference. So you can't figure out. Then you almost spend the entire time to do the entire question once again. If you have any friends who tried the question in the exam and their balance sheet doesn't tally in the exam, ask them what kind of panic attack they get. You start panicking in the exam. You spend 20 minutes. I'll tell you the reason why happens. You spend 20 minutes on one problem. And when you start that, no, you start with very high confidence and hope that this will pakka tally. I've worked on this. I've attended classes. I will tally. You start with full confidence. And somewhere, somehow, human beings, no, when you try to think too much, you might do some error. And if it doesn't tally, you are in a very difficult situation there. Whether should you stop this question and start next question? Or should you try and find the error? Where is it? If you try and find the error, 5 minutes you spend in finding the error. If you find it good, what if you don't find? That is the fear. 5 minutes problem aglilla. So adagle. If it happens, it's okay. Make your heart strong. Go to next problem. If you have time at the end, you come back. Even if your balance sheet doesn't tally, if 90% of the problem is correct, 18 marks, 14 marks, they'll still give. For a 20 marks problem, they'll give 18 marks. For a 16 mark problem, they'll give 14, 12. If you got majority of them right with 1, 2 wrong. But we don't want to be in that situation. Only way, double entry system. And you might just survive. Some people will say, hey, I passed foundation. I didn't do double entry only. You might pass foundation. You might only pass foundation. You get this? They told, no, RCB, we came so far not to come only this far. We have come so far not only to come this far, to go further beyond. And if not today, tomorrow, if not tomorrow, day after, if not foundation, if definitely at inter, if not at inter, but at final, you have to do double entry. So start now. Why are you delaying? One or the other day you have to learn. Start it now. Don't delay it. If not, that suffering will become more. And we have done with NPO one question. Like I mentioned, NPO, it's very difficult to try and conceptualize and then tell it in statements. So it's always nice if you solve a problem. Same with incomplete records and NPO. So we have successfully finished the topic of NPO. Because we were left with one chapter yesterday, depreciation, amortization, we are left with one chapter today, incomplete records. We'll try and do this topic of incomplete records in tomorrow's class. And I was okay to leave this topic incomplete. The reason being, we have uploaded complete all the parts, full discussion, detailed discussion about 5 parts of videos on incomplete records on YouTube. You can watch it full free. It's all there. But someone asked me to just still do it because you don't know how to revise it. Okay, I'll give you a brush up in tomorrow's class. Like how we do other topics, we'll try and do incomplete records tomorrow. I wanted to keep only partnership and company accounts for tomorrow. but now we have another topic, incomplete records, to do. Let's try and do it at the end. Okay, is that fine? That said, guys, was today's session helpful on depreciation, bills of exchange, final accounts, and NPO? Tomorrow we'll be doing partnership and company accounts. We'll start with partnership and then go to company accounts. We'll be doing it like the exact way. Maybe we'll stress a little more on redemption of debentures, redemption of preference shares, bonus issue, right issue, and dissolution of partnership. Hoping to see you all in class tomorrow. We'll solve our RTP question on those topics. And if in case there is a difficult adjustment, we'll also open our ICA study material and go through that specific adjustment. Today we did it for final accounts and we also did it for amortization. Similarly, because those three topics are new, we'll go through the study material also, or the RTP definitely, study material also to the extent possible in tomorrow's class. Hoping to see you all tomorrow in class. Did you guys learn something new today? Did people have little fun today? Remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you're learning something, you're having fun, it's all good. The day you guys stop learning something new or stop having fun, trust me, you might start struggling because you might be in a battle. So thumb rule to stay happy is pretty simple. It is to stay in the game. So for one last time on this day, I have just one simple question for all of you. Are we in the game? Are we in the game? Come on to the top of your voice. Are we in the game? That's it, guys. Tada, bye bye. Take care. See you all tomorrow in the afternoon at 3 p.m. Till then, have a great time. Bye.